You are live, Mr. Gibby.
Hello. Thanks for coming. Good to see you. My name is Jeff Gibby. I'm going to be running everything today, and it's good to see you. Well, I'm going to be, I don't know. Greg's also helping me.
Yeah, I mean, come on. I'm right here.
My car insurance.
Oh, hold on just a sec. Okay, it's good to see you. My name is Jeff Gibby. We're going to go ahead and kick everything off. It's good to have you. It's good to be here. It's been a great conference so far, and we're on day 5. We have a little bit of a shorter day, but we have a great lineup today as well. So welcome. The first thing we're going to do is a legal disclaimer. So today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock and its employees shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Metastock and its employees do not endorse the purchase of a security, nor are they paid for the promotion of a security. No information contained in the presentation today should be construed as investment advice or the solicitation to buy a security. So, good morning, Vincenzo. Good morning, Charles. Say hi as you come in. We'd love to see you. So, want to say real quickly and kind of go through kind of the sponsors of today's events. We have quite a few of them. They're all great. AAII, I'm sure if you've heard about the American Association of Individual Investors, they've been sponsoring quite a number of our events, and a hugely respected organization, a nonprofit. They started in 1970. You can find out more about them at AAII. Stocks and Commodities Magazine, www.traders.com. Great magazine. They've been publishing since 1982. They do a lot of really good work, and they've supported the conferences and the summits and everything that we do for, gosh, 11, 12 years now. So we appreciate that. We do have a new partner, a new kind of partner website that we'd like you to be aware of. You can come in and join us for live market chats, learn about the markets. It's designed to be a community of traders to learn about the markets, learn about technical analysis. There's really, really good market chat. There's people that there's quite a number of people that like to kind of share good ideas. It's been a lot of fun. I hope I see you at thetradersforum.com. Also, I want to say thank you to CMT Association. You can find out more about cmtassociation.org or about CMT Association at cmtassociation.org. Hugely well-respected company, another nonprofit. And if you're interested in kind of getting a CMT designation, that's where you can get it. That'd be helpful for you if you're looking to get a job in banking, or you have assets under management and you want more responsibilities. And Tyler is going to actually talk about that today a little bit later. So, and then finally, a new sponsor of ours, Trade Thirsty. Trade Thirsty runs a lot of they have a lot of stable, I think they said a stable of experts that they work with, and they do a lot of webinars, a lot of online events, and we've been working with them for a long time now. I've known the person over there for, oh my gosh, I met her when I just started, so it's been decades. So you can get a free ETF report if you go to www.tradethirsty.com/free. And of course, we're Metastock. Actually, we did a poll yesterday. We didn't talk about what we're going to do for a poll today, Greg, but we'll figure it out. Hello, Martin. It's good to see you. Our first speaker is actually also from the UK. So anyway, we're Metastock. We've been rated #1 in our price category 31 times in a row. We can help you scan markets, find ideas, test trading ideas. It's a really, really good toolbox. Pricing on it starts at about $75 a month is all. And what we're doing here is, if you want to try it out, if you buy a month, we'll give you the second and third month for free, which means you'll be running till the day after Valentine's Day. So give it a go. Metastock.com/conf promo for any of the specials we talk about today. 800-882-3040 or metastock.com/sales-chat. So with all of that, don't worry, we're not going to do that between every speaker. But with all that being said, our first speaker today is Zaheer. Anwari. Zaheer is been a partner of Metastock for, I think, a few years now. I like the kind of systematic approach that he kind of brings to the market. He uses a lot of pivots. Remember, like when we were kind of bringing him on, I was kind of trying to help him design a lot of his stuff into Metastock. I did a lot of the initial work, and it's very, very extensive. And so you're going to enjoy kind of like what he has to say. And without further ado, let's get started. Zaheer, how you doing? Oh, there we go. Let's try again. There you go.
My apologies. I turned Zaheer's microphone off earlier, and he may not have been aware. Excuse me.
Okay, let me. I can hear you now, Zaheer. Let me go ahead and make you the presenter.
Thank you.
And it should actually just pop up and say, "Hey, do you want to share your screen?"
Yeah.
I don't know if you can see the questions, but Martin Lee says hello from the UK. So.
Hey, Martin. Great to have someone in the UK.
All right, I can see your screen. That's it. I'm going to go ahead and get out of the way. It's your turn.
Brilliant. Thank you. Hi, guys. Hope you're well. I've been popping in over the last few days to listen to the other speakers, and as always, Metastock put together a fantastic event. So I hope you've been getting immense value from it all, and I hope my start to today will bring us maybe a slightly different perspective to how you could potentially approach the financial markets. Today, I'm going to be focusing on discovering overlooked stocks. I think this is really important, creating wealth beyond the media hype. The end of year, I've called this the end of year rally edition, because typically at this time of the year, November, December, we have a strong end to the market, which ends with what is typically called the Santa Claus rally. And this all stems really from my early approach, which was, how do I invest in stocks? How do I find them? What tools do I need to be able to put all of this under my own control? And so hopefully through the next hour, I'll be able to give you a good training session in how I have achieved that. Okay, so a bit of a breakdown of what we're going to cover today. Just a brief background of the MET, the market edge technology, which we're going to cover today. Stocks and performance since last year when the bull rally really kicked into play. We'll then go through the training on how the MET works, and then any questions we will cover at the end. Jeff, if you feel like you need to come in at any point with any timely questions, then please do that. Okay. Right, so just want to set the stage a little bit. You may already have a stock market portfolio in place, but want to optimize its performance. This is precisely what we will be covering today, and how tech has completely changed the game. Tools like Metastock have completely leveled the playing field. It's no longer a space where you have to use old school techniques. Technology has put the whole space in our own hands, and that's what I absolutely love about it. Now, there's a common misconception. Sorry, excuse me. I'll take a complete. Yeah, sorry, I've just lost my train of thought there. Common misconception, right? And now we have complete control in our hands as the retail investors. By the end of this training, you will have an evolved and updated approach to investing in the markets. Often when I speak to people, they are still using old school techniques. People are still playing catch up with what the industry can offer us now in terms of the tech available. Now, a common misconception is that you have to be a genius or an expert or a city pro to be successful, or come up with a brand new, never seen before strategy in order to get ahead in the market. This can't be further from the truth. This is something that I picked up quite early on. It's not about reinventing the wheel. The wheel is already in motion, and it has been in motion for decades. It's just that now, because we have technology, we can take that wheel, we can optimize it, and we can take complete control of that wheel in motion. So I really want you guys to keep on top of that. It's not about reinventing the wheel. A lot of what I'm going to be sharing today aren't techniques that I have created. It's techniques that I've learned, have worked. I've added the tech that was missing, and that's what's allowed me to create this wonderful add-on that I now have the pleasure of having co-founded for Metastock. Okay, tried, tested, simple, and safe make the biggest long-term impact on your financial success and stability. This is really, really important to understand. Tried and tested, simple and safe make the best returns. Now, here's the thing that may sound boring, because often what people are looking for are a sexy way to quick riches. So when you tell people about keeping it simple and safe and using the tried and tested systems, you can see the eyes rolling. The reality is, guys, that there's nothing boring about the wealth you create through compounding gains. And that's the beauty of proven long-term processes, is that compound growth that other systems, other approaches will not afford you. Now, let's just do a bit of planning here. Let's say you have a 20K starting amount. This is generally the sort of amount that people who come to our community, Sublime Trading, they want to learn how to trend follow, which is what we do here. The minimum amount that we really require of our community members is to have at least £20,000, because that's really where good risk management comes into play. Anything less than that, you're going to be entering realms where risk management gets a little bit shady. You may start over risking, you may start doing things that you don't want to be doing. 20K is that sweet spot where it gives you complete control. And let's say that you have a goal of $1 million over the next 20 years, and you want to be able, and you can add a further $100 to the pot. So you've got 20K, you want to reach $1 million, you want to do that in 20 years, and you can add a further $100 to the pot. You need to be achieving an annual average return of 19.78%, so just under 20%. You can of course manipulate these numbers. If you've got more money, that annual return will be lower, for example, but we can use this as a starting point. 19.78% is that average annual return that we want to be aiming towards. Now, if you reverse engineer the goals, banking system less than 1% a year, a tracker fund 7%, 11% a year, hedge funds, depending on which good funds are out there, 5% to 15% a year, real estate 10 to 11% a year, wine, whiskey as well, typically getting you 13 to 14% a year over the last 15 years, which is phenomenal. I'm not a drinker, but you know, when I see these sort of returns, it's fascinating that also that particular brands of wine and whiskey are just going through the roof. I have a friend who's a whiskey broker, and the industry is phenomenal, but none of them compare to what I'm going to be covering today, which is trending stocks. Trending stocks, trend following has topped performance tables for decades, yet it's forgotten about and has been buried under the information of sort of maybe misinformation about it, but also lesser strategies. But if you get on top of trending stocks, you will average around 30% a year. That's what we have averaged over the last 10 years. We've had that audited, my personal track record. I've had it audited, I've had it verified, which has now got me a hedge fund in Luxembourg. Let's just look at some numbers. If you invest in a tracker fund with that 20K over 20 years, and you continue adding $100 a month to the pot, and you average 11% a month, 11% a year, or if you do the trend following methodology, which will get you 30% a year with those same numbers, with a tracker fund, you're looking at about $250,000 after 20 years. Not bad at all if you think about it. Compare that to the banking system, you're not going to get very far. With a tracker fund, you'll do far better. However, with a little bit of education and understanding how to pick the right stocks so that you boost it from 11% to 30% a year, you'll be looking at around $4.5 million after 20 years. So significant difference in terms of what you can achieve financially just with a little bit of education. And also the skills that you develop, I'll be talking about that in a second. With a tracker fund, there's not really any skills there. There's nothing you're learning. You've set up a direct debit and you're just transferring money every month. With stock picking, you've got to learn the tricks of the tools of the trade, which is something that very few people get on top of. And if you can get that, it will completely change everything in terms of what we know as generational wealth, because you'll be in a position to pass that down to your own kids and loved ones. So let's just think about it for a second. When it comes to dealing with those kind of monies, when you start moving into those 7-figure sums, ultimately one of the first things that you'll be on top of is your retirement goals and your wealth goals. Once that is in place, talking to people that are very concerned about approaching their retirement years. Many of them don't have a pot size that they're comfortable with. Trend following and compounding will certainly get you up to speed and get you on track with those wealth goals. Once you are on track, then it opens up other options. For example, how much you work. You may not, if you're a contractor, you may not want to take all the contracts that come your way. If you're working full time, you may be able to start reducing your hours. Options start opening for you. Of course, then you can start putting processes in place to ensure that your family and loved ones are taken care of. Once our time on this planet comes, you want to make sure that people are looked after. When you start dealing with the monies that come with compounded growth, all of this starts becoming under your control. You can, of course, become far more generous with your money. I've been working with a charity here in the UK called Streets Kitchen for the last 2 years. And what I like about being in my position is that every week, regularly, food is short. And that means I can dip into my own pocket and I can then make sure that we feed typically up to 100 people every week. Every Wednesday, which is my shift, we feed up to 100 people. Regularly, food is short. It allows me to dip into my own pocket and make sure that there is enough food for people on the day, which can end up being anywhere from 500 to £1,000 for me personally at the end of each month. Of course, you may want to start your own business. Often you speak to people and a lot of them are doing career choices that aren't their primary choice. They've kind of been directed down that route. Many people want to have their own businesses that they want to start. Being in this position allows you to do that. Of course, you can then afford the finer things in life. Who doesn't want those? Me personally, I like tailor-made suits. So since I've been able to afford the nicer things in life, one of the things that I love doing is just making sure that I have the right suits for the right occasion. Tailor-made suits are the one for me. And then, of course, you may want to be able to upgrade your humble abode. All of these options ultimately are all under your control once you start getting back on track with those goals. I don't have children, and one of the things that I would ensure that if I had kids is making sure that they go through the right education. But as I've already said, there's some things in school that the education system doesn't teach them, and that is financial literacy. It's great for building careers. It's not good for financial literacy. So everyone comes out of school with the same issues, which is what do you do with your money once you start earning it? This is why it's important for us as everyday people to get on top of our own finances, understand how to invest in the stock market, and then be able to transfer those skills to our own kids and loved ones to be able to continue the hard work that we've created. That's truly what our legacies should be. Okay, quick bit about myself, guys. I've got a degree in software engineering, which is why the tech element of the investment space, the stock market space really appealed to me. And I got on top of tools like Metastock. It was a complete game changer. I worked for Oracle, Larry Ellison's Oracle. Once I graduated, wasn't a big fan of the sort of 9-to-5 tech lifestyle that I was in. So I quit. I became a TEFL teacher, which is teaching English as a foreign language. Lived in Taiwan, Japan, Philippines, teaching English. Came back to the UK, worked in advertising photography. Now, this is really where I started making good money. Excuse me. We had clients like Coca-Cola, Whirlpool. We had big brand clients where we were doing their advertising for them. Our images went on the side of buses and billboards. We had work done for Vogue, Harper's Bazaar, Tatler, Barcelona Football Club were our clients. Ultimately, this is really where I started earning money, saving money, and wanted to learn how to do it. Started trend following in 2007. I'm sure a question is why trend following? I'll explain why and how it came my way. Co-founded Sublime Trading in 2018. I basically built up a reputation online. People wanted to learn from me. Co-found Sublime Trading in 2018. And then the Reversy Fund was co-founded in 2023. Now, my goal was to put trend following back in the limelight because what I understood is that it had become a forgotten art form with lesser strategies taking center stage. Fast forward to today, I'm in a blessed position to be able to contribute to, of course, Metastock, but all these other wonderful publications have given me a platform to be able to spread my message and to get trend following back into the limelight. Here's where it changed for me, guys. If you haven't read this book, Way of the Turtle by Curtis Faith, I read this book in 2007. This is what changed everything for me because it made me understand what trend following is. Trend following is a simple and very powerful approach to investing for everyday people. Now, this is what I learned. Anyone with a rules-based system could be successful. Simplicity is key. Charts tell you everything you need to know. The less you do, the more you make. And a breakout strategy is powerful. People tend to want to get in on pullbacks. You often hear about people talking about pullbacks all the time, getting in at a cheaper price. But it's actually breakouts that are phenomenally more successful. So our breakout strategy is powerful, and that is what the MET, the market edge technology, which I'm going to cover today, is all about breakouts for the modern day investor. So 2022 was the start of the bull run. 2022, there was a 28% decline from January to October. October 22, the market found support, and it's gone on this massive 70% rally since then. What I'm going to cover now is just some of the stocks that have been found using the MET. Now, one of the things I want you to focus on, guys, is the name of the stocks. The title of this presentation, of this training session, is Stocks Beyond the Media Hype. You go online, all we ever hear about are tech stocks. Nvidia, Tesla, Apple, Microsoft is the usual big tech stocks that get all the headlines. Big tech is just one sector, and that's just one sector within a bigger sector, which is the IT sector. But there are 11 sectors in the stock market. Tech, IT is just one sector. You've got consumer discretionary, consumer staples, real estate, materials, utilities. There's a whole bunch of different sectors in there. What we want to be able to do as investors is go into those sectors, find the strongest sectors in that period of time, and then find the best stocks from the strongest sectors. So notice the names, guys. I'm based here in the UK. These are all US stocks. I'm not aware of these stocks until MetaStock has found them for me. So Ameriprise, AMP, it's up 103% since the bull run started. Amphenol, APH, it's up 105% since, these are monthly charts, since the bull run started, since 2022. Fiserv, FI, this is one of the best performing stocks of this year for me in my portfolio. It's up 110%. FTAI Aviation, I mean, this stock has gone absolutely through the roof. It's 950% since the bull run started. GoDaddy, everyone knows the brand name, where we go online to buy domain names, but no one is talking about it in terms of its stock, and it's just performed phenomenally well. It's 160% run since the trend started. Vistra Corporation, this is actually the best performing stock in the S&P 500. It's actually performed better than Nvidia. Again, no one's talking about it. Again, found by MetaStock. I've also used the MET to invest in gold. I'm currently long on gold. It's going through a bit of a correction at the moment, but I've been long on gold since March. I was short on palladium. I was long on the Japanese yen pairs. These again have all been found using the MET, and it's important to be able to diversify. You don't want to just focus on stocks. You want to diversify into other asset classes when required. You don't want to diversify for the sake of diversification. Everything has to be strategic. But when the opportunity does come, you want to diversify, and the MET excels at helping you achieve this. Just to give you an idea of how we have performed since last year, we have a service in Sublime Trading called the APL, the Asset Position Log, where we do the scanning and we share our portfolio with our community members for them to copy. As I mentioned, that typically it's a 20,000 starting amount for our community members. So the calculations are all done on a £20,000 account. Current running P&L is over £23,000, so, or $23,000. We have an ROI of last year of over 100%, roughly around 115 to 120% at the moment. So you can see the power of choosing a handful of good stocks, holding them and compounding them. This is how returns have always been done by the finest investors and traders. Instead of this sort of in-out methodology, which is what is pushed today, take many positions every single day, be in, out, cut yourself in, cut yourself out. It's not the way you want to do it. You want to be slower, you want to be more methodical, you want to be more strategic, you want to find the best stocks, cut out the losers, hold and compound the winners. It's timeless. And it's also a process that will allow you to just get on with your day, working, family life, whatever needs to be done with all of these processes working in the background. Here's just an example of the sort of sector exposure that I have at the moment. Industrials, guys, It's the single best performing sector this year. Yet if you go online, everyone's just talking about IT. Industrials doesn't even get a look in. So it's important to move away from what's going on online, because it's just a very inaccurate picture. It's misleading. It's a lot of disinformation out there. You want to step back away from all of that and go deeper into what the technology that's available to you today, like Metastock, to be able to create a much more powerful portfolio, not just over the next 6 months. I'm talking about for the next 10, 15, 20 years. That's the time frame, the horizon that you need to be looking at. Okay, so use the MET to invest in trending stocks that are outperforming the S&P 500. Now, what does this mean? Well, the S&P 500 is an average. Some stocks match the average, some stocks underperform. We want to find those stocks that outperform the average. This is where the MET comes in. So once again, the S&P 500 has roughly moved about 70%. If you look at all those stocks that I shared earlier, they've all moved over 70%. So what that tells you is that it's very straightforward and simple to be able to find those stocks. You've just got to know how to do it. And there's a plethora of them every single year. This is the beauty of the US market. I'm here in the UK, but the US market makes up 90% of my portfolio. The remaining 10% will be UK stocks, commodities potentially. Sometimes it's 100% US stocks. It's just that I'm diversified across sectors. So again, don't fall into this trap of thinking diversification is, okay, I've got to have this and this and this and this. No. You want to be where the money is, and then diversify across the best assets in that class or in that sector. Okay, stocks outperforming the index move up quicker, deliver superior returns over the next 12 to 18 months, and they all follow a particular pattern, which we call the 4PS method. So the 4PS method is that every single stock that makes it into my portfolio follows 4 phases. First, it has a proven performance history. If it's performed well in the past, it's very likely to perform well in the future. So all of these stocks like GoDaddy and Nvidia, Amphenol, Fiserv, they all have a proven history of performance. Then you have a consolidation base, a sideways market. The longer the consolidation, the bigger the breakout. Then you want a breakout, which is a move out of that consolidation. Typically, that consolidation base, 3 to 6 months is a good period. Longer, the better. Then you have the breakout, and then you have that phase 4, that new trend. This is the trend that we want to get into, to have into our portfolio, and will typically last for 12 to 18 months, which is the holding period. Use the MET, which is what we do, to find those phase 3 and phase 4 stocks. Okay, so how do we do this, guys? Well, let's switch over to Metastock. Okay, so when you first open Metastock, let me just double check, make sure that you can see my screen. Yeah, looks like you can see my screen. Okay, so when you first open Metastock, this is what you will be presented with. The magic happens in this power console in the top corner. I have favorited the explorers for you, so ignore the top 2. Is these 4 explorers here. These are the ones that are included in the MET. Now you'll notice that there are 4 explorers with with a particular criteria for each one. The top one is a breakout explorer for large cap stocks, so stocks with volume over 200K. We've also then got a scanner for small to medium cap market, so those with 50K volume plus. So US market, typically we scan for stocks with over 200K. UK market, and we've got community members in India, we use the scanner that scans for volume of 50K plus. We've also got, so we've got 2 scanners that look for bullish opportunities, and 2 scanners there that look for shorting opportunities. So you've got everything covered here in terms of looking for breakouts. Breakouts is really where you want to start from. Why is that? Because first of all, there's the breakout from the consolidation. So if you look at the 4 phases that we went through, phase 2 to phase 3 is the breakout from a sideways market into a start of a trend. And then when the stock starts trending, you've got breakouts all the way up. Yes, you've got pullbacks, but you'll have far more breakouts, far more high probability breakouts than pullbacks through the duration of a trend. So that's why we have got these scanners that help to look for those breakout opportunities. Okay, And then we've got the markets. Now, in terms of the markets that I like to scan for, well, when it comes to North America, these are the three main markets: the NASDAQ, the New York Stock Exchange, and then the New York Stock Exchange Amex, totaling roughly around 11,000, 12,000 stocks. Phenomenal number of stocks that MetaStock will scan for you at a click of a button. You just click here, start exploration, and it will leave it to do its thing for 10 minutes, come back, and you will have a list of stocks to go through. Again, all of those stocks have been picked up on a particular criteria. At the back end of these scanners, we're looking at things like volume, we're looking at things like where they are in relation to the 200 simple moving averages. There's a bunch of criteria that goes into these explorers that basically goes through 11,000 stocks, and then we'll give you a much more manageable list. Typically, anywhere from 50 to 200 stocks is a good number every single day. Excuse me. Of course, it depends on what is happening on that particular day. For example, on the day of the elections, when Donald Trump was voted back in for his second term, with, of course, that gap in his gap term there. That particular day, MetaStock picked up 800 stocks because of the big gap up and the huge bullish moves and that very positive reaction to the elections. MetaStock picked up 800 stocks. Yesterday, because there was a correction, there's currently a correction in the market, MetaStock picked up, I think it was like 40 stocks or 50 stocks. So it depends on what's happening day to day. At the very minimum, you want to be scanning the market once a week, which will be at the weekend. I like to scan the market every single day because there's opportunities coming up every single day. Once the market has done its thing, once the explorers have done their thing and picked up the stocks, I then save that list, and then I can go into the charting section, which is here. And then typically what I do is I save my lists. You can see here I've got a bunch of lists for the Indian market, some for the UK market, some for the US market. So I typically like to save my lists each week, and then at the end of the week I delete them, and then I create the next set of lists for the following week. Once I've done my list, I can then open each of those, I can then open up each of those stocks that has been found by the explorer. I can open them up into this analysis setup that I have created. So in the top left, we have the monthly time frame. In the top right, we have the weekly time frame. In the bottom left, we have the daily time frame, and then also in the bottom right, there is the daily time frame. What we have here is a multi-time frame analysis setup, and what we're looking for is alignment, multi-time frame alignment. If the monthly in the top left, weekly in the top right, and the daily in the bottom left, if they're all moving in the same direction, we have a high probability asset, which you can consider for the portfolio. If you have considered that for the portfolio and it's ready for investment, we then go into the daily in the bottom right. And then in the daily in the bottom right, that's where you will find your entry points, your stop losses, trailing stop losses, compound levels, all the information that you need to transfer into your broker account that will be found in the daily chart in the bottom right. So let's start with the S&P 500. I'm going to start with the monthly time frame so that way you get a feel for what is happening. So first and foremost, you'll notice that there's a solid green line and a solid red line. There's a solid green line here and a solid red line here. What we're looking at is the high and the low of the previous calendar year. Any asset that's trading above the high of last year has a bullish bias. Any asset that's trading below the low of last year has a bearish bias. Guys, excuse me, let me just grab some water. And any asset that's trading inside the annual levels between the high and the low of last year, that's a sideways market. So if you look at the S&P 500, since January of this year, it's been trading above the highest point of 2023, hence why it's been in a confirmed bull market. We also have these dotted red and green lines. These are key major levels of support and resistance. Critical levels of support and resistance, which you will find only on the monthly time frame. The beauty of having good software like this is that the tools are continuously being updated through the system. You don't have to manually draw support and resistance lines, which I know people who use lesser software, they're continuously marking their own support and resistance level. You can imagine, even if you're going through, let's say 10, 15, 20 charts, and you have to mark those support and resistance levels yourself manually on a daily basis, you can imagine how much time and effort that takes. What we have here is software that is doing that work for you. We're not in the days before the internet. Before the internet, charts were drawn by hand. And because charts were drawn by hand, it was a long and laborious process having to create all of this. The beauty is we have technology now, and we have good software like Metastock that not only does the scanning for you, but also once programmed with the right tools will continuously update itself. So all you need to do is to do your analysis, make the right decisions, and manage your broker account. So that's the monthly time frame. Now, the other thing that I like to look for on the monthly time frame are periods of history, proven performance history. Going back to the 4PS method, if we look at this area here, we can see, for example, if I just compress the chart, just so that you get a little bit more information. This is the S&P 500. Does it have a proven performance history? Yes, it does. We know the S&P 500 since 2009 has just really been heading up. Then it went through a phase 2, which is this base. Then the phase 3 was January of this year. Excuse me. And then phase 4 is the trend that it has been in since this year. Now, of course, the trend has really been in place since the support was found in October 2022. But in terms of trend confirmation, real trend confirmation, is when it started breaking out and printing new all-time highs. Now, when all the factors align, what I like about Metastock is that it has a ribbon here at the bottom. You can see that it says bullish. That means that all the criteria, all the factors that have been programmed into the monthly time frame, they've all aligned to confirm that we are in a bull market. Now, also what I like about Metastock, again, I wish I had some of these kind of tools when I first started, is that you've got expert commentary that's inbuilt, that's guiding you every step of the way. So here at Sublime Trading, we programmed with Metastock help, with the guys at Metastock, we programmed Metastock to be able to give you the right commentary bar by bar. So if you look at right now, there's an upside down triangle on the current bar. If I move that across, you will see that the arrow moves, that the triangle moves. And with that, the commentary is changing for what is relevant on that particular bar. So that's the monthly time frame. The monthly time frame on the S&P 500 is bullish, telling us that we're in a bull market. So we now go to the weekly time frame. So the way I like to do it, guys, is that I start on the monthly because that gives me a very clear picture of what the asset has done in the past, how it's setting up right now, and what it's likely to do going forward. I get all of that information on the monthly time frame because I'm looking for those big moves. On the weekly time frame, same setup. If you look here across the bottom, guys, it says bullish. That means the weekly time frame programmed with the indicators that we have on the weekly time frame are now all aligned, and we are in a bull market. The bars are green. That means our trend filter is telling us that there is a bullish trend in play. The moving averages there, we got the 50 and the 200 simple moving averages. They're all angling up, confirming that we're in a bull market, and that price is above the moving averages. If the price is above the moving averages, that means it's performing better than the average. And then on the weekly time frame, we also have all the other the sort of minor, the less. On the monthly time frame, you have the major, the real critical levels of support and this resistance. On the weekly and the daily, you have the tier B, if you like, the sort of less critical but just equally important support and resistance levels on the weekly time frame. Again, bullish time frame, bullish ribbon on the weekly time frame, telling us that the S&P 500 is bullish on the weekly time frame. So what do we have? We have that alignment. The monthly is bullish, the weekly is bullish. Now we need the same thing on the daily time frame. The way I like to look at this is the weekly time frame is big sister, the daily time frame is little sister. Whatever big sister is doing, you want little sister to be following. So if you look on the daily time frame, is the daily time frame following big sister? Yes, it is. You can see that the ribbon is bullish. If you look at the trend filter, it's predominantly green. Yes, there's a bit of a correction going on at the moment. Let me just expand the chart so you can see for yourself. You can see that there is a bit of a correction. That's okay. We expect the market to have ebbs and flows. There's a bit of a correction going on. There's the 6,000 round number acting as resistance. and we have the moving averages below, which will act as a support level to potentially push price further up. Crucially though, all the factors on the daily time frame have aligned. You can see here it says bullish. So despite this pullback, the overall bias of the market is still bullish, and that means we want to be patient and we want to allow for the market to do what it's doing, which is go through this correction where everyone tends to panic and start screaming market top. Those with a process and a systematic approach will remain calm, get on with their life, pop in day to day at the end of each day to see what is happening, and then manage their portfolio accordingly. So that is how the 4-screen setup. We're going to go through the daily in the bottom right in a second. A point to note here is that I don't take positions on the S&P 500. The S&P 500 for me is an average, and because it's an average, it's good to determine what the overall market is doing. So if the S&P 500 is bullish overall, then the market overall is bullish. And so that means then I can then look for those stocks that are outperforming the average. So let's have a look at some of the stocks that you should certainly be having a keen eye on. One of those is Amazon. I don't know, again, guys, I mean, Amazon is a massive, massive company. I'm sure pretty much everyone on here has an Amazon account and, you know, has or at the very least ordered something off Amazon. Yet when it comes to their stock, no one is talking about it. And if you look at their stock, Amazon is actually now printing new all-time highs. So if we apply the logic of what I talked about, which is that 4PS method, does it have a proven performance history? Yes, it does. It has a massive performance history, very good stock. Phase 2 is this long sideways market of many, many years, actually. Phase 3 is this breakout, and we're now waiting for that phase 4 where we can start taking a position. In fact, apologies, it has only just set up for phase 4. I'm going to show you in a second, and we've actually added this into our portfolio. Importantly, you can see that the ribbon is saying bullish, so all the factors on the monthly time frame have aligned to say that we're in a bull market. If we go down to the weekly time frame, again, green trend filter above the moving averages. The ribbon here is saying bullish, so the weekly time frame has aligned with the monthly time frame. Excuse me. And then if we come down to the daily time frame, you've got a bullish ribbon here as well. So overall, across all 3 time frames, the monthly, the weekly, and the daily, they have all set up, they're all aligned to tell us that we have a bullish trend in play and that this is one to consider for the portfolio. Okay, so now that I've decided that I want to take this position, I want to take Amazon and put it in my portfolio, I need to know what my entry points are, what my stop losses are, what my compound levels are, how much I potentially want to risk. These are all these sort of questions that need to be answered. That's where the daily in the bottom right comes in. Now, first of all, you'll notice that they're blue bars. When the bars are blue, there's an added filter on here, which is great. The bars are blue, which is telling us that the monthly, weekly, and the daily are aligned. So you've also got that on the daily in the bottom right corner. If I just go back to the 4-screen setup, when the monthly, weekly, and the daily bottom left are all aligned, the daily in the bottom right will have blue bars telling us that we have a good trend in play. So I'm just going to open that up. Now, there's this green line here. First of all, you'll notice that there are some diamonds underneath the blue bars. These are entry points. So when the diamonds start appearing, what the MET is telling you is that you now have the opportunity to enter in on this stock. Monthly, weekly, daily are aligned with the blue bars. We now want to know where to enter, and we want to enter on the right breakouts. First of all, you'll notice that there's diamonds and then there's a circle. A circle is a low probability breakout entry. The diamond is the high probability breakout entry. So it's actually telling you, well, okay, you could potentially enter here, but you may want to either stand aside or reduce your risk because this isn't a very good quality breakout. And you can see it's more of an indecision candle. With breakouts, what you're looking for are big bars, good bullish breakouts. And that's why we've got a diamond here and we've got a diamond here. And you've also got this subchart indicator, which we call the BOQ, the breakout qualifier. It's actually telling you how good the breakout bars are. So the green bars, the green histogram is a solid bullish breakout. The red The red histogram is telling you that it's a low probability bullish breakout. The gray bar histograms are telling you that it's a neutral breakout bar. You may want to stand aside on it and wait for a better opportunity, or you may want to reduce your risk. So the software is actually telling you the quality of the breakout so that you're continuously stacking the odds in your favor. Then you've got the entry, which is this green bar, green marker here. You've got your stop loss, which is this red line here. And then you've got your compound level or your target level here. So when the stock moves to this price, you can then start considering adding more of Amazon into your portfolio. And this is a really important point, guys. As a trend follower, I don't set target levels in that in my broker account, my position will not close here. I add more of a winning stock. When a stock is performing well, you want to buy more instead of taking profit. If you're taking profit, it's because it's fear-based. If you're adding more, you're actually adding based on a systematic approach, and you're doing what the finest traders and investors have always done, which is add more of a winning asset into the portfolio. And then finally, if I compress the chart, you will notice that there's this red line across the bottom. These red lines are the trailing stop loss. So as the stock moves up in your favor, there's a trailing stop loss that follows that you can then manage and put into your broker account. It's a wide trailing stop loss that typically allows you to hold positions for 12 to 18 months. Again, everything is in the commentary. So if you go to view expert commentary, again, everything is there for you to take into consideration. You've got the entry points, you've got the stop losses, you've got the explanation as to why the bars are bullish. Why is it making it a high probability breakout? Why is it a low probability breakout? Everything is explained in the expert commentary so that you are fully informed when it needs to, when the time comes to actually make a decision and add it into your portfolio. So that's Amazon. Let me just go through some other stocks that no one seems to be talking about right now and that have all been picked up by the MET. So the other one, again, one that you may obviously be very familiar with, is Hilton Hotels. Hilton and Marriott, they're two very, very good performing stocks that, again, don't get any media attention. I'm going to go through these quite quickly. If you look at the monthly, it's bullish with the ribbon. If you look at the weekly, the ribbon is bullish. And if you go to the daily, the ribbon is bullish. And then if you go to the daily in the bottom right, I'll just open that up. Trend filter is blue, telling us that we have a trend in play. Entry, stop loss, compound level, all there for you to then put into your portfolio. Very simple, very straightforward. Okay, another one that I'm going to go through, this has actually been in my portfolio since last year. Again, no one talking about it, and if I'm honest, it's not a stock that I was familiar with until it actually got picked up by the explorers in Metastock, and that is BWX Technologies. Again, monthly is bullish, weekly has been bullish for a very, very long time, daily is bullish, trend filter is blue on the daily in the bottom right. You've got all your, and look, if you look at the diamonds, guys, look at the number of high probability entry points that have been just in this stretch of the trend. 1, 2, 3, 4, 5, 6 high probability entry points since September. This stock has been performing very, very well. It's been in my portfolio since last year. No one's talking about it. And let me just go through one final stock. Let's go through Waste Connection. Okay, there you have it. Monthly bullish, weekly bullish, daily bullish. It dropped out a little bit because it went through a bit of a sideways market. If I just open up the daily in the bottom right, excuse me, bottom left, overall performing very well. Went through a bit of a sideways market, and it's now popped out of the other side of that sideways market. Trend filter is green. And if we go to the daily in the bottom right, we can see that there was a breakout signal recently, which can be considered, which was considered. We actually added this into our portfolio on the 13th of November, further positions. We've actually had this in our portfolio since the start of this year. So we've now added more positions. We've compounded. So there you have it, guys. Step one, use the explorers, which will then scan 11,000, 12,000 US stocks. It will give you a more manageable list. You save that list. In the list section. of the Power Console. You then save these lists however you want to choose. I've got a naming system that I use. And then what you do is you open each of those stocks up in that list. You go through the 4-screen analysis, and then you make a tier A, tier B watch list. Tier A go into my portfolio. Tier B are those that I'm watching. And that's how I rotate and manage my portfolio. Very simple, very straightforward. No news channels involved, no media channels involved, no opinions involved, including my own. Remember, one of the first rules of investing is to ignore opinions, including your own. It's a concept that people find hard to really sort of absorb. But the less you try and bring opinion and understanding, and the more you follow, the more money you make. It's the simplicity, guys, that eludes most people. Okay, I'm just conscious of time, so I'm just going to switch back to the charts. Just make sure the charts are showing. Yes, they are. Okay, so the MET 3-step blueprint. First, pinpoint when to invest for maximum ROI. This is market conditions. We use the S&P 500 for this. I showed you how I did that at the very beginning. Once the S&P 500 is confirmed to be bullish, I know what kind of market conditions I'm in. If the S&P starts reversing and starts going back inside the annual levels of last year, or the trend filters start changing color, then I know market conditions are changing. But ultimately, you get a lot of information from the S&P 500 and the 3 screens, the monthly, weekly, and the daily, to ensure that they're aligned. That's how we look for market conditions. Step 2, identify top assets to invest in for maximum ROI. This is where the explorers and the analysis comes in. So first step is to use the explorers. The second step is to use the monthly, weekly, and the daily to then analyze those stocks. And then the final step is clarity on how to invest for maximum ROI. Most people are struggling for a strategy, particularly when it comes to risk and exit management. Everyone seems to get into a stock, but when it comes to exiting the stock, that's really where the challenge comes in. Within the MET, the daily in the bottom right, that's where the strategy criteria is found. You've got your entry points, your stop losses, your compound levels, your trailing stop losses. Risk management is typically no more than 1 to 2% per position. Very simple, very straightforward. This is the exact methodology that I use for my own portfolio, and it's the exact methodology that we use to manage our investors' money in our fund. Everything is explained as well, by the way. This is not a black box system. Where the stop loss is explained. There's a formula that we use, how the entry is calculated, how the trailing stop losses are calculated. Everything is explained. There's a wonderfully detailed manual that comes with the MET. So all your questions will be answered. Okay, the MET, guys, is your edge. And this is what I mean. There is an expression. If you cannot define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does. I'm just going to say that again. If you cannot define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does. The MET is your clearly defined. The MET is your clearly defined edge. So now when someone says, what do you look for in a good stock? You know exactly the precise criteria. There's no fumbling for what makes a good stock. So guys, the market edge technology, this has only gone live in the last week. It's currently 1497, but on the current price that we have, the introductory price, it is now going for 997. That's a one-time offer, guys. The MET bundle also comes with a one-to-one onboarding call with myself so that we can discuss your current portfolio, private community to discuss daily setups, and a boot camp training day. The date is still to be confirmed. I'm going to be discussing this further with Metastock, but I'll be doing a live boot camp training day to make sure that you guys understand precisely how to use the MET. Value in this is jam-packed, guys. Over the years, in how much time and effort it's taken to create the MET, as well as all the other bits and pieces that you're getting at, is jam-packed with value that will help you all to get back on whatever your goals are, wherever you are in life. The MET is designed to help people get back on track with complete control every step of the way. Now, what the MET also does, guys, is that there's 30+ years combined experience between myself and my co-founder. It will save you thousands, and I mean literally thousands and thousands of dollars trying to create this system yourself. By all means, I've given you all the information that you need to actually go away and do that. But it's not as straightforward as people think. This will save you that money. It will save you endless hours trying to create this system. It's not about reinventing the wheel, guys. It's about learning what works, taking it and putting the time and effort into actually making money and growing your portfolio. Not trying to figure this out. I've done the hard work to figure it out. You don't need to do that. You just need to put the processes in place to start growing your money. It's a proven system. As I said, it's a system that's decades old. It tops performance tables. I've taken that system, optimized it, and added the technology. And ultimately, it gives you peace of mind that the future is in your own hands. And as I said at the very beginning, it's a system that you can pass on to your loved ones. This is your legacy. Financial illiteracy is rife globally, and it's not going to change. Your kids are going to come out into arguably a more difficult world, a more expensive world, but still financially illiterate. So if you don't get on top of it, who's going to teach your kids? It has to start with you guys. And again, that'll be a legacy that you'll be immensely proud of. So once again, 1497 is the actual price, but currently it is 997. This is the introductory price, one-time offer. Jeff, over to you.
Here, can you answer a couple questions?
Absolutely, yes.
All right, let's see. The first question, we actually have a few. The first question we have from Al, he says, great webinar. I trade short-term futures. Does this work on a 30-minute NQ or GC chart?
Sorry, does it work on a 30-minute chart?
Like a 30-minute NASDAQ chart, a 30-minute futures chart.
Yeah, sure. Look, it's a question that I get asked a lot. This is a trend following methodology, and if you look at trends, if you take the definition of a trend is something that's in play for the long term. Fashion trends, for example, they're at least 3 months if you look at it seasonally. Yet trends will often stay in play for years. Fashion trends that are forgotten about, that come and go, they're called fads. You want to approach the financial markets with that same understanding, that same logic, which is this is a trend following methodology. Look for the trends on the higher time frames. The problem with lower time frames is that you're dealing with more noise, more candlesticks. The chart patterns are far more erratic. It's very, very, very difficult to make any money day trading. I'm not saying that it's impossible, it's just notoriously difficult. If you want to take this system and adapt it to a lower time frame, by all means, go ahead and give it a go. But the edge lies on the higher time frames. Less money, more work.
All right, let's see. Another question we have is roughly how many stocks are identified each day through your scan?
Good question. Yeah, good question. Good question. On average, I would say somewhere between 100 to 200 stocks.
David also wants to know if if your trailing stop is set as a percentage of the entry price or something else.
Yeah, great question. It's based on the ATR, average true range. So that is then unique to the volatility of each asset. So it's a formula, let's say ATR over 10 days or 20 days, and then we use a multiplier. So ATR 10 times 4 or ATR 10 times 3. So there's a mathematical formula that makes it unique to the volatility of each asset.
Grace says, I trade options and I don't buy stocks. Does it help with that?
Yeah, absolutely. Absolutely. Well, it's a very versatile system if you're looking, as long as you stay true to the principles of long-term investing, holding, compounding, of course, you can use it across the board.
All right, one more question, and then I think that's where we have kind of a time limit. But Jason says, relative to open strategies, what are your thoughts on using a market maker broker to get better fills? And can you suggest a good one?
Look, I'm not one to talk about brokers. There's brokers that I recommend once I know people's financial situations, how much money they're dealing with. Then I'm in a better position to sort of recommend brokers. But other than that, I'm broker neutral. I'm not. I don't have IB agreements in place. I don't recommend brokers other than once I've got on that onboarding call and I know more about that person's personal finances and goals.
Perfect. All right, that's all the questions. Zaheer, I want to say thank you for being here. I'm going to talk a little bit about how to get this as a special offer. And before I let you go, thank you for coming in and spending some time with us.
It's always a pleasure. Thank you for today, and enjoy the rest of the day, guys. I'm sure it'll be a good one.
All right. Thank you, Zaheer.
Cheers, Jeff. Cheers, guys. Bye.
Bye. Okay. Presenter. Okay, I'm working on it. Here we go. All right. All right. So just to kind of recap what's included with Matt, you do get one template, the indicators, the explorations, the expert advisors that he talked about. And I love kind of how well things are put together, how kind of clear they are. You'll hear the indicators, here's the stuff that's actually included, and here's kind of the expert advisors that are included, just everything that you need to go ahead and get started. I know from the poll yesterday, about 70% of you or so haven't used Metastock yet. If you don't have Metastock and you do the MET package, we'll actually throw in a money back guarantee. We'll also throw in a free trial. From that, you're going to be able to get unlimited access to support, free white glove setup, unlimited access to a lot of recorded training that we offer. All of that stuff's going to be actually included as part of it. And to take advantage of the market edge technology, that package normally is $14.95. Again, if you buy it here at the webinar, it's going to be $9.97. You can do that at metastock.com/conf promo. You can go to metastock.com/saleschat, and you can give us a call at 800-882-3040. Again, it's $9.97. We offer it with a 30-day money-back guarantee, so you can try it, make sure it works for you. We'll even throw in a trial to Metastock that's been rated #1 in its price category for 31 years in a row. The risk reward ratio on this is pretty good. So if you liked what you saw, want to be able to find these kind of setups and all that kind of good stuff, metastock.com/conf promo. So, all right, very cool. Oh, I just remembered that I need to pull the list so we can start doing some prizes. I'll do that after we get started here. My apologies, I forgot. I do want to say thank you to one of our sponsors, the CMT Association. CMT Association has been a supporter of the Metastock conferences and the summits that we do for quite a few years now. Later on today, this afternoon, Tyler Wood's going to come in and talk about the benefits of having a CMT designation. I'm trying to find the right word there. It's a hugely well-respected, well-reputed organization. You can find out about them at cmtassociation.org. You can also call them at 646-652-3300. So, with our recommendation. All right. Also, we appreciate the sponsorship as well. We are, of course, Metastock. Been talking about Metastock. Zaheer showed how you can scan and kind of take a big list and make a small list, find the opportunities that sit in the market. It'll also help you test trading ideas. Get our forecaster, our patented forecaster, will look at a lot of statistics to give you good probability analysis. The commentary, we've talked a lot about the commentary. I love it, especially if you're new to the market and just want to learn about, what indicators do and what they're what they're designed to do, and kind of help figure out your learning curve. Metastock starts at just $75 a month. If you subscribe, you'll get 3 months. That's February 15th. You'll be able to run it all through the holidays. You'll be able to play with it. I don't know. I personally get a lot of downtime during the holidays. Maybe you do too. What a great time to actually kind of start looking at a software that can really take your trading to the next level. So go to metastock.com/conf promo for all of the offers and to sign up for that extended trial. You can also give us a call, 800-882-3040 or metastock.com/saleschat. So I promised that Tyler Wood would come in later to talk. He's also going to come in right now to talk. So our next presenter is Tyler Wood, Alex Cole, great presenters. They're going to talk about kind of their GoNoGo methodology for identifying the trends and symbols and turning points in the market. They do a good job. We love having them on here. Let's go ahead and get you started, guys. How are you doing?
Hey, Jeff, can you hear us?
I can hear both of you, and I can see you, Tyler.
Awesome. Happy Friday.
Tyler, I'm very disappointed. Like, I don't see a lot of musical instruments behind you this time. Oh, okay, now I do.
I think my head has just gotten bigger, Jeff.
All right. Well, I can see both of you. Refresh my memory. It's usually Alex that does the screen share. Am I correct?
I'll do
It's
the
usually
screen share.
Tyler. Okay. Let me go ahead and send that over to you.
Thank you, sir.
And I need to, just so for when I'm introducing you, so I need to bring in my guitar and hang it back here just so that I feel in place.
You start singing, Jeff.
Oh, we want people to stay. I'm not going to sing.
Jeff Gibby, the Eddie Vedder of Metastock pickup bands, right?
Yeah. All right, I can see you guys. I'm not going to reply to that. I can see you guys. I can hear you guys. I'll get out of the way. It's your turn.
Thank you so much for having us. I was really enjoying Zaheer's talk because it aligns with a lot of the ways that CMT charter holders think about the value of technical analysis. And what we're talking about today is using data to drive your decision making rather than relying on perhaps your preconceived notions, your emotional reaction to headline news, to what you think about perhaps the underlying fundamentals of the companies or the geopolitical landscape that we're investing in. And certainly this year, like every other, has been a bit of a wild ride. When we were looking at charts in August and at the last Metastock conference in September, perhaps a little indecisive spirit amongst a lot of investors. And we saw, volatility spike in early August as the Bank of Japan unwound those carry trades with a surprise rate hike. We also know that we've got a lot of bullish enthusiasm in the market right now, and we certainly are participating in bull market activity. But I think what I hope everybody takes away from this conversation over the next hour is that markets move in cycles, right? We have bull markets and bear markets, and you can use the information presented in prices, volume, volatility to help guide your decision making about when those trends are worthy of participating in and when indeed they become exhausted or even revert into downward trends. So we're going to keep our eye on the markets rather than the news, as Zaheer was telling us. And to get us started today, Alex and I have known each other well over 15 years, all through the CMT Association. It's a pretty incredible network of professional money managers, data analytics professionals, and we came across John W. Henry. It might be a familiar name to many of you if you've read the book or seen the movie Moneyball. Well, this gentleman grew up in a farming community, pretty humble beginnings in Southern Illinois, and he learned the commodities trade. And what John Henry went on to do is really incredible. He owns Roush Fenway Racing and the Liverpool Football Club, and of course, if you've read Moneyball, the Boston Red Sox. And if you are a baseball fan and you know about that really underdog team, sort of the Bad News Bears that went on to have just an incredible winning streak, it was all driven by Sabre analytics. And they started using statistics of players' performance rather than tried and tested recruitment techniques of judging the player's arm or seeing what family they may have come from or whether or not they had a girlfriend. A lot of speculative, emotional-driven decision-making in player selection. And if you get down to what's actually happening with those players, how they actually perform statistically, batting averages and pitching and catching and all the rest of it, you can assemble a championship-winning team. And so what John Henry has taught us about trend following, and he's a wildly successful trend following investor, is that simply observing what is actually happening and quantifying that can give you a huge advantage over the rest of market participants. And so keeping that in mind, here's what we're going to talk about today. This is our agenda. And there's only 3 things on the agenda because I'm a pretty simple guy. I can't remember more than 3 things. Number 1, we're going to talk about those basic tenets of trend following. What is it that we're actually trying to accomplish, and how does traditional technical analysis help us do that? We're going to identify what rules-based systems look like, so that you can separate your preconceived notions, your biases, your emotional reaction to what's happening and make more data-driven decisions. And then we're going to go through some real-time charts looking at today's bull market and look across asset classes to kind of see the landscape. So if that sounds like a pretty good agenda, let's buckle up and dive right in. When we talk about the tenets of trend following, what we have to start with is the expectancy formula. And folks a lot smarter than Alex and I in the behavioral finance community have spilled a lot of ink helping us all understand what are those heuristics or mental shortcuts. If you're familiar with Daniel Kahneman, if you've read the book Thinking Fast and Slow, he talks about system 1 thinking and system 2 thinking. It's not wrong, but there are a lot of mental shortcuts that we've developed to help us process overwhelming information, to help us in a fight or flight scenario. Level 1, or excuse me, system 1 thinking are those shortcuts. You jump to a conclusion because you have to react quickly. If you're driving on the road and a car pulls out in front of you, you're not really processing what actions you should take. Your system 1 thinking takes over and you swerve out of the way and you slam on the brakes. That's system 1. We don't really want system 1 controlling our portfolios. We want to have a plan and a rules-based system and be in control with our system 2 thinking. Now, we know that those behaviors really impact portfolio managers or investors or traders because they have also, Amos Tversky and Daniel Kahneman, outlined prospect theory and the exploration of the fact that we as humans suffer much greater disappointment from a loss than we experience joy from a gain. So let's unpack that for a second using the adage from the 1600s. We want to let our profits run and cut our losers short. But emotionally, coming to grips with being wrong, cutting a loser short, you chose that security, you put it in your portfolio, you are an investor, and it's trading against you, and you're down 10, 15, 20%, 30, 40, 50%. If you don't want to recognize that loss, you simply hold on to it in your portfolio. And that's a very dangerous thing that happens to a lot of investors. I'm not just talking about retail traders. Institutional investors suffer from the exact same things. They are also human beings. And not wanting to cut a losing position and admit to the loss is a very natural human emotion. Contrarily, when we have winning positions, we're pretty eager to lock in that gain and move on to the next thing. So we don't necessarily capture the full breadth and length of trends. So when we look at this expectancy formula, and if you just follow my little laser pointer here, this is our efficient frontier. This is where a portfolio gets to break even. And it's the combination of the percentage of winning trades and the profit ratio of each of those trades. So let's just pick on one dot, this little blue one down in the center. That is a 50% winning trade rate. So imagine you just have a coin and you flip a coin. That's your entire edge in the marketplace. You have no opinion. You don't even look at the ticker symbols. You have no idea what the companies are. Not looking at a chart. You just flip a coin. Heads, I buy it. Tails, I don't buy it. You could still break even with a system of totally random stock selection if you manage the risk and reward correctly. And so above a 2-to-1 ratio of profits to losses, you are at break even and above. Now, these dots over here, and actually probably up here in this green area, you've got some incredible hedge fund managers in the world, CTAs, commodity trading advisors, who are very comfortable not having a particularly high percentage of winning trades. They place lots and lots and lots of small bets, but they manage the risk and reward. And when they have a winning trade, they can really lean into it. They can pyramid into their positions. They can capture those outsized gains that offset many, many smaller losses. So we should all get comfortable with the fact that we are not going to have a 100% winning trade record. There will be trades that go against you. And what we do with those trades is what will define what our P&L curve looks like for our portfolios. So with GoNoGo charts, we're going to definitely talk about developing an edge to identify high probabilities where stocks are trending, stocks, currencies, commodities, cryptos, you name it, trending in our favor. But also we're going to use it to manage risk and reward to help our overall portfolio gains. So from here, what I want to turn over to Alex for is the idea that technical analysis can help us separate data-driven decision-making from emotional-driven decision-making. But there's also a problem with technical analysis, and that is analysis paralysis, the abundance of very powerful tools, which when combined in a rules-based checklist can be very powerful. But if they all appear on our charts, we get something that looks like this. We've obscured the price panel. We can't even see what's happening in price action. We've got so many indicator panels below and so many squiggly lines on our chart. It's very difficult to make a decision. So, Professor Cole, let's walk everybody through what a reasonable and responsible approach to trend identification looks like using traditional technical analysis tools.
Absolutely, and I think to your point, we've all seen charts like that. We've all built charts like that, and
guilty.
It across the industry, whatever you're doing within the industry, whether it's sell side, buy side, charts that complicate the decision-making process are a real problem. And we'll go through just a simple process now to see how that can happen. But as we were listening to the presentation before, we were talking about trend following, and we believe that trend identification really arguably is the most important skill that we can develop as technical analysts. And if we can identify those trends, then we can profit on the majority of the move. We're not looking to buy the top or sell the top and buy the bottom. We're looking for that range of price movement where we can get in, profit on that movement, and then hopefully get out with profit. And we like to say that it's simple, but of course not easy. So as you said, how would somebody build a process of sound technical analysis that would allow them to use a weight of the evidence approach to help them with that decision making? And what you might do first is just eyeball a chart to see if price is starting to move in the direction that you want. We know that one of the most basic definitions of trend is higher highs and higher lows. So you'll look at the chart to see if you are seeing a first higher high. You can see here towards the left bottom of the chart, that August low. Where's the first time we see that new higher high? Does that tell us that perhaps we're starting at a trend in the next direction? But we want to automate that, again, as we've been talking all week about making this objective, not subjective, and making it something that we can adhere to without bringing our own opinions to bear or without our own emotional biases. We want to automate this process, and the Donchian channels is perhaps where some people might start. Donchian channels simply look back over a defined period and ask if price is the highest price that it's been during that period, and if it is, then we'll move that line, the green line, will move it higher. Same thing for the lows. If the low of price is the highest it's been in the certain look back, we'll move the red line higher. So now you can see that channel moving as we make higher highs and higher lows. And when we were eyeballing it on the slide before, we were sort of hovering around the sort of mid-September-ish area and asking whether or not that was a new high. And now we're seeing that Donchian channel line move higher there for the first time right into September, and then of course into October. But you're going to go on from there as a technical analyst. You're going to bring in all the other tools that you studied and all of the things that you found valuable when working either with your own investments or with clients, whatever it might be. Simple moving averages. We've seen them on every chart. We joke that they're not really counted as technical analysis anymore because everybody has a simple moving average on their chart. I've even talked to people that said, yeah, I don't use technical analysis. And I'm like, what's that line there? And it's a moving average. So, you know, moving averages are just everywhere in our industry, and we see moving averages on charts for really good reason. If you think about what a moving average tells us, it tells us whether or not the average of prices is moving up or moving down. And so when you compare the current price to that average, you get a sense of whether or not we're in a bullish environment. If price is crossing above a moving average, that tells us that the current price is moving higher than the average of its prices over the length of whatever that moving average is. So here we're looking again at sort of maybe even earlier, a little bit in August, we went above the moving average. Then again, we found support in around that September area and stayed above the moving average. So that tells us that price has started to move higher quicker than the average of its prices. And what do we know? One moving average is good. Two moving averages surely will be better. And of course, we all know about the moving average crossover. And so we can put another moving average on our chart, and we can look at the interaction between the short-term average and the long-term average to give us a sense maybe a smoother sense of how prices are doing relative to the longer term average. And so you can see here in that circle, that's when the shorter moving average crossed above the longer moving average. And again, a little bit before that September mark. And that's when we're sort of saying now, okay, that's another thing we're going to look at to add to the fact that then we see a higher Donchian channel moving higher for the first time. So now we're seeing moving average crosses, we're seeing higher highs in that sort of September, mid-September line. Are we going to start to say that we feel fairly confident that there's a new trend in the upward direction? But we're not going to stop there. We'll add a couple more things to our analysis. Maybe we add Bollinger Bands. Bollinger Bands, I'm sure everybody on the call is familiar with Bollinger Bands. What they're going to do is encapsulate price within 2 standard deviations of the mean. So if you think back, my dad was actually a math professor, and you think back to those classes that we all took, we know that roughly 95% of the data set should be within 2 standard deviations of a mean. Now, that's normally distributed data. Financial data is not normally distributed, but the vast majority of price action will be within those 2 bands. So when price trades up to the top limit and maybe breaks higher than that Bollinger Band, then that is a significant moment. And there's a couple of different ways to read the Bollinger Band, but when we break out of a band, when the bands are narrow, we look to trade in the direction of the break, because that's a significant moment and often the start of a new trend. And again, in that sort of mid-September area, the bands narrowed quite significantly. Price traded up to that top band and then rode the band as it made then that new Donchian channel high, and then of course we made a series of higher highs going forward. What else will somebody look at? We'll look at volume. Volume, perhaps the first confirmatory indicator. We've been talking about volume since the days of Charles Dow, and you want to get a sense of market participation. We like to think of volume as sort of getting a sense of enthusiasm or understanding how the market is participating in a move. And you want to look to see, does volume support? Is the market engaging in what you're seeing in price? And now this is interesting, because in this chart, we had a lot more volume when price was moving down. And then as we're starting to wonder if there's a new trend, volume stays relatively low. And then there's a bigger green bar again now later in September as the price is riding the Bollinger Band. So we're now thinking, okay, perhaps the market is agreeing and buying into what we're seeing in price. And this already is becoming quite a process and quite a checklist. Let's just add one more tile to the bottom panel. Let's put something like the MACD on here, a very, very common indicator that's used, the moving average convergence divergence, and that gives us a sense of trend and momentum in that we're trying to look at the difference between 2 moving averages, and in this case, exponential moving averages, which just means that they move a little quicker, they respond a little quicker to price movements. But with MACD, we know from the textbooks that if MACD crosses its signal to the upside, that could be read as a buy signal, because again, prices in the short term moving higher than prices in the long term. What we also like to look at is when the MACD crosses above 0, right? That means that the difference between those is positive, between the MACD and its signal. So again, looking at this area now, we're sort of saying, where are we lining up all of the things that we value as technical analysts? And somewhere in this blue oval, we've got new Donchian channel highs, we've got price crossing above its moving average, then later finding support at that moving average. We've got a shorter moving average crossing above a longer moving average, and then a little bit later, we've got price riding the upper Bollinger Band as it breaks higher. If we look at the bottom, we had to wait till almost the right side of that blue circle to get volume increasing. And then we look at MACD, and we know that MACD crossed above its 0 line quite early in that blue circle. So all of the things that perhaps we go through our checklist and we say, this is what I would like to see to feel confident in recommending or in identifying a trend in a new direction. All of those things are happening over that sort of 6-week period when we look at this chart.
Now, here's the challenge that Alex and I found teaching technical analysis to institutional fund managers, to trading desk operators, and sell-side research analysts. In this scenario, we're using a responsible approach, just a 6-point little checklist, but there's over a month of trading days between mid-August and mid-September where all of the checklist is met. So if you take this out of just an analytical, artistic exercise, and you think about what it means to control capital using your tools, where in that 1 month time period do you actually make the decision to get involved in this ticker is Raymond James Financial, and it's not a mistake that we're looking at some financials charts. We'll get to that in a second. There's a full month of trading activity where you might still be undecided. Now couple that with the fact that you may have emotional baggage on this security, on this sector group, on equities as a whole, if you've just gone through a major downturn and you've given back profits in these names, right? So now you're bringing more emotional baggage to the decision making. What we also see is that after the trend is established, you have pullbacks. Nothing moves in a straight line. And which of these pullbacks might be your sell signal? Is the trend over right here in early October, right? Assuming you can't see the right side of the chart, as none of us have a crystal ball to predict the future. How do you make decisions once you've gotten in about where that pullback is meaningful trend reverse and reverse to the downside, and where is that simply a healthy pullback within an uptrend? So what we're delivering in today's talk is an idea of blending all of those tried and true technical analysis concepts and tools into a data visualization that simplifies what you are viewing. So as we just went through that checklist, there's several other pieces built into the algorithms behind GoNoGo charts. But what we're looking at right now is the exact same Raymond James Financial daily chart, and there's a lot less decision making going on when you have a chart that codes the trend conditions, blending all of those tools in the background to give you the strength and direction of how that security is moving. So if we just unpack this real quickly, Alex, we've got blue and aqua bars signaling a go trend. Now the name of the charts, go, no go, we're borrowing that from a pass-fail testing system that you might be familiar with in launching rockets or NASA applications. When it is in a go trend, all of the probabilities are on our side. It's a go for launch, the conditions are optimal, we should give this a try. And if it's in a no-go trend for long-only investors, that means that it is not favorable to enter, despite how seductive these relief rallies might be. We've built some sensitivity into the models. So strong form is blue, strong form is purple, weak form is aqua or pink. And then we have these periods of transition. You might have a hard time seeing a couple of these little amber bars. Alex and I are big fans and followers of the life and work of Jesse Livermore, who's famously quoted as having said, in all markets, there's a time to go long, a time to go short, and a time to go fishing. So in about 2 seconds, you should be able to understand that there are go bars, no go bars or candles, and go fish bars or candles that will just help you stay on the right side of those trends. Now, we're really proud of the work that went into this. We've been teaching technical analysis and lots of different concepts and tools, like I said, for about 15 years in lots of different capacities. We're happy to just give that away. So for everybody who is a Metastock user, you can simply apply the GoNoGo trend to your charts for free with that template, GoNoGo trend, right in your Metastock platform. All we would ask in return is shoot us a note. Let us know, how is it impacting your trade decisions? What time frames are you trading? What markets are you trading? You can send us an email, info@gonogocharts.com. So if that's all you take away from today's talk, and you're just simplifying your analytical process to take the tried and true methods of identifying trends and putting that into your charts, then things like Fibonacci extensions and retracements, or if you do other cycles work, or if you have other macro views that you want embedded in your process, at least you have a check on whether you are trading with or against the market. Now, the other component to blending all those tools is that we want to keep price action front and center in everything that we're viewing. After all, it's only price that pays, and that's what's going to be our ultimate determinant of buys or sells. So Mark Abraham is another very successful trend following investor, and I think he said it best. He said, ultimately, It is the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down. And that consensus view is revealed by analyzing price. So the price panel of your chart is the most important technical observation you have. We want to keep that front and center. We don't want to bury it under tons of squiggly lines and additional indicators. All right, Alex, let's talk about a few more GoNoGo examples, and we're going to deal with some multiple time frames. So broadly speaking, U.S. equities, how's the S&P 500 doing these days?
Yeah, it's as simple as this. It's in a go trend. And what's the strength of the go trend? It's a strong go trend. We're seeing those bright blue bars, and we've just seen new highs. And you can see that we had a period of weakness running up to the election, and where the trend wasn't broken, though. It stayed in aqua bars. And then, of course, we gapped higher, and now we're seeing strong blue go bars on the daily chart. We can, sorry, go ahead. Were you going to say something, Tyler?
No. Keep going.
Yeah, and that's as simple as it is when looking at the trend. We know that in the background, enough of the criteria are being met to tell us that we are in a go trend. It's a go for launch in the equity markets in the US at the moment, if you want to put some money to work. But we also are very, very strong believers in the value of multiple time frame analysis, and having the larger time frame picture, and as Charles Dow explained it to us, is always going to help you trade in the direction of the trend.
Absolutely. Charles Dow, about 135 years ago, if you're a reader of the Wall Street Journal, this is the gentleman who got that started. And he was a journalist by profession, also a very accomplished sailor, loved nautical themes, and he described markets, not using any quantitative methodologies, no algos, no computers, no automated charting software as good as Metastock. He simply had ticker tape. But the gentleman had such a visionary way of capturing what was going on in markets. He defined, and what later became the Dow theory, one of the central tenets of that was that markets move across multiple time frames. So Charles Dow explained the primary trend of markets, like the tides of the ocean, is unflappable. It's very, very consistent over longer time periods. And that is what is driven by expanding GDP and the underlying fundamentals of the companies that we're owning. It doesn't fluctuate day to day. It's the broad underlying drift of the market. So when you look at very long-term charts, you can get a sense of what the overwhelming trend or direction of markets are. He also talked about the secondary period of trend, which he compared to the waves of the ocean, and that waves come in at high tide and waves also come in at low tide. So if, as technical analysts, understanding what the primary direction of markets are and the fact that it can get overdone or in either direction, right? Markets can become despondent or they can become euphoric at the end of bull markets. We can use that to our advantage, because the overall trend will mean revert to that primary line, even when the secondary period is below or above what is the underlying trend. Then he defined it, the minor period, or that tertiary time frame, as the ripples on the surface of the water. Very small moves in magnitude of price and percentage, but that those are the day-to-day fluctuations based on market participants' interpretation, the news of the day, their emotional decisions. It's not going to broadly impact that primary trend, but just like the secondary period, it'll move above and below the secondary trend of the market. This is where faster traders, intraday, swing traders and scalpers can really make their systems shine based on that smallest minor period. What we would argue to you today is that you should use a mosaic approach, looking at whatever vehicles you are trading across multiple timeframes. Now, the time frame of your trading environment is very personal to you. It has to do with where you are comfortable trading. And if that's intraday, great. If that's a long-term investor and you might rebalance portfolios monthly or quarterly, great. You can still use technical analysis to your advantage, because these observable human behaviors are ready on all charts. So let's go back to that S&P 500 chart, Alex, and let's talk about it on a weekly time frame rather than the daily chart we were just looking at.
Yeah, and so the weekly time frame, I think in the previous sessions, here was talking about how long these trends can last, and you can see that we've been in a go trend since Q1 2023. We had that no-go move that took us through, most of 2022, and then when we entered the sort of Q1 of 2023, we found that go trend. We had a correction that showed us some weakness, but never painted any more no-go bars, and then we've really been in a go trend since, with a few periods of weaker aqua colors. But if you look at where we are right now, we are at new highs and we are painting strong blue go bars. Now, again, like you said earlier, we're not going to move in a straight line. So we'll see any weakness displayed on the chart on a weekly basis with some aqua bars if they come in. But we've been in a go trend for US equities since Q1 2023. So we're in Q4 of 2024. That's a relatively long period of time where we could have been looking to sensibly enter equity markets.
And so if you're a long-term investor, weekly charts might be your execution time frame. If you have a weekly trend that has shown such weakness, it's reverted to a no-go trend, that would be your exit signal. But how wonderful to not get whipsawed in and out of markets if the underlying primary trend is still in your favor. Now, similarly, in 2022, when we were in that very difficult but fair and orderly bear market, look at these relief rallies. I certainly was rooting for the U.S. stock market. I wanted to get back in and capture some of those early budding shoots of the new bull market. That's a pretty sharp relief rally and certainly caught a lot of investors' attention. A lot of folks got in before another leg down. That is the other side of trend following, is that it's guilty until proven innocent in a bear market, and it's innocent until proven guilty in a bull market. And if you go back to thinking about that expectancy formula chart that we looked at right at the very beginning of today's talk, if you can simply stick with the meat of the move, that's going to improve your returns. You're going to have a lot less turnover in your account, and frankly, some peace of mind that you have a simple way of identifying where that primary trend is. Now, Alex, we've talked about weekly and daily charts. What about for the intraday traders? What if we wanted to move with the market in a simply 1 hour or a 60-minute chart?
Yeah, I mean, and not just intraday traders, but think about your position in the markets. Think about a portfolio manager sending an order to his trader, right? You're going to look for the best entry and the most sensible point to enter. So if you're stacking the time frames as well as the indicators in your favor, we know from looking at the chart that the long-term time frame is a go, the daily time frame is a go. So perhaps as either an intraday trader or somebody looking to enter a position, we certainly would want to look for go indications on a smaller time frame. So if we're in a no-go on the 60-minute, maybe that's not the time to enter. Like right now, we've just seen as of creation of this chart a couple of hours ago, we just saw a change to a no-go trend. So we saw the go trend, we picked it up right before that gap, which was great, and then we saw that move on the 60-minute bars. But if you're looking to be long because of the larger time frames, right now with no-go bars, perhaps not the best time to do it.
Well said. All right, moving right along, we know that not everybody on today's call is an equity-only investor. And looking at that bear market environment of 2022, my good friend Alex here likes to say, hey, it's 5 o'clock somewhere. There's a trend somewhere. And if you're going to waste all of your clients' time and your own investment capital in a market that is trending lower, you're missing out on the markets that are trending higher during that same time. A lot of these cross-asset relationships are anti-correlated, meaning they move in opposite. So let's talk a little bit about using GoNoGo charts across all the asset classes. We're both big fans, students of the great John Murphy, who published Intermarket Analysis 40 years ago, and he's a widely cited author throughout the CMT curriculum, as well as folks like Marcos Katsanos and others who've helped to quantify those correlations between and across the asset classes. Now, with just a simple multi-chart layout, you could look at the trend across multiple asset classes. Alex, why don't we do a quick round robin of where we're at around the board?
Yeah, and especially with the ease of investing in ETFs and the way we can be exposed to these different asset classes. I mean, right now, we just talked about it, strong go in US equities. You move over to look at treasury bond prices. Now, those are not rates. Obviously, rates and prices of bonds will move in opposite directions, but treasury bond prices falling in a strong no-go. You move across to the dollar. We know that the dollar, oil first. We know the oil's been choppy, but it's back in a no-go and strong purple bars. I think on the bottom left of this screen, we've got Bitcoin. And Bitcoin has had a really nice run. So Bitcoin, strong go bars, and again at new highs. So the Bitcoin trend has been back for a couple of months, and we saw that go trend with mostly strong blue bars for the last couple of months. Gold in the middle panel. Gold has been a great performer for so many people since sort of the early summer of this year. We saw the go trend on a daily basis really take off. We know the larger context of gold. We talked about it. It's so much decade-long patterns of potential strength in gold, and we really saw it take off this year for the summer and into the last couple of days. But now in a no-go for gold. And then the dollar, of course, the dollar came out of its no-go at the end of September and has been in a go trend, making higher highs and higher lows since. And we're on strong go bars. So we know really quickly, moving around the asset classes, where the trends are, where we should be invested. We should have moved out of gold. We should be in US equities. The dollar looks strong. Cryptocurrencies. And it's sort of that simple from taking that multi-chart view that, of course, you can set up fairly easily on Metastock.
Yeah, preparing for today's talk, just looking at what we had presented in September, this relationship between gold and the US dollar was absolutely reversed. Gold trending higher in strong go bars, the dollar trending lower in strong no-go bars. And we've seen that relationship completely change as dollar strength has taken over and gold is tapering off. I also wanted to just pause and mention that that you used the phrase, the trend in Bitcoin the last couple of months. And if you are a heavy consumer of news, you've probably only been hearing a lot about Bitcoin in the last couple weeks, maybe even just the last week since the election. And so the idea of trend following, being involved in something that is moving higher, typically when a trend is in your favor, more people become aware of it. You add volume to the trend higher, you add participation, there's money flow into that asset class or that security, and that accelerates the trend. This is what gives length to trending environments and markets. So I love that you were talking about the go trend in Bitcoin from 2 months ago, Alex. Most folks weren't talking about that.
Yeah.
All right. Congratulations, everybody. We are a little past the 50-yard line. We've talked a little bit about trend following tenets and about having a really simplified data visualization method to guide your trading. If that's all you take away from today's presentation, fantastic. Shoot us an email, info@GoNoGoCharts.com. Let us know how that's working out. But in our final 20 minutes together, we'd really like to talk about sort of the next steps that Alex and I take in all of our analytics work and with our institutional clients. So the complete solution from GoNoGo Charts, also available in Metastock, involves not just the GoNoGo trend methodology, but using the same concepts for volume, volatility, and momentum. And Alex, let's breeze through this section. Hopefully some of the folks online are familiar with GoNoGo Charts. We're going to focus on this bottom panel of the complete GoNoGo chart here for the next few minutes. Talk to us about momentum.
Yeah, momentum is going to be the next place you go as a technical analyst. I think trend identification first and then momentum next, because it helps you understand the strength of the price movements that you're looking at. So it measures the rate of change of price, and I always like to teach it talking about cars, because I'm from the UK and it's a real car culture, and I think you must have sent me this picture because these are not British cars. But if you think about acceleration, that's how we kind of like to think about momentum. And when you're driving a car, even our normal cars, you are going to increase your speed at a certain rate. And we talk about pulling onto a highway. When I drive on the on-ramp to a highway, I'm going to start off at a slow speed, and then I'm going to increase my speed quickly so that I can get up to highway speeds without causing any danger by being the slow guy in the fast lane or anything like that. So as I start to increase my speed to get up to highway speeds, I'm going to increase my speed probably pretty consistently, go to 10 to 20 to 30 to 40, you know, as quickly as I can. But as I get closer to trying to pull onto the highway, I'm not going to keep getting faster as quickly. I'm probably going to keep getting faster, but a little more slowly. So I might go from 40 to 45, 45 to 48, 48 to 50, right? And then I pull onto the highway. So I am still getting faster, but I'm getting faster more slowly. And that's a concept that we're going to look for when we talk about momentum, because when momentum is making new highs with price, that's confirmation. That's my car accelerating quickly to get onto the highway. But when I'm still increasing speed, but less quickly, that's when we see perhaps a lower high in momentum or momentum divergence from what we're seeing in price. And if you go back to the car analogy, if you think about it, when I hit that highway speed, what's going to happen? Am I going to continue to keep increasing my speed? Well, hopefully not, right? I'm a responsible driver and I don't want to get a ticket. So the most likely thing is either I flatten out and then eventually perhaps I take an exit. So when we see momentum divergence from price, that's often a sign that there is some exhaustion to what we're seeing in the price movement. So if you keep that in mind as we talk about momentum, hopefully that will be clear. What we then do, though, is we want to take the most valuable momentum ideas and momentum tools and use them in our analysis, right? So we've got on here, we talked about the Bollinger Bands briefly already, but we've got things like Chaikin money flow, we've got the DMI indicator, we've got RSI. You can put stochastics. There's all kinds of really good momentum tools that we can add to our chart. But if we think about adding 4 or 5 momentum ideas to the trend identification chart that we had at the beginning, we've now gone from 6 to 11 or 12 ideas on that chart. And you can imagine how crowded it would be. And then if you think back to our problem chart at the very beginning, that's when price gets super small and it becomes very hard to see important levels and important things happening on the chart. So,
quick note, Alex. For anybody who's using GoNoGo charts on Metastock, there is a 6-part educational series. One of the sessions is all about momentum indicators. So just as we built that trend following checklist in today's presentation, we do the same thing and walk through each one of those momentum indicators, how they're calculated, what they mean. So if you're interested in that, check in with the Metastock folks and get access to that 6-part educational series. All right,
absolutely.
Keep going.
Yeah, and having said all that, though, we still want the information that we can get from those indicators. So we want to see areas of overbought and oversold, right? We want to see areas of divergence. These are very, very important momentum concepts. So we've taken the same approach to momentum that we took to trend, in that we've taken some of the most foundational and tested and time-used momentum ideas and blended them into just one oscillator that gives us the traditional use of momentum. So very quickly, we can see where those areas of overbought and oversold are. We can see how they line up with the intermediate highs and lows in the chart. The peaks and troughs will line up with a overbought, oversold level on the oscillator. Our oscillator goes from a value of +6 to -6. It's bounded, so it's very simple to read and simple to understand. And we also can get divergence. So in this example here, we're seeing a lower high in price and a higher low in the oscillator. So the one on the right, the second example, was what I think we were zoomed in on. You're seeing lower price high, lower low in price, higher low in the oscillator, common divergence. On the left side, we're seeing that higher high in price and the lower high in momentum. So now we're seeing bearish divergence. And so we can still get the important information out of our traditional momentum analysis using just the one that has all of those blended inputs. And then the last thing to point out here on this chart is that lower ribbon is our way of incorporating volume. So volume, as we mentioned at the beginning, important to use, important to give you a sense of participation. So when the ribbon appears, when you see that blue, that dark blue, that tells us that volume is heavier than its average, so heavier than usual volume. So you can then look, okay, on this new high, let's say on the left, on this new high, but a lower high in momentum, are we seeing high volume or not much volume on that high? As we roll over, do we see volume increase? All of those volume ideas can come into play as well without adding another distraction to the chart. But then the most important piece of this, Tyler, I'm sure you're going to talk about it, is how we use our oscillator to give us a little bit more value and hopefully something unique, which is an objective understanding of how to use the oscillator in trending situations.
So as Alex described, the GoNoGo oscillator moves from +6 down to -6, a range-bound momentum tool. And I first learned momentum from Ralph Acampora in the first few weeks of being on the job at CMT Association. Alex is a car guy from the UK. Ralph is a baseball guy from the Bronx. Same kind of idea. But he explained momentum as, Tyler, imagine you have a baseball in your glove. And if you're going to go throw that ball, it's moving fastest the minute it leaves your hand, right? The acceleration is fastest right when you throw the ball. And you throw it way high up in the air, it's going to reach that apex, the highest point that it'll travel, and it's still going up, but up more slowly. And then it's going to come back down, and potentially, in the game of catch, unless you're playing with me, Butterfingers McGee, somebody's going to catch the ball, and you toss it again. So there's some fantastic work that has been conducted by Connie Brown and others around using momentum indicators within a trending environment. So the oscillator doesn't necessarily range from +6 all the way to -6 momentum. In a trending environment, it might move from +6 down to a neutral level, right? The game of catch continues. The ball didn't hit the floor, it came to our glove and went up again. So the way that we have calculated the GoNoGo oscillator, there is an objective neutral level. All of those momentum oscillators blended in the background, when they're in their neutral territory collectively, we're going to be on this 0 line. And I want to just point out these moments where in a trending security, which is what we're seeing in the price trend, we're in a go trend, momentum is positive to an extreme, overbought, and it comes down and it tests the 0 line before surging positive again. This might be one of the most important parts for trend following investors. It's the idea that a momentum resurgence in the direction of the underlying trend is your dual confirmation of what you're looking for to stick with the trend. And in 2021, Alex and I observed as so many YouTubers and trading gurus and get rich quick schemers were shouting to their crowds, just BTFD, buy the dip. It's no problem. And anytime price corrects, you should just put more in. Well, that's extremely irresponsible. That is not risk management, and that you'll never hear Alex and I talk about that. However, there are times when buying on pullbacks makes a ton of sense. You want to be objective and be able to quantify when those times are. In GoNoGo charts, those times are when momentum pulls back to 0, but finds support at neutral and takes off again in the direction of the trend. That is a healthy pullback within an otherwise well-defined uptrend, and something that we can use to our advantage to buy that resurgence of momentum where it hits the 0 line. Now, Alex, because we love data visualization, those moments, we want to call them out right in the price panel. Talk to us a little bit about GoNoGo icons.
Yeah, and going back to that quote, the second quote we talked about, where price is the most important thing you can look at. So we want to keep our eyes focused on that price panel as much as possible. That's why we've blended everything into the color, so we don't have to deal with the distractions of too many things on there. So we have two types of icons. One is using momentum in its traditional sense. So finding those areas of overbought and oversold, and then watching as that momentum comes back towards its neutral territory. So that's that idea of prices surged and then it's come back. So we want to look for those temporary exhaustion points, and those are the arrows. If you just click again, I went in the wrong order there, so apologies guys, but that's that counter trend correction icon, are the arrows. That tells us that momentum has surged and fallen back towards neutral levels. And those are the traditional ways of using momentum to understand that in the short term, prices may struggle to go higher. Perhaps that's somewhere to take profit. Perhaps for you, that's what you're looking to do. But it doesn't tell us the trend has changed. Until those colors change, the trend remains in place. The other type of icon, which is probably the most important for us, is what we were just talking about, which is when that game of catch continues. And that's because we're seeing momentum find support at our objective zero level and then surge back in the direction of the trend. And so those are our trend continuation icons. And in a Go trend, they'll be green, telling us that really we have low risk opportunities to participate in the trend that's in place, because we're getting that momentum resurgence back in the direction of the trend. And I think we have an example of it on the other side. So this colors didn't come out quite here as well as perhaps I'd like, but you can see here we have momentum resurgence in the direction of the no-go trend, and that's going to be the red circle instead of the green circle. So coming up to the zero line from below and then finding resistance at that level. So that objective level of the zero line can be used in both directions, a go or a no-go trend.
And that traditional use of momentum, right, when it's leaving an overbought or oversold, is still a helpful tool, even for trend following investors. If you're looking for a logical spot, short term, price may struggle to move further in the direction that it is headed. That may be a time to lighten up your position and looking at other opportunities if you needed to liquidate some capital to move that around. That's a logical point. It doesn't mean trend has come to an end. All right, the last and final, most important part of the whole mosaic approach is understanding volatility. If anybody watched Squid Games a few years ago, you know that games of tug of war can sometimes end pretty dramatically. In markets, the same can be true when you have a crowded trade, when there's indecision, there's a tug of war between buyers and sellers. A couple things are going to happen. Let's just walk through this chart from left to right, understanding the behavior of the market. Here we're seeing the range of price action start to narrow, right? So the trading range of how far it can move becomes very, very narrow. We see momentum has completely stopped. We're at neutral and we get stuck there. That is a go-no-go squeeze. If you're familiar with Bollinger Bands and Keltner channels, the same idea exists, which is that from volatility compression, you will have volatility expansion. Now, go-no-go squeeze is built right in the momentum panel so that we're not adding more to our chart. We build this amber grid as the momentum retains its neutral zero level. It gets stuck riding the zero level. This can happen in times of trend reversal, as in the chart that we're looking at right now, or trend continuation. But the important lesson, whether you're looking at a Bollinger Band squeeze or a Keltner channel or a go-no-go squeeze, it's the idea that the direction of the break is your signal for what could be a high velocity move to follow. So when the go-no-go squeeze, go-no-go oscillator is negative, comes up to zero, retest, we got a trend continuation icon to the downside. For those of you who trade to the short side, you can absolutely capture trends to the short side, trading no-goes. Comes back up to zero and gets stuck there. Now, all else being equal, this is a no-go trend, momentum has been negative and it got stuck at zero. We'd expect it'll be rejected. That'll be a resistance area for momentum. When it breaks through to the upside, that's our signal of trend reversal to follow. And so using these tools in concert, using them together is the rules-based approach that we would advocate for all of you. So we're paying attention to the direction of the break. All right, Alex, we've got a couple of live examples that we wanted to get to. The whole idea of a rules-based system is to keep your methodology fairly straightforward, fairly simple. So there's only 3 questions we got to answer, right, Alex?
That's right. What's the trend? Where's the oscillator? And is there anything interesting happening at the zero line? I mean, that really encompasses everything that we look for. And we can run through the next one. Is just an example of the S&P, but using the complete chart now. So now we're looking at the S&P. We can shout it out. What's the trend? The trend is a strong blue go. Where's the oscillator? It's at a value of 2, which is positive. So confirming the trend at the moment. And is there anything important happening at the zero line? Not currently, but recently we broke through the zero line back into positive territory after that trend weakness, and volume, of course, has been picked up, meaning that we've got market participation. And I did want to just quickly, I know we have 1 minute, if maybe we skip the weekly version of that, just to talk about just the implementation on Metastock real quick, because we have done a lot of work with the team, and it's fantastic because we have expert commentary which tells the user exactly what's happening from a GoNo perspective on any bar, on any chart, which is really like having us there with you. And then the
Not in a
thing,
creepy way though.
No.
We'll be looking over your shoulder, but not in a bad way.
And then the second thing, of course, are explorations, right? The ability to scan through the massive universe. I mean, every presenter's talked about this, but the ability to use Metastock's explorations to find securities, to narrow your focus and to save you time. And we do that, of course, with GoNoGo criteria. So you can find all the new goes on the S&P, all the trend continuations on a certain stock index. You can find max squeezes, looking for those breakouts. You can find all of the different criteria for the GoNoGo charts using Metastock's exploration. So I just wanted to make sure we got that in there.
Absolutely. Super important and time saving. We know that not everybody can spend 9 hours a day staring at markets and doing analysis. That screening and scanning is really powerful, particularly if you know the type of trader that you are. So if you're really comfortable in the options market and looking for those trades to the short side, right now in a raging bull market in US equities, that might not be the most favorable environment, but there are markets trending lower, like fixed income, treasury bonds, for example.
Yep.
All right, let's do a couple more live charts, Alex. We've talked a lot at other conferences and in our weekly research and daily notes about the rotation. We're seeing financials and consumer discretionary, as well as some green shoots in the industrials segment, really leading this market higher. There's a lot of rotation and breadth expansion throughout the U.S. equities market. It's going to fuel bull market trends, at least for the time being. Do you want to talk through a couple of these charts as we wrap up here?
Yeah, and this is not a financials chart. This is Raytheon Technologies, and you can see that we are now, we had a nice go run. Now we're in a no-go. Just to run through it in terms of how we would look at it with those three questions. What's the trend? We're in a no-go, having gone through a few amber go fish bars of uncertainty. Where's the oscillator? The oscillator is at a value of -1. And is there anything interesting happening around the zero line? Yes, we've just retested that level from below. So you can see where the oscillator broke into negative territory. We've come back up, retested it, and we've been rejected at that level. So now we've got a fresh purple no-go bar, momentum surging in the direction of that no-go trend. And you see some heavy volume as well. So oscillator value is supposed to say -1 there. But then this is CF. CF totally different. We've had a strong go trend. We experienced a period of correction, but now we've got fresh new go bars. And if you look at the bottom panel, we've seen a max go no go squeeze formed that is just being broken into positive territory. So again, 1, 2, 3. What's the trend? We are in a new go trend, but slightly weaker, painting an aqua bar. Where's the oscillator? Well, it's just coming off zero into positive territory. Anything interesting? Yes, we've broken out of a max go-no-go squeeze on heavy volume as well. You can see that blue ribbon. So this would be something where we would say, let's see if this gives price the push it needs to make an attack on that prior high from early October, right? We've got new trend, we've got momentum, we've got volume. And then the last one, the opposite direction, no-go trend in place. Pink no-go bars, so we're seeing some weakness. You talked about relief rallies. Perhaps this is one of them. After a new lower low, we've made a new higher low. A lower high, apologize. And the oscillator is testing the zero line from below. And you can see how it was doing this before, broke out of a max squeeze into negative territory. So we're going to watch to see if the same thing happens again. If it does, we'd look for another leg down.
Absolutely. Well, Jeff, Kelly, the whole team at Metastock, thank you very much for having us back again. We're really enjoying talking with you and all the Metastock users. Happy to take any questions if there are any.
Yeah, let's go quick. There's a couple. Do you folks have a preferred look back period for trend following? Turtles use 20-day breakouts and 55-day breakouts. So is there?
Yeah, with the turtles, with the Donchian channels, that was sort of their primary entry technique, using the Donchian channels. Ours, as we said, is a combination of a lot of different principles of technical analysis that combine together to paint the bars. So if you think about the kind of things that might be in there, it might be different periods of moving averages, it might be different lengths. So we try to incorporate some longer, some shorter to give that composite effect of what's trending.
And from a long-term investor perspective, all the research shows top decile momentum winners over a 12-month look back tend to be the outperformers in the year ahead. At the 3-year mark, you start to see more mean reversion. So technology, for example, as a sector group, has been a strong momentum leader for quite some time. We might start to see that rotation into other areas of the market.
Does this work with futures, Bitcoin, and how about international markets? I thought I'd bundle a couple questions into one question right there.
I love it.
Anything with the data, anything with the historical data, anything that you create a chart with, you can apply the GoNoGo templates to.
Has to be a liquid, unmanipulated market to get proper returns. So yes, absolutely, futures, currencies, crypto, all of the above. There are certain emerging market, very small equities markets that might be tough because you just don't have the liquidity there.
All right. Thank you very much, guys. We do have a question on how to get it. I'm going to answer that one though. So before I let you guys go, thanks for being with us. Tyler, we'll see you in just a couple sessions.
That sounds great. Thanks so much, Jeff. Thanks, everybody. See you soon. Bye-bye.
Very cool. Let me go ahead and do this. I'll turn my camera on. And we'll go ahead and make me the presenter real quick. And we'll go ahead and make sure we're showing the right screen. They do a really good job of talking and making sure that everything's talked about. GoNoGo, you get the trend, the oscillator, icons, the squeeze, those are all included as part of the package. If you haven't played with the free template that's included in Metastock, you should take a look at it. But I really recommend you take a look at this. It really kind of does a really good job of breaking this down and simplifying it and making it a decision process for you, which is really what you need, right? So it, as part of the add-on, it includes crystal clear explanations, as Tyler showed, GoNoGo trend identification on charts, scans, all that kind of stuff. Normally, it's $149 per month, and that's how you pay for it. But if you buy 1 month, you'll get the second and the third month for free. And we're doing that as part of the conference promotion. We'll throw in a trial to Metastock with that if you want to give Metastock a go. You can do that by giving us a call at 800-882-3040. metastock.com/sales-chat or metastock.com/conf-promo. So great add-on, give it a go. Before we go on to the next speaker, hello, Marina. I can't quite hear you yet, but you can put on your mic.
Can you hear me now?
Yeah, I'm gonna have you help me with a question. Nick says thanks for you're welcome. Ask questions if you have them. We'll try and get answers for you. I do want to say thank you to AAII. Are you familiar with American Association of Individual Investors, Marina?
No, I actually haven't.
Oh, okay. Well, they're a nonprofit. They started in 1970 something. They're known for the AAII investment surveys. They do market reports, newsletters. Great sponsor, AAII.com, if you're interested in that. Marina, would you like to help me give away a prize since you're already here?
I would love to.
Okay.
What are we giving away?
We've got the Steve Bigelow. We've got a kind of a book package of his. Candle Profit,
great.
Eliminating Emotions. The High Profit Candlestick Patterns. And then we have a mouse pad that lists the major candlestick patterns on here. So we're going to give away this to a lucky winner, and we're going to see who you make lucky. As we kind of go into this, if you're watching us on YouTube and you haven't registered yet, there's a pin comment. It'll take you to metastock.com/tradersconference. Go ahead and register, and that way you can be part of the prize drawing. What I need for you, I do want to say, as I'm kind of getting over here, we miss Steve Bigelow. He was a big partner of Metastock. Great guy. I learned a lot about trading from Steve, and we miss him. Anyway.
Well, his legacy is continuing with you guys giving his books. His gifts.
Yeah. Let's see. What I need from you, Marina, is a number between 1 and 10,513.
Oh my goodness. Let's go with 55555. what is that, 55,500? No, that's too much, right? 5,555.
Okay. Is there a reason you like fives?
No clue why, but somehow it's my favorite number forever.
Okay, there you go. Good enough. Let's see. The winner is a Claudia M in the USA. Claudio M in the USA. And I think I even have a state here. We don't like to fully dox. I don't know where the state is. It's over on the edge of the spreadsheet. We don't like to fully dox people on the internet, so we just go off with the first name. So Claudio, I will reach out to you next week to help to kind of make sure I have a good address for you and send that off to you. And then I will personally deliver it to the post office myself.
That's at his house.
Our next presenter is going to talk a lot about, I don't know which direction you're going to be for me, probably below or above. Our next presenter is Marina, the trader chick. She does a really good job. She helps people learn how to day trade. And I don't know, how many of these have you done now? It seems like a few, like a number.
I've lost count.
Okay.
Time is flying so fast, and I've lost count.
Yeah. Well, we love having you here. Let me go ahead and get you the screen share. I know we're running a little bit late in terms of that. Don't worry about time so much. Somebody will catch us up. All right.
It's all good.
Or we'll
all
go
right,
on.
hang on. There we go.
All right. I can see that. I'm going to get out of the way. It's your turn. Go.
Can you just give me the access to questions, please?
For sure. Let's see. Let me do this. Just remember not to shut the whole event down when we are done. Are you there?
Hang on. All right, cool. So now I have access to the chat box. I love you guys asking questions, and I will definitely answer every single one. Maybe not in the moment, but I will definitely answer all of them. So let me just here. You guys are able to see my chart, my screen, right?
Yes, ma'am.
Okay. Well, thank you again for having me. I really enjoy these presentations. I find them to be some of the best ones for sure. And just hanging out with Jeff and Greg. So thank you guys for having me here again. I love it. So I actually have a funny confession to make. I literally just moved into our brand new apartment yesterday. So it has just been total chaos. I don't even have internet. What I am using is my phone, what is it, hotspot? I don't know. I live in Barcelona, so they're called datos here. So just in case if we start to kind of lose one another, that's the reason why. We're going to get our internet tomorrow. It's been pretty good as far as my hotspot, but just so you guys are, aware. And I was gonna actually find excuses not to join because it's a very last minute move, but I'm like, you know what? I got my chair, I got my table, I got my hotspot, and I'm gonna be here because I really love hanging out with you guys. So I am gonna just hop right in, and I do want to say something really important. You guys have taken this time to join our presentations, right? So even though I definitely want to be able to teach you something, I always tell my kids, if you learn one thing, if you get one thing out of everything, you come out a winner. So the goal is if you could take away one thing and implement what I'm teaching you literally today or tomorrow or whenever, that means this was successful on my part. But to make it even more successful, I find that being interactive is how we really learn. So please, like I said before, ask questions, don't be a spectator, get out there. Every question is somehow important. And if you feel if you have it, I can guarantee that other people have it just as well. All right, so we're gonna hop in. I'm trying to figure out, yeah, I keep on seeing my face. I'd rather look at the screen. So I think you guys are still seeing me as well. So today we are going to talk about 4 steps to simplifying your day trading and to dominate under any market condition. At the moment, the market is going pretty well. And when the market's going well, everybody is, all confident and they think that they're doing great. But the reality is you want to be able to learn a very specific strategy so that it doesn't matter what the market is doing for you to be able to work with it. Even if it's a bear market, a bull market, a flat market, it doesn't matter. If you understand what the market is doing, you can literally dominate it. No joke. So I am Marina, the trader chick. Like I mentioned before, I live in Barcelona. I've been an expat for over 22 years at this point. It's absolutely insane. We moved to Barcelona 2 years ago, but yesterday we moved into our new apartment. It's amazing. I don't know if anybody's been to Barcelona, but we are now literally on the beach. I wake up to the sunrise. It's incredible. Very happy. And before I was a day trader, I was a fitness instructor and also a travel writer. So the main reason I bring this up is, one, a lot of people think that you have to have some sort of a background to be a day trader, right? Like engineering, finance, economics, math. I was literally a fitness instructor. I don't know anything about math. You do not need to. That's the beauty of day trading. And I still do have a travel site. It was actually my very first business online. It was a travel site. And the main reason is that travel for me and my family is not a luxury. It's a necessity. We traveled 3 to 4 months out of the year. So day trading is an amazing way of being able to do that, right? It's part of a lifestyle. So that is something that I really want you guys to understand about day trading. And I speak 3 languages, not because it's of much relevance to who I am as a human, as far as the relevance is when I learned Spanish. I was a refugee from the Soviet Union. When I was young, I learned English kind of when I was still learning how to speak. So I spoke Russian, English, but I learned Spanish in my later years. So before moving to Barcelona, we lived in Guatemala for 14 years, in Costa Rica. So I've been in Spanish-speaking countries for many years, but I didn't speak Spanish. And when I learned Spanish in my late 20s, there's a process, right? I'm sure that whoever's sitting here and who has been studying a second language or is bilingual, trilingual, but learned in later years, it's a process, right? You have to commit, you are very disciplined, you have to practice, there's all these things going on, right? And as a new speaker and learning a new language, you would never in a million years walk up to a group of 5, 10 people who speak, let's pretend I'm just learning how to speak Spanish. I would never go into a group of 10 people and pretend that I'm going to understand what they're saying. It's absolutely impossible, right? I'm barely even saying, hola, mi nombre es Marina. So I find that the majority of people, when they begin to trade or enter the financial markets, they're literally entering a group of people speaking a completely new language, and they're trying to, I don't even know, understand or catch up, but in the meantime, they're throwing money at the market, right? So it's absolutely ludicrous to me. So you need to step back and just learn the language. And the other thing that I did find out when I was starting to learn how to trade was that the market actually speaks to us. It has its own language. And when I started to look at it as learning a new language, everything changed for me. And I hope that you guys could maybe do that shift and understand that the market is a language, and you would never enter a room of people who speak a totally different language from you and try to enter that language without learning a little bit first. It needs to be the same way when you're doing for the trading or any financial markets, right? And the beautiful part about trading, you could do it from anywhere. Like I said, for us, trading, traveling, it is a non-negotiable. So I need to be able to take my computer with me wherever I go, and I can. That's the amazing part about it. Before the pandemic, I know the pandemic was quite a while ago, but at this point, I used to be live all the time. Like I used to travel quite a lot. I'm really enjoying a lot more being in person virtually with you guys, because I feel like there's just so many more opportunities for people from all over the world to join as well. So before I hop in to the presentation, I made you the entire presentation for free, so you could take it. And then I know that Jeff always sends replays, and you could go on YouTube, so you can go back and go at your own pace, because we do have a time limit, right? So it's important to be able to do that. So please go and get it. makingofadaytrader.com. makingofadaytrader.com. Go, you'll get the whole presentation for free, and then you can follow along, and then you could go and use it when you're doing the replay as well. Makingofadaytrader.com, put that in your browser, and you're going to be able to get it. So let's begin. Just like learning a new language, you start with the basics, right? And the majority of the time, especially in the financial markets, people don't ever begin with the basics. I don't know why. We are not born with this information, right? We need to learn this information. And what I have found is that people kind of like jump through it and start to literally put their live money into the market without learning the basics, right? Without learning what is a buy, what is a sell, what is a long, what is a short, what is divergence, like these super basic things that literally make all the difference in the world. And this is what we need to get back to, and that is what we are going to do today. Before you do anything, get on MetaStocks right now. Get on the platform. You guys cannot drive in a Formula One race when you have a rinky-dink, a little mini, go-kart, right? It's the same thing here. So MetaStocks is one of the best, really powerfully, there's just so many features to it. You need to have a really good platform. If you're going to be doing anything at all, that is what you need to get number one. All right. Then indicators, and usually MetaStock has great universal indicators, so you don't have to really go out and get others. However, you can if you do want, and they can work with you as well on that. So now that you have your platforms, let's begin. We are going to be talking about the market movement and the breakdown of a trend. So we technically and logistically all know that there are three trends, right? There's the upward trend, the downward trend, but honestly, to me, the most important trend of all is the sideways trend. Why is that? Why is the sideways trend the most important one of all? Because this is where the majority of our money gets lost. Okay, this is where the majority of the money is lost. Why is that? Why is it the place that the majority of our money gets lost? It's because it's flat. There's no momentum. It is the indecision zone. This is an area where nothing really goes on, and people are putting in money thinking that they're gonna either predict what the market is saying or beat the market, right? We can never do that. We can never do that, right? We can never do that because we have no idea where the market will ever do, but we can understand it. So let's break down these trends, because I'm going to be really focusing on the sideways trend because that's the place where we lose the most amount of money. But once we are able to be able to identify it and focus on it, that's when we could also make the most amount of money. So we have to shift that around, and we can very easily do that. First and foremost, what is an uptrend? I'm just going to go through these really fast because a lot of times we don't even know like the basics. An upward trend is literally when each pivot is higher than the next. It is the bull market. It is the market trending up. It's the market going up. It is where you enter a long. This is where you are buying, right? You are entering a long position. You are buying. So what does that mean? It doesn't matter if there's buyers and sellers. Who cares? We don't know who they are. We don't care about them. All we need to know is that we are entering at a low price point, exiting at a high price point because our technical analysis tells us, and we're taking the profit in between. That's it. We're going long. We are buying. That's all there is that you need to know, right? You're entering low, exiting high, taking the profit in between. Going down, downward trend. What is a downward trend? It is literally the opposite. It is every pivot is lower than the other. Okay, this is where you are selling. This is when you are shorting the market. This is when you are entering high, exiting low, and you're taking that profit in between. As day traders, this is usually where we end up making the most amount of money, by the way. So short, you are entering high, exiting low, you are shorting the market, you are selling. All right, this is the bear market, the market going down. Now, let's really dive into where the majority of our money gets lost. I personally call these areas a trader's worst enemy, and we need to learn how to avoid them and spot them. Okay, what are these areas? This is the consolidation area. This is the transition area. This is the exhaustion pattern. This is the chop. This is the indecision. I don't care what you call it. It's all the same thing. What it is in between. It is bouncing back and forth in between two areas. It's going nowhere. When you are looking at a market like this, you have no idea where it's going to go, right? So what is the most important thing of all? You stay out. This is when we stay out of the market, because the market is literally screaming at us and saying, don't answer. I have no idea where I'm going. I have no idea what I'm going to be doing. Do not enter the market. All right. So the thing is with retail traders and individual traders like us is that we forget that there are actually three super important positions that we do. One, we look to see where to get in. Two, we look to see when to get out. But the most important, and I think the one that no one ever talks about, is that we need to know when to stay out altogether, right? Like when to sit out and literally on our hands. What happens a lot of times is when people see this kind of movement, this kind of behavior, I guess you could say, is that, oh, sorry, Tom, I see. So you know what? Can you just put in HTTPS:// that could be the difference. Google has all these different updates, and that could be it. So when you're putting in makingofadaytrader.com, put in HTTPS:// All right, thank you for letting me know that. All right, guys. So again, let's focus right here on the market, okay? Hang on, I'm gonna just remove my video because it keeps on popping up. All right. Consolidation market, guys. This is that flat area. This is that channel. All right. We could have a very strong down, but all of a sudden we could have a channel. Boom, we lost it, and now it's going up. But we don't know that. All we do know at the moment is that we cannot do anything at all. We cannot move, right? Right here, consolidations. This is a slowdown. You guys need to understand these. You need to draw these areas out. I'm going to talk about these areas a lot more in just a few minutes. And honestly, if you can get anything from this particular presentation, is understanding the areas and understanding how to identify and marking these specific areas, all right? The channels. So even in an upward trend, boom, you have a channel, it breaks out. Boom, you have a channel, it breaks out. Okay, sometimes it can be downward, sideways, continuation. All right, but if you don't know how to mark these areas, guess what? You're going to miss them out. So the market respects areas, and we as the retail individual trader, we as well need to respect them. What are these areas? It is the support and the resistance area. Basically, to me, the support and resistance area is literally seatbelts. I guess that's probably the best way I want to explain it. It's like a seatbelt, right? So for instance, back to Formula One analogy. In the Formula One racing season, it is a known fact that 25% of the drivers will either have a horrible accident or even worse, a fatality, right? So when they're getting into their cars, they have their fireproof uniforms on, they have helmets, they have their goggles, and then they hop in and they put on like 2 or 3 seatbelts, right? Because they know the risk. 98% of traders fail, lose, and they lose big. Yet they do nothing to protect themselves. They do not put on their seatbelts. Support and resistance areas, those are your seatbelts, all right? So how do we identify them? What are these areas? And by the way, you need to draw them in, right? You cannot have a mental seatbelt put in place. You need to draw these in, because when you are in the live market, you're gonna look at your chart to the left, and that is when you're going to be like, that is the reason why I entered this trade in the first place, okay? Because when you are in the live market, your adrenaline is pumping probably the same as a Formula One racer, because your live money is on the market, right? But you have to understand what's happening. So if you have everything drawn out, your support areas, your resistance areas, understanding what is happening, you'll feel good. You won't have any issues. So what is a resistance area? What is a resistance area? A resistance area is the ceiling of the trend. It is the ceiling of the trend. What does that mean? It means that the market's been going up and all of a sudden, boom, it hits this area over and over again. So after 3 times, you need to have that drawn in, and that is a pretty significant resistance area. And the market isn't breaking through, and we don't know if it's going to break through. We don't know if it's just going to bounce off and start a new trend either. So until we get that confirmation, we don't touch that market, okay? Resistance areas. And when you draw it in, you need to draw it in for the whole time. Like, you need to continue drawing it in, because the market will revisit these areas. And even if it's like an hour or a day later, you're looking at it and you're like, oh, this was a resistance area and that market is still respecting it. So I'm going to wait. I'm going to hold off. Okay, what is a support area? It is literally the opposite. It is literally the floor of the market. It is the floor of the market. So if you have a massive downward trend, boom, boom, it keeps on hitting that floor and it is not breaking through it. You draw in that support area and then you sit and you wait to see what it's going to do without putting in your trade. If you already are in a trade, you need to get out when, even if you have to manage it properly. All right. So the support area, it is the floor of the trend. It is the floor. So when you have a channel, you have a floor and a ceiling. Again, you need to really draw them in. Why? Because the most important, probably one of the most powerful trades that we could take is the breakout trade. It is the breakout trade. All right. When you have a breakout trade, that is when you make the most amount of money. But if you don't have your areas drawn in, how are you going to know it broke out? You have no idea if it's going to be breaking out, right? So we're going to talk about that in just a second. I just need you guys to understand how these channels look. And sometimes they could be large channels, but it's still bouncing back and forth. Look, do you really want to enter a market that is so grindy and so choppy? No, for sure not, right? You want to go where it's fluid, when there is movement. Now, a lot of times people are like, well, how do you recognize that the market is slowing down and it's about to go into these areas? These are called reversal areas and divergences. To me, these are my holy grails, and I call them the trader's map to shift in direction and trend. And the coolest thing of all, they're free. They are 100% free. You could use it in any market under any condition. So what are these areas? What are these shifts or these holy grail moments? They are double tops, triple tops, double bottoms, triple bottoms, head and shoulders, and divergences. So I'm going to show you all that in just a second. So what exactly is the reversal pattern? When you're starting to see a double top or a triple top, does it mean that it's 100% reversal? Absolutely not. What it does mean is that there is a high potential that it can. We are waiting to see when. We don't know definitely when, but it has 100% indication that the market is losing its strength and it's losing its steam. The last thing we want to do is put in our money where the market is losing its steam. Okay, reversal areas. Now, I love and live for divergences. Do you guys know what divergence is? So divergence is actually very simple to spot. Right here, I have a perfect double bottom, right? So my price action, as you can see, is a straight line. This is a double bottom. So already I have a reversal pattern. But if you look at my red dots, those red dots are the MACDs. I personally love the MACD indicator. It's my favorite. I find it to be the least lagging indicator. A lot of indicators are quite lagging. This is the least lagging indicator. I absolutely love it. So what is great about this particular indicator is that it is showing you that there's divergence, that the market is slowing down. It is losing its strength. And when I see divergence, I'm staying out. I am staying out until I see massive strength in the market again. The market is screaming at me, stay out. Right now, I'm not really sure what's going on. I'm being to weakness. I'm losing my strength. Just wait. And that's exactly what I do. I listen to the market. And the coolest thing of all, guys, is that it's really easy. It's really, really easy to spot these areas once you know what to look for. All right, guys. So again, go to makingofadaytrader.com. So remember, put in HTTPS:// That is going to be able to get you guys to the freebie. All right. So now we're going to talk about the breakouts, because breaking out of areas is literally understanding and having the most powerful trade at your side. All right. So what exactly is a breakout? It's when the market is going in one direction and then boom, it hits either a floor or a ceiling. and you have to draw that support or resistance area in, but then all of a sudden it breaks through and continues in that same direction. So you're literally going in one direction. All of a sudden it's flat, it's dead, it's so uncertain, but all of a sudden, boom, it breaks through and you are on your way. So once you break through, basically what is happening is that the market is giving you that renewed energy, renewed confirmation in the same directions. And that's when you want to hop in and ride that out and make the profit. Okay. So here's how I do my breakout trades, because I find the breakout trades some of the best trades out there. So of course, here is a very good example of a strong resistance area, of a strong ceiling, right? And if you look at my MACDs, my red dots, you'll see a black dashed line. The black dashed line is 0. It is a total weakness. So as you can see, right before it flies up and breaks through, I am pretty much caught up in the 0 area, right? But then all of a sudden it breaks through my MACDs, it goes high. That is when I enter the market. So I use EMA lines to, enter the market as well. Okay, so that's how I know where to go in. Right here, hang on just one second. I see Craig is asking, so it's this. Okay, hopefully you'll be able to see the answer here, Craig. Oh, I just lost you, right? Okay, I see that Jeff has helped. Okay, cool. So this is how I see the breakout trades, right? Right here, you can see this really strong resistance area. And then look at the MACDs. They are just dead. And oh my God, just stuck at the 0 line. But then all of a sudden, boom, it is back in action, moving in the same direction. The MACDs are high. The price action has broken through. Boom, and you are ready to go. Now I have another bonus trade for you. So as I mentioned before, a breakout trade is after you have this flat, dead zone, boom, it breaks out. It gives you strength and energy, right? So the other really powerful trade, I call it personally an initial instant reaction trade. Why do I call that that? Because it's the transition. It is when the market has transitioned into a new trend. Usually you have the most amount of strength and the highest probability of profit when it first shifts direction. So I just want to give you this more like a layman term idea of what this is. Imagine you want to go jogging, right? You've got your jogging clothes on, you just put on your sneakers and you're out the door. Usually that's when you have the most amount of energy and interest, right? And you're continuing, but then all of a sudden, I don't know, you get thirsty or you are just getting tired and you're not really sure if you want to continue. This is that dead zone, right? This is that channel that you're in. Do I want to put money on you continuing in that channel area while you're indecisive? Not so much, right? So when we leave the door, that's the beginning of that new trend. Then we get into this, oh, I'm getting a little tired, but then we pop in a gel, right? Like one of those high energy gels, and then we're going again. That is the breakout. All right. So that is exactly what we want to focus on. And once we are able to spot that, the sky's the limit, guys. And you'll be so amazed once you can spot these and they are now going to be visible to you because you're going to know what to look for. You will be able to have so many aha moments and so many fantastic moments. Okay. So here's the thing, guys. We have absolutely everything we need to take action. Absolutely everything, right? We have these presentations, we have YouTube gurus, we have amazing books, podcasts, you name it. But at the end of the day, how do you know that you are doing it right? How do you know that you are doing it right? Who is there to be able to help you to understand that you are doing it right, right? All of this is great. But at the end of the day, the real question you're truly probably asking yourself is, how do I get started? How do I truly get started? And this is not from beginners, by the way. I get this question asked mainly from seasoned traders who have been really putting in years and into the trading and are still inconsistent. And they ask me, so how do I turn this around? How can I become profitable and do it consistently, right? That is a big question that people ask me all the time. And funny enough, it's usually lacking the basics. Like I mentioned earlier, you would never enter a room full of native speakers of a language that you don't understand and pretend that you know how to get along with them, right? When you don't even know how to say, hello, my name is, right? Or hello, what is your name? That is as basic as you possibly could get, because you can't just enter a philosophical conversation in a completely different language and think that you're going to be doing well. They're going to look at you and be like, what are you even doing here? But if you show them that you are learning the basics, they want to work with you. And it's usually the same with the market. Lacking the basics, I found that to be the #1 problem for the majority of people who are not able to do consistently and being profitable consistently. Okay, so it's like driving a car. My oldest son just recently got his driver's license, and he's been in the car all his life, but he's always been in the passenger seat. So when it was time to teach him, we hopped in, my husband's like, all right, put the car in, put your foot on the clutch and the brake, make sure that you get the car out of first gear, put it into neutral, now release the brake. He's like, wait, clutch, gear, brake, what are you talking about? He had no idea, because we just for some reason thought that he would know this by being a passenger, but he didn't. No one ever taught him that, right? So once he was taught and shown, all of a sudden, guess what? He's driving on highways like a crazy teenager, but he understands, he knows, he has the basics. Now, I want you guys to go even further into like a creative mode. And imagine you're in a car and somebody who has never been in a car before gets in. And you're like, all right, buckle up your seatbelt. It's going to save your life. They don't know what a seatbelt is. They've never been in a car. They're like, what's a seatbelt? It's buckle up. It's going to save my life. If you don't show them this is the seatbelt, this is how you buckle it up, they're not going to be able to do it. We forget that we're not born with this information. And this was my own personal sad truth for years. I spent over $20,000, probably even more, on my own trainings. And I have to say, nobody ever talked about the basics. And I struggled, and I lost money over and over and over again, to the point that I lost $4,000 in 5 minutes. Why? Because every time I asked in either a chat room or in different academies or in summits, I'm like, can you please explain to me, what do you mean by divergence? What do you mean by reversal pattern? What do you mean by bull market? People wouldn't even respond to me or treat it like I was supposed to be born with that information. And that's why I ended up losing money, because I was following what they were saying in an advanced tone, right? Oh my goodness, they're sitting there saying that here there's a great trade, and I don't really understand why, but I hop in because I feel like I have to. But if you understand why, everything will change and you will have full control. I ended up losing $4,000, and it broke me. It broke me. Okay, it broke me, and to the point that I ended up quitting. I quit. But here's the thing, guys, and I know that everybody in this room is probably in the exact same position. We are all bit by the trading bug. We're all bit by the trading bug, and it never stops itching. Do you know why? I'll tell you why. Because deep down inside, we know that we can do this successfully. When I quit, I walked away. It was probably like 4 or 5 months. But I couldn't stay away. I was constantly watching others. And I said to myself, I'm like, if they could do this, so can I. So what I decided to do, though, is I decided to get back to the basics. I used to have three charts, 3 monitors going on. I literally donated 2 almost new high definition monitors. I put it on the street because I knew if I left at home, I would be too tempted to go for it. Put them out on the street. Probably the garbage men that day scored really well. I removed all my indicators. I was just looking at the naked price action, and I slowly started to put in indicators. Another thing that I have found is that we watch all these different gurus and listen to this indicator about that and all this, and we put them all on our charts, and then we're in massive analysis paralysis all the time, right? So when I removed all my indicators and slowly started to put in, I only have 2 indicators now, but it's funny because, you know, a lot of people talk about like Fibonacci's, the Bollinger Bands, the Kepler Bands. And when I removed those 3 very popular indicators, I felt released because I just never aligned with them. And it's okay not to align with everything what other people are saying. You need to try it out for yourself and get back to basics. And as I started to do well, I started to share my experience, and people were like, can you please help me and teach me? And one of my students a few years back said to me, you know, Marina, your entire philosophy of how you teach and explain is like Coach John Wooden. And I never heard of Coach John Wooden before. I was like, who is this guy? So of course I looked him up. And this man was a legendary coach, right? I mean, he was legendary. And his entire philosophy and teaching style was, when in doubt, get back to the basics. And here's the thing. This guy was a legendary basketball coach. Him and his team went on to win 88 national championships, 10 NCAAs. He had A-star, A-list players that he was with all the time. But every season, it did not matter how many national championships you've won. Why? Because your ego will pretend that you know it all. You'll get on that court and you won't have your shoe tied properly. You're going to run on that court. You're going to, well, I don't even know, sprain your ankle, fall, and you're sitting out the whole time. So he would start every season with these guys that have just won so much, how to tie your shoe, how to roll up your socks, how to dribble the ball, because we need to get back to the basics. And today I have an incredibly special offer only for you guys, only for the people that have taken this time out to be here with us today. And I'm so grateful that you guys have taken this time to be here today. And I have a special introductory course for you, Bootcamp for Day Trading. You can do this on any apparatus, on laptops, on desktops, on tablets, on phones. It does not matter. And all of this for $97. One time, $97. You do not pay ever again. Now, I want you guys to go to bootcampfordaytrading.com. So again, you might have the same issues. So please make sure that you go in and put in HTTPS Bootcamp for Day Trading. Okay, hang on just one second here. Bootcampfordaytrading.com. So I'm going to put that here for you.
I already put it there.
Bootcampfordaytrading.com. Okay. Hang on just one second. Why? Oh, there we go. All right, guys, if you go here, HTTPS, make sure you put in that S because that makes a really big difference. You need to go into the actual thing right there. Okay, Craig, cheat sheet. It's not a heat sheet, it's a cheat sheet. I'm not sure if you're from the States, but we say that. Oh, I see that, Jeffrey responded. Okay, cool. Thanks, Jeff, for being on top of that. I appreciate it. Okay, so guys, what do you guys get for $97 that will bring you the same return on investment for anything else that you buy? $97. Look, me and my husband used to love to play golf. When we first moved to Guatemala, that was almost 16 years ago, we used to go to the golf course, and it was like $29 per person. Before we moved to Barcelona 2 years ago, it was $119 per person to play golf. No joke, okay? Going out to lunch today, dinner, $97 doesn't even buy you a nice lunch anymore with wine. It's unbelievable, these prices. So this is what you guys get, $97. It's like a no-brainer. So let me break this down for you guys, okay? What are we going to be getting in this particular introductory course? First of all, simplifying your day trading package. Another thing is helping you set up your platform. A lot of times we are really intimidated by the platform. That is all part of it. I help you guys set up really fast so that you guys could start to have fun in the actual trading versus learning and figuring out how to work your platform. Okay, so bam, that is all included in the course. And then we're going to get into the dissection of the trends, because this is it. Without understanding how to focus on these trends, it's going to be really difficult for you to be able to have a profitable lifestyle consistently, right? Because we want to make this our livelihood. So we're going to be dissecting the upward trend, the downward trend, and really focusing on those sideways trends, understanding those telltale signs, the reversal patterns, the divergences, really understanding. All right, because once you guys spot them, I promise you the amount of emails I get with aha moments just from this has revolutionized half, the majority of the people who trade that I teach, and the other half is divergences. I love divergences, and then when you put them together, it is just a guarantee, completely successful way and completely taking your trading to the next level. That I promise. Okay, you guys will be able to see the market in a completely different way and understand what it's doing and be able to handle any market. So you're going to be learning about those telltale signs, the support and resistance areas. You're going to be putting on your seatbelts, and divergences. Divergences to me are my holy grail, and if you guys spot them, I promise you it's going to change your life. Breakouts. We are going to really focus on those breakouts so that we master the breakout, and we're going to learn how to avoid the fake out breakouts, the FOBO areas, because you can. So once you get that, you'll be able to understand how to do the breakouts, and you will have unlimited access to the curriculum for life. All right, guys, all this is valued at $1,600. You get all of this, the traders workspace, the sections, the areas, and the work and the power of the breakout. But before we continue, I just want to show you some of my student testimonials. And like I mentioned earlier, trading, you can do this anywhere in the world. Anywhere in the world, and my students are from all over the world. Here's what one of my students said: Michelle, best money I've ever spent. I just finished the boot camp. Unbelievable. Derek, you're the only mentor that truly checks the work and works with us. Adrian, I am enjoying your boot camp and learning every day. But I want you guys to go back to the question I asked before. How do you know you're doing it right? Right? So I want to share something really important with you. How do you know you're doing this right? Right? Here's the thing. It's hard to not have real knowledge unless you have an accountability person. So what I have included in that one-time fee of $97, one entire month of mentorship and coaching with me, private, one-on-one. You guys will have unlimited access. You can email me, we could do Zoom. You decide how you want to work with me, but you get 1 month. That alone is worth $500, and that is included in that $97 one time, because the mentor is what can take you to that next level. And I'm saving all of this for you right now, $2,600 value for one-time price of $97. So go here right now. Remember, put in that https://bootcampfordaytrading.com. Bootcampfordaytrading.com. So let's review once again what you guys are going to be getting for bootcampfordaytrading.com. Everything in this course. One-on-one mentorship with me, and I also have a live chat room that you can enter for free for the first month. Okay, $97. That's worth less than one trade. One trade that we normally put into the market is usually between $200 to $400, right? Like that's the minimum trade. For $97, you will get 10x your return on your investment. So you can have 100 of these dinners, guys. But here's the thing. It's really important. Right now, it is a full room. It is a full room right now. I only have spots for 25 people. So I sell out really, really quickly because I really want to give my time to you guys because of the one-on-one mentorship. So I'm just saying it fills up really, really fast. So I recommend you guys just hop on it right now. And $97, you can't go wrong. Okay, so here's what the order form will look like. I'm going to show you right here. Oops, hang on just 1 second. Oops. All right, so bootcampfordaytrading.com. So you could go here and you will see right here, ooh, what's happening here? Oh, wow. Oh, there you go. Sorry. So no, I was wrong. You have to remove the S. You have to remove the S. That is my bad. I'm telling you, every day there is a new update with Google. It's a little bit tough. But if you don't have Google, if you're using a different browser, then it shouldn't be a problem. So when you're putting it in, make sure it's That's it right there. Bootcampfordaytrading.com. No S. All right, guys. And I see that Jeffrey has put it in right here also to take you directly to the actual order form. Okay, so here you guys are. Please go to the actual order form for here. But again, remove the S. Wow, Google just messes with us all the time, right? We have no control over that. So guys, go here again, bootcampfordaytrading.com, no F. And again, I do sell out really fast because the price is just, you know, obviously 97 bucks. You can't get too much with it one time. You will not have it again. So let's go here together. And I am truly looking forward to having you guys in the course. And if there's any questions, this is definitely the time to ask. And Jeff, let me know if there's any questions from YouTube people as well.
All right, let's see. Okay, yeah. Is there a way to get in touch with you? It seems like Craig is having a hard time with the, with the order form.
Okay, so Greg, I am putting it in right now for you. You could just go directly here. I think also, hang on a second. I'll put in the direct, hang on a second here, the direct way of getting there as well. So, oops, how do I do this? There we go. Here, Greg, you go just directly there. I hope you could access Craig, sorry, not Greg, Craig. Our brother's name is Greg. Craig, you could go in directly to right here to that link. Let me know if that would work better for you guys.
Okay.
Okay, cool.
Aside from that, we kind of explained what the cheat sheet meant for US. I see a lot of questions. Let me check YouTube real quick.
It's funny, I'm married to a Guatemalan, and a lot of things that we say, we speak English all the time at home, but whenever I say some things that are just strictly US, he doesn't get it. Like 101, like, you know, trading 101, he had no idea what that meant, and no foreigners, but it's such a US term.
Yeah.
I
wonder, like, I think terms like boot camp too kind of confuse people. Like when you do, when we say, hey, we're going to do a boot camp, they're like, huh? I didn't join the army. What? So anyway, yeah, do we have any questions?
It's
Marie?
a fun boot camp.
Thank you for joining us. Yeah, I'm sure it is. So you're not going to make them do push-ups?
No push-ups, unless they want to. That's not bad for you.
Bridget wants to know how long it takes to complete the course.
So it's a quick course. It's about within a week or two, but then you have 1 month of working with me, because it's not about the course. Obviously, you will learn all the specifics, but it's about practice. And my goal is to be there for you when you're practicing with your charts and even going into the live market.
Craig wants you to save him a spot.
Cool. Okay. I will. I promise you can have that for sure.
Okay.
Let me see here. What are my settings for the MACDs and the moving averages? The moving averages are 20, 52, and 135. And the MACDs is just the universal ones. So when you open up and you'll have MACDs, that is the only ones I use. So it's nothing out of the ordinary.
Mustafa from YouTube wants to know, can I choose the market if I'm in the one-on-one training? So do you specialize?
Yeah.
Okay.
100%. You get to choose the market because every market, the charts are the same. Like the language of the charts are the same. So we will work with whatever market is best for you. All
right. And then why did Han Solo not like his steak?
What? I have no idea. I'm not a big Star Wars fan, so I could call my husband.
Anyway, it's just a joke. Let's see. Jason says, I signed up during your last webinar. Thank you.
Oh, thanks so much. Yes. So please, Jason, get in touch with me and I will be, yes, for sure. Because I was moving and all this other stuff, so I had to put it off for 1 week, but yeah.
All right. That's it, I think, for the questions. Thank you again, Marina. Also, you brought us
everybody.
In time, so that's cool too. Bootcampfordaytrading.com. No S though.
Yes.
Or just click
No,
the link.
HTTP. Yeah, no, it's just bootcampfordaytrading.com. And also, I think we have put it in the audience,
Both the
right?
links that, excuse me for interrupting, both the links that Jeff and I put in GoToWebinar and YouTube do work, and go to that page, FYI. So this should be good.
Yeah, click the
Thanks,
links.
Greg.
We double checked. All right.
Okay.
Marina, thank
Awesome.
you very much.
Thanks, everybody. Bye. Have a
Bye.
good weekend.
Okay, let's do this. Yes, okay. And make me the presenter. And I'll show my screen. All right. Very cool. All right. Great job. Really appreciate Marina coming in, sharing that with us. If you haven't yet, join the community. You go to www.thetradersforum.com right now. You can click on a little terms of use, and then you can start live chatting with other traders about the markets that you're interested in, exchanging ideas, sharing thoughts, all that kind of good stuff. It's a community of traders helping traders. There's a lot of education. We do some really cool events up there. You should go, www.thetradersforum.com. It's been a lot of fun, been kind of heavily involved in this. It's not really the same company as Metastock, it's a partner company in Metastock, but it's been a lot of fun, and you should join us there, thetradersforum.com. So Jason says, great stuff, looking forward to completing the work. All right, very cool. Greg, it's your turn to help me now.
I'm here for you.
Do you want to do some prizes?
Yes, I do. Absolutely.
Okay, let's do that. There are prizes, and they're not going to give away themselves. So let's see.
While you're looking at that, I have to mention that, you and I have listened to these discussions many times in some cases, but often don't have the ability or the time to actually listen to them and pay attention. Today, I've had a little more of that time, and I've really, really enjoyed today's speakers and what they've got to say, and their level of expertise is just off the hook.
I'm glad you're enjoying it, Greg. I've got notes from all 5 days. I listen to everybody.
Oh, I know you do. Well, I do as much as I can, but there's switches and buttons and
I know. Yeah,
it's background.
It's a little bit different to run it for sure.
Well, and it turns out, Jeff, they make me do my job otherwise, even like I know, right? Please, prize. Let's do this prize thing.
Yeah. So the prize that we're giving away is the Trading Indicators Welcome Package. It includes the Divergence Cloud, which is an auto-optimizing indicator. It also includes weekly trading sessions and the Trade Radar Indicator put together by Daniel Sinig, and the trading indicators. And we're going to give away one of those to whoever you decide that is going to be lucky today. What I need is just a number between 1 and 10,123, Greg.
Okay, I've got my Google random number generator here, and
Cool.
The number we get is on the high side, 9317.
Okay. That is a Glenn in the USA Gmail account. I'm sure that doesn't narrow it down a lot.
There's probably one or two.
If you're the 9,317th person to register, you may have just won a prize. So anyway, we will reach out to you. I'll send that information over to Trading Indicators. They will get in touch with you next week to kind of help you fulfill that package. So, Greg, why don't you tell the people on YouTube how they can win?
Oh, well, it's really simple. Just go to metastock.com. There's a large banner on the top. You can click that. That will take you to metastock.com/traders-conference. It's also pinned at the top of the chat here in YouTube, and just register there and you are good to go. You don't have to register every day. You just register once for the entirety of the event and you are eligible.
All right. Jason said he really enjoyed the session. So very cool. Let's talk a little bit. Thank you very much for the assist, Greg. Appreciate it.
Thank you, sir. Carry on.
We've talked ad nauseum. You've probably heard it before. I've probably mentioned that for 31 years in a row, Metastock's been rated the best software program in its price category. I'm going to mention it again, though. we are offering a special promotion where for the next 3 months you can use Metastock. You can use it to scan, identify markets, trade, get test ideas, get real-time alerts, commentary, a good understanding of everything. It's a software we've been really developing since the 80s, and there's tons of stuff in it. Yesterday I did a class on Ichimoku, and the day before that the Guru, and we've just been kind of scratching the surface of what's there. If you want, you can buy a month, which would be $75. Get the second and third month for free. That brings your monthly cost down to about $25. That runs you into February. I can't believe that's going to be next year by the time that's over. You can get your extended trial at metastock.com/conf-promo. Or you can call 800-882-3040, or you can go to metastock.com/sales-chat. I literally would not trade without Metastock. I think you'll love it. You'll never know unless you try. All right. That's actually, I should put that as a Facebook update. All right. Our next presenter is Buff Dormeier. Buff does a lot of volume analysis, very, very smart guy, won a Dow Award. He also manages 2 ETFs, and we can see you already, Buff. Let me go ahead and make you the presenter real quick. I just had to move stuff around. I have to find my mouse. Where is it? Okay. How you doing, Buff?
Can you hear me now?
I can, yeah.
All right, yeah. Great to be back with you, Jeff.
Yeah, it seems like was it last week or the week before that we sat down and did a little bit of the
remember, it was on Halloween. It was 2 weeks ago.
Yeah. Getting ready for these things make stuff a little bit of a blur for sure. All right. Let's see, you should have a screen request share. That was a good interview too. So one of the things we do on Traders Forum is we'll sit down and we'll just do interviews. And we'll just talk. And it's kind of a long form content. And so if you go to thetradersforum.com, you can go watch that now. I do see the presenter view for you.
Okay. Let's see here. Okay, now how do I switch the screens?
If you, let's see, under sharing, it'll give you an option. There's a little, I think you figured it out before I could even explain it.
I'm trying to figure it out.
Okay. Under where it says sharing, there's a down arrow.
Show video, is that where it is, or share,
no,
sharing?
Just,
yeah, I see that. Yeah. Change.
Yeah, it should list out your monitors. So it should say monitor 1, monitor 2, monitor 3, etc. I can show you how to just move the PowerPoint so that it's on the right screen.
Show screen. Okay. Yeah. Okay. So I think you see it now.
First try.
You got it. We got it.
Yep, that's it. All right. I'm going to go ahead and get out of the way. Buff, thank you for joining us. I'll let you know if we see any questions on YouTube or something.
All right. All right. Thank you. Yeah, I won't see them. So thank you. So thanks everyone for joining my session. My name is Buff Dormeier. I consider myself a volume evangelist. Now, my goal today in our presentation and time together is to instantly turn you into a market guru or reveal to you the holy grail of investments. You might be able to find those in your junk mail. Rather, our object today is to provide you with some tools, new tools, some new applications, and teach you how and why these tools based on volume principles may allow you to better interpret the charts and improve your trading and become a better investor. So one of the things I like to start off with is just talking about the difficult game that we're all in. So the markets they're extremely efficient. So what we're up against is we have the most capitalized institutions, and they're hiring the wisest minds, and they're giving them the best resources. So that's just a plug there for having your trading platform is your weapon, okay? And so having a robust system like Metastock gives you a powerful weapon. But even with that, going up against these folks head to head can be a difficult game. And so I'm here to provide you with these volume-based tools, hoping to provide you an edge so that you too can follow the smart path that the smart money is blazing. So today, I'm going to update you on some of my research. This is Jeff mentioned the 2007 Charles Darrow Award, but this is an update on a recently published article in Technical Analysis of Stocks and Commodities. Okay, that just came out a few months ago. Okay, and this update is also covered in my new book, The Volume Factor. Okay, and you can get that at my website, buffdormeier.com, or anywhere books are sold. Most importantly, I'm going to tell you where you can obtain these resources for your own use within the Metastock platform. So this is a technical discussion today. I'm going to begin, and we're going to talk about some of the most basic indicators and why they work. And then we're going to focus on the fundamentals, and then we're going to build off that base. Now, it may start off basic at first, but I need you to pay attention because these are principles that are going to build the foundation, a foundation of understanding that you're going to need as we progress along. So why should we consider using volume? Okay. Volume is an edge. Now, that's not just my opinion. This is research that has been applied and tested over and over again. And so here are 4 good reasons to apply volume in your analysis. Okay. And so I mentioned in the beginning that I'm an evangelist. And so if I'm an evangelist, I got to have a good 4-point sermon. And so this is my 4-point sermon on why you should use volume. And just like the sermon that you might hear at church, it's going to all start with the same letter. Okay, and the letter we're going to use is the letter R. And so our first R is responsiveness. Volume leads price. Okay, volume provides quicker information. Okay. Generally, changes in volume typically occur before major or significant price movements. Our number 2 R is reliability. Volume confirms price. So if you think about the market or price being the market's testimony, volume then is its polygraph, because volume validates and substantiates price. The more investors participating at a given price point, the more that price point is validated. So in this way, volume not only gets you into a trade quicker and faster, but simultaneously increases your probability that that trend, momentum will continue on in the future. Our number 3 R is risk. By identifying legitimate trends from illegitimate failing trends, and by identifying trend weakness early on, we should be able to reduce the risk in our portfolios. And 4, if you're in a trend earlier and have a higher probability of being positioned correctly, then you're putting the odds in your favor and positioning yourself to make a better return. And so I said we're going to start with the basics, and it just doesn't get much more basic than price. But what is price? So if I purchased a security today, what is my opinion? Okay. Well, if I bought it, then it must mean I'm bullish. I believe the price would rise. There's no other reason I would buy it. But in order for me to take ownership, that order must be matched. And what is the person on the other side? The person that sold that stock to me, what is their opinion? Okay, well, there might be multiple reasons to sell, but most likely they believe the price is going to decline. Otherwise, they wouldn't have sold it, right? So therefore, price in the exchange markets is an agreement to disagree. Two parties with the opposite view of what the future holds for that security come together, and their agreement is the price. Okay, so price represents the conviction, emotion, and will volition of investors, and it's truth. It doesn't matter what the talking heads and TV are saying, or what the analysts' price targets are, or what someone's view of intrinsic value may be, or your opinion or your cost basis. A stock is worth what it trades for, and that price represents all the collective knowledge of the markets. So let's move on, and we'll talk about B equals S equals T. This is a little formula to help you remember, okay? So let's think about it. Why did the market go up last week, okay? And why is it going down today? Well, if it's going down today, there must be more sellers than buyers. That's what technical analysis is, right? That's what I heard him say on financial TV, but no, they don't understand. In an exchange market, the number of shares purchased always is and equals the number of shares sold, and that also is the total volume. So B equals S equals T, buy volume equals sell volume equals total volume, okay? So now let's put this into practice. So let's say I have my newly purchased Metastock add-on, and I get a signal to buy a certain stock. And so what I'm going to do, the moment I receive that signal, I'm going to put an order in to buy 1,000 shares of, let's say, XYZ stock, and I'm going to buy it right at the market. Now, unbeknownst to me, on the other side of that trade, there's a big institution, and they got 100,000 shares, and it's just reached their intrinsic value. So what they do is they put a limit order to sell 100,000 of their shares. Now, my 1,000 shares are matched with 1,000 of their shares. So the question I have to you is, who's in control? Me, a buyer with a market order suggesting urgency, or the seller order with 100 times as many shares, but with a more complacent limit order? So the answer is that we don't really know until that order is executed. But once that trade goes through, if it goes through on an uptick, it indicates my demand is greater than their supply. And if it goes through on a downtick, then there's more supply than demand. So these interactions they're happening tens of thousands of times every second, 5 days a week in the exchange markets. And so if the accumulation of these ticks over time are moving higher, then we know demand is in control. Okay, and that's visualized by that uptrend. Okay, and that is a security that's being accumulated over time. And if these accumulations of ticks over time and they're going downwards, then we know that supply that is in control, and that's visualized by a downtrend or a security that's being distributed over time. So now, what if there is a way to look deep inside these interactions of supply and demand and determine if volume was supporting price? Well, that's the goal of the analysis that we're going to talk about today, volume analysis, okay? So I like to think of volume as being synonymous with the word force, okay? And so if we were to look up the word force in the dictionary, okay? Oh, I just missed it. Go back here. I'm going to need that definition here. This is what we might find in Webster's. Force is a power operated against support or resistance, okay? And well, those are some interesting terms in technical analysis, because what is support? Support is an area where buyers reside. And what's resistance? Okay, and resistance is an area where sellers reside. And what is an uptrend? An uptrend is nothing more than a rising support line. And what's a downtrend? Downtrend is a falling resistance line. Okay, so volume is that force required to sustain trends. So if we were to switch dictionaries and look at the physics dictionary, and we're going to talk about some physics here in this conversation today. This is the definition. Force is a vector quantity that tends to produce an acceleration, and that confirms our first R. And it's been confirmed since the days of Charles Dow over a century ago that is volume leads price. Okay, and so this statement can also infer that volume plays a crucial role in trend and momentum analysis. Okay, so I said we're going to talk a little physics. So let's take a look at some Newton's law of motion, because we can understand volume's role in analysis through the laws of Newtonian physics. Okay, so here is the first law of motion. An object at rest remains at rest. An object of motion remains in motion at a constant speed and in a straight line unless acted upon by an unbalanced what? An unbalanced force. Yet most market analysis neglects this very word, force or volume. So if I were to rewrite this in terms of volume analysis, it might look like this. A price trend in motion, or its momentum, tends to remain in motion at a constant speed and in a straight line unless acted upon by an unbalanced volume. Okay, my old friend Joe Granville might like to call that on-balance volume. But we'll stick here with this definition: physics, unbalanced volume. Matter of fact, I think if I were to talk to Joe back when, you know, he's passed since now, but about this, he may have called this unbalanced volume as opposed to on-balance volume. So Joe had an interesting phrase. Volume is the cause. Price is just the effect. Okay. Yet most all analysis on technical analysis focuses strictly upon the effects, and we ignore its cause. Okay. So let's take a look here, and what we're going to do is we're going to look at some typical indicators, and what we're going to do is we're going to transform them and superpower them by adding in volume information. Okay, and so the first thing that we're going to talk about is my volume weighted moving averages, and these were first published in Stocks and Commodities magazine by myself quite a long time ago. So what are volume weighted moving averages? Okay, so volume weighted moving averages differentiate from simple moving averages or other price weighted moving averages because they not only include price data, but they also include the proportional changes of price adjusted to the volume data. So in effect, moving averages show you price, whereas volume weighted moving averages actually show you more capital flows, where people or investors have actually participated. So, and let's give you a simple, easy illustration on how you might calculate this. So let's say in day one, the price is 10, day two, the price is 12. Well, then the average price, 2-day moving average, would be 11, okay? But there's some information that neglects here. So again, day one, the price is 10, and let's say 100,000 people or 100,000 shares were traded on that day. On day 2, the price is 12, and we now know 300,000 shares traded. So 3 times as many shares were bought and sold at 12 than at 10. So really the average price, what people participated in, was not 11, but 11 and a half. Okay, so here's how it would look on your Metastock screen. So the blue line is the simple moving average, which you probably all use in some format. And now I'm going to show you the improved one, which has the volume data. This is the volume weighted moving average, the red line. And notice when the volume spikes, how much more responsive the red line becomes. So why would we do this? Okay, we're going to do this to get the benefits of the 4 R's. And so I'm going to show you that study and that in the magazine that was published long ago, and these principles still hold true today. Okay, so what we did is we studied this by testing stocks over 5,000 trading days, and what we found was that the stocks with the volume weighted moving averages had faster signals 93% of the time. Okay, so volume does indeed lead price. I mean, it's pretty clear there. So here's another study done. So we in this session or in these seminars, you're probably hearing a lot from the practitioners. Okay, I'm going to give you some information from academia, which often doesn't agree with practitioners. Okay, but there's Wharton School. So Wharton School, I would think you might think maybe a pretty school, and they did this study on volume. And here was the result of their thesis statement on their study on volume. This is quoted here. We find that individual stocks whose trading activity is unusually large over periods of 1 day or week, as measured by trading volume during those periods, tend to experience large subsequent gains. And this is their so the on the quote below here, if that wasn't enough for you, University of Texas learns about their paper, and they think, what are these guys from Wharton smoking? Can this really be true? All you got to do is follow the volume, and you're going to get these exponential returns. So University of Texas went out and they did their own study, and what they did is they studied markets all over the globe to see if this phenomenon held true. And here's the results of their thesis statement, their concluding remarks. We studied the existence and the magnitude of high volume return premium across equity markets in 41 different countries and find that the premium is a strikingly pervasive, it's a pervasive global phenomenon. We find evidence that the premium is significant presence in almost all developed markets and in a number of emerging markets as well. So volume is an area where technicians, fundamentalists, and even academia can find agreement. And let me tell you something. To get a faster signal, it's not all that tough. All you need to do, if you shorten your data set, you're going to get a quicker signal. That's true in technical analysis, fundamental analysis, economics, or any realm of science or social science. You shorten the time frame, you're going to get quicker signals. Okay, but the cost, what's the cost of getting a faster signal? It's always been the expense of reliability or accuracy. Not so with volume analysis. We can not only receive faster signals, but simultaneously improve upon the reliability of those signals. So what this slide is showing, that 60% of the time, volume improved on the accuracy. Okay, the simple moving averages only improved 28% of the time, and 12% of the time there was no significant differences. So volume not only leads price, but it confirms price as well. Okay, not only that, the average drawdown, fewer of the most of the stocks in the study had lower drawdowns, and then the next one is lower risk, and then finally higher returns. So we did the study, and we included different types of factors: low volatility, low volume, high volatility, and high volume. All across all 4 factors, volume analysis improved the results, financial results. Okay, we also studied different types of stocks. We looked at large caps, mid caps, and small caps. In all 3 categories, both large, mid, and small, volume made improvements. Those 3 size categories plus those 4 factor categories makes up 12 total categories, okay, or subgroups. Of the 12, 11 of the 12 showed improvement with the volume weighted moving averages over the simple moving averages. So let's move on to another, and you look at some more physics here, and we're going to study Newton's second law of motion, which is force. Okay, and this and why are we doing this? Because understanding the amount of volume required to move a security or over a given distance at a particular speed helps us gauge the momentum. So this is momentum. Okay, Newton's second law of motion or force. The acceleration of an object depends on the mass of an object and the amount of force applied. So again, rewriting this into volume analysis terms, the more volume or force being applied to price or mass, the stronger the expectation of the momentum. So here's the analogy. Price acceleration or momentum is powered by and through its volume. Again, price is the effect, volume is the cause. Okay. So now we're gonna add some more volume into some more indicators. Okay. This is a little bit more complex one. Okay. But this indicator that I'm going to study today is the trend thrust indicator. Okay, it was also published in Stocks and Commodities magazine. It is an indicator that is available here on the Metastock platform. And what we're going to do is we're going to switch out the simple moving averages, and we're going to empower this with the volume weighted moving averages. Okay, but we're gonna add to that, okay, by putting in some adaptive properties to superpower this volume weighted MACD and turn it into this trend thrust indicator. Okay, and we're gonna then let me just show you the results. I think it speaks to itself. So first of all, here's a chart. Here's the MACD. Here's my volume weighted moving MACD, and here is on the bottom the trend thrust indicator. Okay, so why would we want to use this? Okay, the MACD we studied in our study of stocks. We found that the MACD was accurate about 34.5% of the time, and that's not a bad. Okay, because stocks trend approximately a third of the time, so you would expect the MACD to work about a third of the time, and it does just a little bit better than that. Okay, but when the MACD is confirmed, the volume is confirmed through the trend thrust indicator. We can take that up from 34.5% to 51.5%. Okay, meaning we can look at the trend and move from being right a third of the time to being right over half of the time. Okay, so the reliability. Okay, so this is the reliability across small caps, large caps, low volume, high volume. You can see that they're all right near or above 50% compared to the MACD, and whether it was all 4 factors and all 3 sizes. Okay. And again, as you might expect, we get quicker signals with higher, much more reliable results. We're going to make more money. Okay, so with this, let's close out here with Newton's third law of motion. Whenever an object exerts a force on one another object, the second object exerts an equal and opposite on the first. Okay, this is Newton's third law of motion, and it's really talking about a symmetry. So the analogy here is the difference between price trend and volume adjusted trends or momentum exposes an asymmetry between momentum and volume. And let me tell you something right off the top. No one's doing this analysis, and this is by far the most powerful aspect of volume analysis, and nobody's doing it, okay? So let's take a look at this in from a trend standpoint. So here, we're gonna put our volume weighted moving average, the red line, versus our SMA, simple moving average, similar to what we did before. But this time, as opposed to looking at this in isolation and this is isolation, we're gonna look at the asymmetry between these two. What is the difference between these two? And what that exposes is this Newton's third law of asymmetry. Demand pushes, supply pushes back, okay? And that is the information we want to gather, okay? So here is the volume price confirmation indicator. What this does is it takes that asymmetry and puts it into an indicator, okay? And so you can see here at point 1 here, the indicator bottoms before the stock does. At 2, it breaks out before the stock breaks out. And then you can see that at point 4, it's really rolling here. Okay, that's how we use the VPCI. Okay, and to kind of give you a quick overview of how this relationships work, let's think about it like this. Okay, so first of a couple of definitions. Okay, a rising trend is driven by greed. A falling trend is driven by fear. Okay, volume is energy. Okay, or fuel or force. But when volume falls or declines, it operates under the laws of not energy, but entropy. Okay, so in the first phase here, we have a trend that's up with rising volume. Okay, this is greed with energy or invigorated greed or an issue under strong demand. The uptrend is being confirmed by more volume. The implication going forward is bullish. Next, we have underneath here, we have a trend that's up, okay, and the volume's falling. Okay, this is greed not with energy, but with entropy. This stock is not under invigorated greed, but it's a complacent stock or an issue under weak demand. The uptrend's being contradicted by fewer and fewer people willing to participate at the ever-increasing prices. The outlook for this condition is bearish. Next, we have a trend that's going down on rising volume. This is fear with energy or a market under supply or fear. This downtrend is being confirmed by more people willing to sell at ever depressed prices, and the outlook is bearish. And finally, we have a trend that's down, but fewer and fewer people willing to sell, or fear with entropy or a state of apathy. Okay, this is an issue under weak supply, and it's being downtrend is being contradicted, and that implication is bullish by fewer and fewer people willing to sell at ever decreasing prices. So here's a chart here, and we can see that the trend is down, the VPCI is down, but then here at point 1 it turns up, our stock turns up, the VPCI is moving up, confirming the trend. But at point 2, it crosses underneath. But still, this line right here is the 0 line, okay? It's still above 0. And then when the VPCI crosses underneath the 0 line, the trend breaks down, forming this little V right here is a VPCI V bottom, which is a capitulation signal. The indicator goes back up and then eventually does the stock. Okay, this is the test on the VPCI. What we did is we take the S&P 500, We take the top 10% of stocks with the highest VPCI. That's the top 50. And we compare that to the market. And when you own the top 50 stocks with the highest VPCI, as opposed to the last 2 decades getting a 5.6% return on the S&P total return, you got 8.6 with just owning the VPCI top 10. So 3% improvement in annualized returns, and that doesn't include dividends. So what we did is then we took this and we said we got 2 indicators here. We got the VPCI, okay, and then we're going to combine this with a trend indicator called the MACD. And when we do that, and this is actually the Charles Dow award-winning study. When we did this, we got the S&P did 10%. The MACD alone, it didn't do very good. It lost almost 3.9%. Okay. When we use volume to confirm it with on-balance volume, it cut the loss significantly down to 1.5, but we still lost money. But when we combine the MACD with the VPCI, and then we also had a high ADX on there too, if you're familiar with that indicator. But that was a strategy. We improved the MACD that lost almost 4 to making 8. Okay, so not quite as good as buy and hold, but let's look at some of these other statistics. The VPCI strategy was only invested about 1/3 of the time, 35.6% of the time it was invested. The rest of the time it was in cash. Okay, and so what did that mean is that we had significantly lower risk. Okay, when we applied this strategy. Okay, and people ask me, well, what if you were to invest in T-bills when you were in cash? Then if during that 60 or 60-some% of the time when we were in cash, 65% of the time, if we were in cash and we invested in T-bills, we would have beat buy and hold with significantly less risk. This is the year-over-year returns. Notice that VPCI strategy combined with the MACD only had 2 losing years. Okay, and again, if we were to invest in cash in T-bills during these period of times, we wouldn't have had a single losing year in the course of the study. So what I did I said we're going to give you an update. So here's the update. So this is the MACD, the VPCI, and the ADX. Okay, so people wonder, why did that strategy perform so poorly? And so with this update, what I did is I made a change. And so as opposed to investing in the S&P 500, what we did is we ran this scan not on the S&P 500, but what we did is we took a 5% position in each of the S&P 500 stocks that made the criteria. Okay, so what was hurting this system, this is a trend system, and because the S&P is so diversified, with 500 stocks, it doesn't trend that well compared to individual stocks. So this is the same study. So as opposed to using the index, we use the index components. And what we do when we add the MACD, the VPCI, and a high ADX, okay, we significantly outperform the market. So this is the S&P components, okay, earning 20.7% annualized returns versus the S&P at 9.3%. But we just told you about the TTI. Why would you use the MACD when you got the trend thrust indicator? And when we do that, we not only even add to those annualized return, bringing it up all the way up to 23%. One of the things I want to note here, though, is that look at our end result, $1 million versus 34.4. So even a small percentage in annualized return can make a big big difference in your total return. Okay. Now, I said this thing works because it works better because stocks trend better than indexes. So what index or what index has stocks that trend even more? Well, it's not the S&P, but the NASDAQ. So what if we did the same test as opposed to using the S&P stocks, S&P 500 stocks, and we use the NASDAQ 100? By doing that, we improve our results from 23 to almost 29% annualized return. Okay, and notice here that we significantly beat the NASDAQ, but look at the volatility. We also bring that volatility way down, and the recovery time is 2 years. That means from your lowest point, your highest point to your lowest point, how do you get back to the highest point? Only took you 2 years. If you were in the NASDAQ in 2000, you didn't get back to even until 2011. So it's almost like 11 years where before you broke even. But in this system, it took you a whopping just 2 years. Again, all of this is covered in that Stocks and Commodities article or my book, The Volume Factor, which you can get at buffdormeier.com. So I mentioned before that these studies here are imputed in your Metastock software. Here are 2 studies that are available at Metastock with the toolkit, volume analysis toolkit. And I ran this last night and pulled up the results. And these are this one right here. The results of this scan came up with these stocks that met the criteria. Okay, and so what I did is I pulled these up, and we can kind of go through a few of them together. Unfortunately, the market's been down the last few days, so most of what we have are not new ones. These re-signaled yesterday, but they've already signaled before. So here we have I think this is AGH, AJG, and you can see that we got our first signal here, reconfirmed here, and then reconfirmed here again today. Lennox, I think this is LII. Original signal was here, but again, just yesterday we got another signal on it. This one's new, okay? Mankind just recently signaled. That looks like a beautiful base there and breaking out here. Oppenheimer, I think it's OPP. This signaled here, but look, it just recently broke out and re-signaled. Coastal Financial, that signaled way back here. Okay, by the way, let me give you some information here. This would be a good one. So the green dots, okay, so the green dot is if you were short, this would be your stop loss, okay? The red dot is if you're long, what is your stop loss? So the system tells you not only what to buy, but when to sell through this, what I call this is called the anti-volume stop loss. It's my proprietary selling indicator. Okay, below this here is the TTI that we just went over. Below here is the volume price confirmation, and we didn't even get into this one, but this is the most powerful of all. This is the volume momentum indicator. Okay, so these are the this is actually the setup that you would get if you were into the if you had the toolkit. Red, violet. See, we got a signal here and just recently re-signaled, and Ventas signaled right here, and again, this one's approaching resistance, but we just got a new signal which suggests strength. Okay, so this is my book. This is my second book that just was released here in July. It's The Volume Factor. This says volumefactor.com, but I think that'll take you to my website, which is my name, buffdormeier.com, right down here. And so I also on that website have a free newsletter. We didn't cover any of that information from the newsletter, but with my flash updates, that contains my my market commentary and some calls, and you can sign up from my website to get that for free. So with that, Jeff, I think that's I'm running short on time. So is there any questions or anything like that from the audience?
Yeah, Craig wants to say, Craig asks in the chat, does this mean that we should only trade high liquidity, high volume stocks? What's your take on that?
It depends how much volume you're trading. So if you're trading an illiquid stock and you got a lot of money, you really have to work that trade. So this analysis works on low volume or high volume stocks. Okay, it's not about just being high volume. It's about that relationship between price and volume, and the indicators expose that relationship. So you can, as long as you're not trading, you're not putting too much into a low liquidity stock, you should be all right.
Another question that we have for accumulative volume.
Well, let's say that again. You just cut out on me.
Mustafa asks on YouTube, are you talking about smart money or accumulative volume?
Okay, so there's different ways to parse volume. Okay, so most when you sign up for the toolbox, we're gonna cover them all. Okay, but what's most popular is this volume spread analysis, which looks at charting your stocks based on one bar, one volume bar, one price bar at a time. That's volume spread analysis, where most of the work is done. Most all volume indicators basically take that data and use it to create the indicators. Okay. Now, there was an interesting question because they mentioned smart money and accumulative. Okay, and what I found is, and how my volume indicators differentiate from those other ones, is that I'm not looking at price on a bar to bar, volume on a bar to bar basis. I'm looking at it more on the trend level. So what I'm looking at is not this bar versus that bar or these averages. I'm looking at the trend. Okay, and that makes a significant difference because volume works on those bar to bar on a bar to bar basis. Yes, it's helpful, but you get exponentially more value when looking at volume from a trends perspective. Okay, and that's where these indicators like VMI and volume, VPCI and TTI can really help in the evaluation process, because they're based on trends as opposed to looking at bar by bar.
Let's see, Carlos wants to know, do you have short signals as part of the package?
We do. That's when we mentioned the green dots, that so you can get the shorts and you can get the we can get the longs. I believe we can get the shorts, right? There's a short screen.
Yeah, I saw a short on the chart you're showing. So
yeah, I'm a long only guy, but I know that we build it in there.
Yeah. Is there a particular reason that you prefer longs as opposed to long and shorts?
I'm
curious.
not really. I think I got enough going on with my longs. So
Okay, for sure.
the bias is generally to the upside. I mean, you can if it's a bear market, that would be a different different story. But the bias is, usually you're fighting against one trend when you're going short.
Okay, cool. That looks like all of the questions.
All right, Jeff. Hey, well, I appreciate the time, and wish everyone a lovely weekend.
Thanks for coming in, Buff. Have a great weekend.
All righty, you take care.
All right, you too.
All right, bye-bye.
Okay, let me do this. I'm going to make me the presenter, and I'll show my screen. And there we go. Let me go ahead and turn on. There we go. Okay, very good. I'm going to go back a little bit here. I think I might be a little bit in front of where I wanted to be. Okay, no, perfect. All right. So we did kind of show the indicators. There are 2 different expert systems that are included, and they're, of course, fully built into Metastock, including system testing, scanning. As part of the system, it's 24 unique indicators. And here's a list of them. There's quite a few of them. He talked about the anti-volume stop loss, the VFI. There's a list of all of the ones that are included. Obviously, Buff has a lot of really good experience in the market. The system is called BD Volume Trend Thrust and Volume Trend Thrust Momentum, and they're both part of that Buff Dormeier's analysis toolkit. We do have, what we are offering as part of the package today is normally the cost on this is $149 per month, and you can just go, if you want, you can subscribe to it. It's on our website right now. It'll allow you to go get it, and you'll pay $149. The offer that we're doing here is if you pay for, well, not only are we going to give you a permanent discount, we're going to give you $99 per month on it. If you pay for a month, we'll give you the second and third month for free as part of that. So after that 3 months, so it's $3 for 3 months for $99. After 3 months, you keep that rate of $99 as that special promotional price. So very, very cool offer, because not only are you getting 2 months free, you're also saving $50 every single month for the subscription to it. So to do that, you can go to metastock.com/conf promo. You can go to metastock.com/sales chat, and you can give us a call at 800-882-3040. So without all that being said, give it a go. All right. We are, of course, Metastock, and what you can also do. Greg, there you saying something?
Yeah, I beg your pardon for interrupting. There was one last question. Mustafa, who had asked several good questions during the presentation, was wondering if there's a one-time payment option for Buff Dormeier's add-on, and I didn't know how to answer that.
No, there isn't. Right. But if you do it now, you'll save $50 every single month. There isn't a one-time option for it, Mustafa. Thanks for bringing that to my attention, Greg.
Thank you, sir.
All right. Of course, we are Metastock. If any of the offers that we have, you can get. Metastock's been rated #1 31 years in a row. If you buy a month, you can get the second and third month for free. That goes with all of the subscriptions, including the Buff Dormeier one. Prices for Metastock start at $75 per month. We specialize in helping you find the right trade, find the right trading strategy, get informed in terms of what the strategies are trying to tell you, what the indicators are trying to tell you. A great software, because, and I think that's the reason it's been rated so highly for so many years. To get that extended trial, you can go to metastock.com/conf promo. You can go to metastock.com/sales chat. You can also give us a call at 800-882-3040. We're running a little bit ahead in time. So Greg, why don't we give away a prize?
That sounds fantastic. Let's do that.
All right. Let's see. Let me go. I need to come up here. All right. We are going to give away Jody Samuel's Forex Foundation course. It's a retail value of $299. The Forex Foundation course provides with the following. It'll help you set up a business plan. It'll help you define a system. It'll help you develop a clear trading plan, grow your discipline in trading, and it'll get you to keep yourself healthy. all of those.
I have to say, I really enjoyed Jody's candor and scope of knowledge during her presentation 2 days ago, I believe it was.
She does it. Yeah, she does a really, really good job. So we kind of, let's see, let me go ahead and do this. Let me go over to the prize list. And what I need from you, Greg, is just a number between 1 and 10,123.
Okay, is that all?
Yeah.
Okay,
just
the wheel twirls around to
you can
7.
pick it. Go ahead.
Oh, I'm sorry. You ready?
Yeah, I'm ready.
The Google random number generator came up with 7203.
David, I almost said his full name. David in Mexico, David S. in Mexico is the winner of that prize. So
Congratulations.
If you hear your name and you win a prize, let us know in the chat, because I don't know about Greg, but I absolutely love seeing when somebody wins a prize.
I second that emotion.
That's a cool one too. So, okay, let's go ahead and do that and that. Greg, thank you for the assist on that. I appreciate that. All right. Okay, I knew we were in here somewhere. We've talked a little bit about the CMT quite often throughout the course of the event. Tyler, I'm gonna have you just come on. How you doing, Tyler? Welcome back.
I'm doing great. How are you doing, Jeff?
Good. I'm gonna have you do my job. Are you ready?
Okay, great. I love that.
So tell me, what is the big deal about the CMT thing, and why should I be interested?
Yeah, the Chartered Market Technicians Association has been active on Wall Street for over 50 years, advocating for the advancement of technical analysis. And we work with partners like Metastock, who are at the cutting edge of data visualization, analytics, screening, scanning, and helping investors make better informed investment decisions. So it's an organization that I'm so proud to continue to work with. I took over as the executive director and CEO this summer, and it's been a pleasure of mine over the last 14 years to learn from the very best institutional money managers, traders, and research analysts.
Cool. I always feel like I owe you a little bit of money for doing my job right there.
We'll meet up for a cheeseburger one of these days.
CMTassociation.org. Tyler Wood was in here earlier today. Now he's here more as a CMT representative to talk a lot. What are you talking about today?
Well, we're going to talk a little bit about some of the core concepts that are in the CMT program. Part of what we do as an organization is this credentialing program. So it's education and examinations for folks who want to learn a lot more about technical analysis.
Cool.
Yeah.
I just sent you the screen share. I can see. Are you in this picture somewhere?
I'm down here in the lower right-hand corner.
I see you. Okay. All right. It's all you. I'll get out of the way. Thanks for coming back.
Thanks so much for having me, Jeff. What an awesome conference all week long. And congrats to you and Greg and the whole Metastock team. So thank you all for sticking around. I know it's Friday afternoon. We're going to come up on the market close here in a couple hours in the US. But you're taking time out of your schedule to continue to learn about process and tools that will help you as an investor. And I just want to applaud you for being on the right track, focused on your learning. And this picture that I thought I'd start with is taken from the Bell Podium at the New York Stock Exchange. Most folks that know about the Chartered Market Technicians Association think of it as a large global body, kind of the leading authority in all things technical analysis. And it might look like an overnight success, but this organization started with just a few very passionate individuals. This gentleman right here is Ralph Akampora. He and a number of co-founders got things started in the late 1960s. So, you know, back your mind up to a time when there were no computers, there was no Metastock, there was no ability to chart the markets except by hand with pencil and paper, and computing every single indicator mentally and drawing those into the charts as well. So the discipline continues to evolve, but at its core, this community really just stands for professionalism and ethics, competency in a broad body of knowledge. And that's what we're going to talk a little bit about today. Just by way of introduction, I'm a representative of a lot of very hardworking men and women from around the world. And CMT Association exists to do a number of things, including that credentialing program that we'll talk a little bit about this afternoon. But we work with regulators and with media outfits, and we work with financial advisors and algorithmic traders. We work with exchanges and you name it. And that picture was from our 50th anniversary. The New York Stock Exchange asked the CMT Association to celebrate with them that important milestone, but also recognize that this community of individuals have had a huge impact on markets, including market structure changes as we moved into decimalization and eventually into electronic trading. Things like how the indexes are constructed. There have been a lot of important thought pieces and opinions from this community and from the board of directors. And actually next week, Jeff, I get to celebrate another important milestone, 20 years since FINRA recognized the CMT credential with equal weight to our fundamental colleagues on the valuation side, the CFA charter holders. They only recognize, FINRA, the highest regulator in the United States, only recognizes 2 designations for the exemption on the Series 86 exam, because they went through not only our body of knowledge, our examination practices, how questions are psychometrically evaluated and all the rest. So we have some of the founders coming back with us next week in New York City. We'll do a closed door meeting with FINRA all day on Thursday, as well as the celebration Wednesday night at the Bloomberg offices on Park Avenue. So if you're in New York City and watching today's session, please feel free to join us. I'd be happy to get you an invite. You can shoot me an email, tyler@cmtassociation.org. So from that very humble, small beginnings of this organization, we have expanded globally with offices in Mumbai, Toronto, and New York. We have members in over 137 countries around the world, and roughly 35,000 folks who are participants in all of our educational offerings. We do weekly webcasts. We publish daily market commentary, monthly magazines, annual double-blind peer-reviewed academic-style journals, and much, much more. So if the credentialing program is a bit of a big bite for you to take off right now, I welcome you to join the organization as an affiliate member and just participate in some of that educational activity that we offer. Doing these conferences with Metastock is absolutely on brand for us. We love learning, and glad that you're here with me. As I mentioned, we do a lot of different work across the industry, not just with investment management, but also with academic institutions. I'll mention our academic partner program towards the end, but if you're a professor or faculty listening to today's talk, by all means, please reach out to us. We'd be happy to get you and your university involved in that. Little shameless plug, because I'm on here and because we love free educational content. One of the greatest joys I have is sitting down each month with some veteran portfolio managers, research analysts, strategists, global macro folks, systems designers and developers to talk about their process and tools. We do that in a podcast called Fill the Gap. It streams everywhere that you might find podcasts. And so if some of what I'm talking to you about resonates today, don't take it from me. Tune in to Fill the Gap for those sessions with expert money managers, and we really dive deep with them in those interviews. I think you'll get a lot out of them. We also, just this year, took our annual flagship conference, the CMT Symposium, out of New York City. That had been a running tradition for many, many, many years. And we moved it to Dubai. And that really reflects the international growth of the organization, and certainly moving an office, opening an office in 2018 over in Mumbai was a big part of our Asia Pacific expansion. But we'll be back in Dubai next year. First week of October, we host a lot of live conferences and events as well. So if you are tuning in from around the globe, please join us in Dubai. We'll have a lot more information coming out about that 2025 Global CMT Summit happening in Dubai in the United Arab Emirates, the first week of October 2025. All right, enough about who we are. Let's talk about what we're going to dive into today. I'm a pretty simple guy, so I've got a very short list for us to get through. Number one, we have to define technical analysis. I think a shared common understanding of the discipline that we help define is important for how we characterize technical analysis, what fits in that umbrella, that body of knowledge, and hopefully we'll all gain that shared common understanding. Then I'll dive into a few tools that you could think about in your own investment strategy building. And finally, we'll talk a little more specifics about the CMT program. So let's dive right in. First up in the agenda is, what the heck is technical analysis? There's a little abacus there because yes, there's a lot of math involved. But for most technical analysts, or for most folks, what immediately comes to mind is a chart, a form of data visualization. And you're not wrong. About 250 years ago, in the rice pits of Osaka, Japan, there was a gentleman named Munehisa Homa who understood that price action in rice trading definitely was impacted by the seasons, holidays, the behavior and mood of the traders in the pits. And I love that story of him observing that trader behavior had an impact on price, particularly for something like a grain of rice, right? Separate your mind from maybe the equities investing that you might be focused on. The value of a grain of rice doesn't really change except because of supply and demand. Each grain is worth the same amount as the last grain. There's no innovation and technology there. And that gentleman found a way to capture price action and display it for himself and his traders in a way that helped them become immensely profitable. If you've ever looked at a candlestick chart, you can thank Munehisa Homa for inventing that way of looking at price action to give himself an edge. But in terms of definitions, why don't we start with perhaps the godfathers of Western technical analysis, Edwards and McGee. They wrote about the study of the action of the market itself. And when I first moved to New York in 2011 and started working with the CMT Association, I was a fresh grad from an MBA program at the Kelley School of Business at Indiana University. Great school, great institution, and incredible education. But it was almost entirely focused on how companies operate. All of the data and statistics, things like balance sheets and financial statements, really tried to understand things like return on equity, valuation principles, discounted cash flow statements, and that is all very important information. There is also incredibly important information coming out of the market itself. So if you're trading liquid vehicles, if you're an investor in public markets, perhaps more than private equity or private debt, then you're studying the action of the market itself. We also know that technical analysis is the study of supply and demand relationships for shares or contracts, and we'll do a little Econ 101 before I dismiss the class here in the next hour. And I'm going to pull up one more definition. This comes from Perry Kaufman, who's currently a widely cited author throughout the CMT curriculum. And he talks about the systematic evaluation of price and volume and other statistics. Now, systematic trading or algorithmic trading, I would argue all of quant finance is an extension of and a way to express technical analysis ideas. But the core thing that develops an edge for any algorithmic trader, any systematic fund manager, is going to be observations on either corporate fundamentals or on market statistics. And so everything that I'm talking about today is part of those first principles that you have to understand about human behavior and market action that will give you perhaps a lead on where to go do some data mining, how to think about your execution plan, whether it's discretionary or systematic. And if you are, like me, a builder of algos, and I talked about that in an earlier session today, what you're going after are core concepts in technical analysis, and what comes out the other end, what is coded up into a systematic strategy, really has its root in understanding market behavior. So that's what we're going to talk about today. More importantly, is technical analysis just a chart? I think it's a pejorative sometimes on Wall Street when they talk about, oh, chartists, that they're just data visualization people. There's not a lot of additional rigor. And Robert J. Farrell, the first president of the organization, was the chief equity strategist for Merrill Lynch for many, many years. They actually, Institutional Investor had him as the #1 ranked strategist for decades. And this gentleman talked about technical analysis as a very broad body of knowledge. Things like macroeconomic impacts and intermarket studies, cross-asset relationships, things like price and volume and statistics on the market. Merrill Lynch in the 1960s also had access to things like the odd lots, looking at sentiment indicators of where retail traders were positioned. There's a ton of information that comes out of the markets, and that trend continues. When you look at the options markets today, there's a wealth of information. Even if you're not a derivatives trader yourself, those data sets are incredibly powerful for looking at sentiment indicators and positioning and all the rest. So how do we at CMT Association define technical analysis? Well, we believe that technical analysis provides the tools to successfully navigate the gap between intrinsic value and market price across all asset classes through a disciplined, systematic approach to market behavior and the law of supply and demand. And that's a lot of big words, and for us, the marketing team came up with a nice little infographic. And what really started the small committee of volunteers to articulate that mission statement was the blog writings of Aswath Damodaran. Now, Professor Damodaran is an NYU Stern School of Business expert in valuation. This gentleman lives and breathes discounted cash flow. And in the world of valuing companies, there are a lot of items which are very difficult to quantify in a DCF. When you look at valuations of companies like X or Uber or a lot of disruptive technology firms, you start to see that market price isn't really attached to the fundamental value of that firm. And so Dr. Damodaran started exploring this question: why is the market so often wrong? Why is price so much higher or so much lower than our valuation estimates of intrinsic value? And that question led him to understand there were two forces at play. There are the drivers of value, things like accounting estimates and valuation metrics. And then there are drivers of market price action. And those include not only all of this information, but also sentiment and supply and demand relationships, and that the behavior of market participants can in fact impact price action. So Ralph Akampora told me very early on, he said, Tyler, if you're ever teaching anybody about technical analysis, go ahead and use some of my slides. Ralph was a professor at the New York Institute of Finance for over 40 years. He basically taught everyone on Wall Street for more than a generation how technical analysis works. Now, when Ralph was lecturing in the 80s and 90s, he was often using IBM as the mega cap name of the day, large equity position. Let's talk about Apple for today's example. And if you were an analyst or an investor and you're starting to think about whether or not you want to own shares of Apple, your research process might start with the company, and there's nothing wrong with that. You would look at valuations like price to earnings, price to book, price to sales, and a lot of other ratios that you could assess or estimate what the intrinsic value per share is for the company Apple. You would also look at their management team and their balance sheet, look at the quality of the company, how much debt they have, is the executive leadership of this group very efficient or very inefficient at allocating capital throughout the team? Do they have good strategy? Are they able to execute on that strategy? You would certainly look for the growth story that's going to propel the stock move beyond what your intrinsic value estimate is. You might look at return on equity. You might look at margin expansion, something that explains the growth story and helps quantify how much of a premium you're willing to pay. And of course, you care about their products, not just the phones, right? But also Apple streaming services and other businesses that they're getting into. I know right now the onslaught of artificial intelligence, seems like everybody has put .ai after their company, kind of reminiscent of the 90s when everything became a .com. But you're going to look at those products to understand the future cash flows, which help you derive that DCF statement and the intrinsic value estimate. And finally, that last one that I pulled up, competition. You want to know how Apple is faring against Samsung, but competition could also include things like the regulatory environment. Are they winning lawsuits around IP infringement or not, right? There are competitive forces even beyond just other companies in their space. All right, but your analysis, as you notice, is only halfway there, right? And for all of us, when we look out of our eyes, we use two eyes to get a complete picture that gives us depth perception. So I'm not here telling you that all of this information in the top half of the graphic here is irrelevant. I find it very, very useful. But technical analysis completes the story. It gives you some depth perception by using two lenses to get a composite picture. So your analysis continues. You got to understand the stock. And unless you're one of those huge PE firms, you're not buying the whole company anyway. If you're like me and any average investor, you're buying shares of the company. So you got to understand what that stock is priced at. Where is price relative to its historical price ranges? How is that faring next to other opportunities for your investment portfolio? You're going to look at volume. At the rate and at the price point that this stock is trading, is there a lot of participation either to the upside or a lot of participation to the downside? You care about things like open interest. You can look to the futures market and the derivatives markets to understand some positioning and some sentiment. You're going to look at supply and demand, not just for shares of Apple, but how about for the technology sector in which it sits? Or how about equities versus other asset classes like commodities, cryptos, fixed income, you name it. So the supply and demand relationships are critically important for the sectors, industry groups, and individual securities. And then there's the psychology of the market. And I spoke a little bit about this earlier. What is very challenging for the fundamental side is understanding just how the mood of investors can impact price. And to help me explain this next step in our equation, I'm borrowing from my co-host on Fill the Gap and incredibly well-seasoned veteran portfolio manager, David Lundgren, who has spent an illustrious career both doing research and running portfolios at some of the largest institutions in the US. And he spent a lot of that career surrounded by colleagues who have a strong fundamental bias to their work. So he explained that in the world of investing, you could roughly group PMs into three categories. There are those who follow price trends, right? Trend following investors or CTAs, they're focused on price. You also have growth investors, and they're focused on what that story is of expansion and innovation. And then you also have value managers. So growth and value kind of dominate the landscape of investable mutual funds and ETF products that are out there. And those three styles of investing, trend following, growth investors, and value investors, come together in this very elegant equation that Dave developed. And he said, not only are we not at odds with each other, but we actually depend on each of those styles for our investment strategy to work. So the price of a share is the components, right? It is the sum of the growth factors multiplied by the value factors. And those two on the right side of the equation have to be improving for long-term price trends to move higher. And if you ask any charter market technician, any CMT charter holder, they will tell you that long-term trends are driven by the fundamentals. Nobody denies that. All right, so we're all in this together. Each side needs the other side's cooperation in order for our investment strategy to deliver on our objectives. Now, there is one more component to this equation, and that's right here, behavior or sentiment. And so when we are in a raging bull market, that B, the amplifier to the power of, can be any whole integer north of 1, right? At the raging end of a market bubble, that euphoria, that enthusiasm can multiply any positive news on this right side of the equation, either the growth story or the values, by a multiple, driving price incredibly high. And contrarily, in a bear market, the behavior, the mood, the psychology, and the sentiment of investors can be under 1, right? So we're amplifying to some fraction, right? 0.5, 0.2, where people are really despondent. So it doesn't matter then in those situations how great the fundamentals look for any individual equity. If we're at the end of a bear market, nobody wants to be a buyer. And so price can only go lower, even when these factors are delivering what should be a driver of price trends in the upward direction. All right. So that behavioral impact is an amplifier. It's a magnitude of what's happening on the right side of the equation. Now, the important differences, yes, we are all in this together. We are dependent on both forces in order to get value out of our investment strategy. But the perspective on how we approach markets is very, very different. I referenced Dr. Damodaran because his blog posts were all about why the market is always wrong, so often wrong. And as technical analysts, we come into the office every morning and we look at our charts knowing full well that the market is absolutely right, because price is a reflection of all of the known information that we have on the fundamental growth story, on the valuations of the companies, everything that Wall Street has poured over and digested and chopped into a million pieces and put into their models. Everything that's known, plus everything that's unknown, right, to us, if we are willing to admit that we don't have particular insight on wind energy or on widget manufacturing or on software as a service businesses. And then it's also capturing, price is also capturing not just the information we know and what we admit that we don't know, but those things that we can't possibly know. And that's really powerful. The other major distinction in how the perspective is different is in the complexity. So if we were to imagine this as a hyperlink, right, and we want to go into the growth factors that drive growth managers to invest, we would click that hyperlink and it would open Pandora's box of so many different ways that we could look on at margin expansion. Well, let's define what margins are we talking about? How about free cash flow? Are we looking at EBITDA? Are we looking at other metrics on the balance sheet? Same thing on the valuation side. There are tons of different ratios we could look at to value a company. And so there's a tremendous amount of complexity, a lot of estimating that goes into the models to figure out an estimate of intrinsic value or a thesis around what the growth story is. But on the left side, it's just price. And price is never an estimate, and it's never restated. It is a fact, and it's a rapidly produced fact. We can see price action throughout the day, every day, during all, across all asset classes. It's the same variable, and it's very elegant and simple in the way that it speaks the truth about what investors are willing to pay per share of a company or for units of commodities. And that is a major difference. One of the things that first attracted me to technical analysis is its accuracy. You can pinpoint the closing price every Friday afternoon, which we will in about 90 minutes from here on US equity markets. And so in summary, all technicians agree how important the right side of this equation is, but it is price that encapsulates all that information and gives you actually the only variable out there that can quantify the behavioral element. And I find that really powerful in my own work, and as I talk to investors all over the world, there is a wonderful sense check on all of your fundamental work about whether or not the market sees what you're seeing. So Dave goes on from here, thinking about portfolio construction, and he's got a very simple set of rules. He also cares deeply about what's happening on the right side of the equation. And so in this little Venn diagram, we can see the quality of the fundamentals, the valuation side, and then the price trend, which you can develop lots of different strategies around what you're looking for as a trend follower. But it's at the center of this Venn diagram when all three components are working really well. If we could fill a portfolio with nothing but number ones in this little matrix, that would be fantastic. What's often in portfolios is something where the growth story is working and the price is trending, but maybe the valuation side is getting a bit expensive. That's okay. right? Things can be overvalued much longer than you can stay solvent, or things can be undervalued much longer than you can stay solvent. Or maybe the growth story hasn't really emerged yet. We don't really understand how this technology is going to disrupt the environment, or what this company is doing that's going to change the face of their industry. But the valuation is strong and the price is trending. The story often comes out after the fact. And then in Dave's portfolios, there may be some things that are trending and outperforming, but neither the valuation nor the quality of those fundamentals are particularly attractive. And that's okay. Sometimes it's after the fact that those stories come out. What exists up here outside of this price trend circle are things that stay on the watch list. So something might have a great quality of fundamentals, great growth story, and when it starts to trend, when it breaks out, then it'll show up in the portfolio. So it's a way to think about using both disciplines in concert. I certainly wouldn't tell anybody that fundamentals don't matter. You shouldn't look at it. You don't care what the companies or industry groups that you're investing in. That's not my message at all. But at the end of the day, if we are trend followers, we need price action to be moving higher in order to make money. Same thing is true for value investors and growth investors. At the end of the day, we all need prices to be rising in order for our strategy to make money. All right, that behavioral component, we could go on and on all afternoon. Every year I reread a book by Daniel Kahneman called Thinking Fast and Slow. It's one of my favorites, talking about System 1 and System 2 thinking. System 1 being those mental shortcuts, the reactionary fight or flight mechanism that sort of circumvents your actual thoughtful, cognizant impact of your left brain thinking. And in markets, that is very, very true. When we reach a fever pitch of a bull market, very irrational moves can be made by investors. And that's why Daniel Kahneman won the 2002 Nobel Prize in Economics, despite not even being an economist. He's a behavioral psychologist. Now, that behavior of investors, particularly at irrational extremes, could also be expressed as a simple supply and demand equation. And so I'm taking you all back to Econ 101. You'll remember that at a fixed rate of supply, an increase in demand will push us up the price equilibrium. So increasing demand moves your price higher. A decrease in demand will move your price lower at a fixed rate of supply. All right, the person who said this best is Mark Abraham. He's a tremendously successful trend following investor, and he said, ultimately, it is the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down. And that consensus is revealed by analyzing price. So let's take a look at a couple of examples of what Mark Abraham is talking about. How about anybody here remember the meme stocks? Do you remember 2021 and the irrational behaviors that were taking shape? Here we have the short squeeze that moved Melvin Capital out of business. This is a chart of GameStop, and right up here it was over $200 a share. GameStop is a video game rental business with brick and mortar stores, and by any fundamental valuation metrics, it's no more than a $6 stock. You can't justify paying a whole lot more than that. So how on earth did GameStop trade above $200? Well, that's supply and demand. And all of the Reddit subthreaders, Roaring Kitty got an army of traders together, and they held beyond what was rational as Melvin Capital and other hedge funds were shorting this stock because it was so ridiculously overpriced in their valuation estimates. And they did what nobody expected them to do, which was to hold on, acting not in their self-interest, not dumping the shares, but holding on for dear life. And those diamond hands retail investors squeezed Melvin Capital and all of those short sellers out of their positions, and you saw another explosive move higher. I just want to point out earlier in 2024, we saw a tweet, maybe a little pop of activity from Roaring Kitty, and look what happened to the price action in GameStop yet again. It was perhaps a very quick, violent, volatile move, but that was an immediate reaction from the supply and demand narrative around GameStop. So keep that in mind when you're thinking about, what you're investing in. Part of what drives price is market behavior of all those participants. I also want to point out, I think earnings releases are important, but they are not a crystal ball. So if right now we're looking at a chart of NVIDIA as it was coming up to the August 28th earnings release, and price had been pretty beaten down. We broke through the short period moving average. We broke through the long period moving average. The 50-day moved above the 200-day, and price held above both, right? That looks like a pretty solid uptrend, a little consolidation at the top. It's ready to break out. And go ahead and shout it out at home. Does anybody remember what happened on NVIDIA's earnings release? They beat expectations. They beat Wall Street estimates. So what should happen next? Should break out to the upside, right? Should be a roaring breakaway trend to the upside. But instead it lost 30% after beating earnings, after all expectations about what that company could do for the AI revolution as a semiconductor manufacturer. It traded down more than 25%. So what I'm illustrating to you here is that even if you had tomorrow's newspaper, even if you knew right now all the companies that were going to beat analyst expectations on their earnings calls, you wouldn't know how the market might digest that news. Another great example, in September, Jerome Powell and the Federal Reserve Bank of the United States of America began cutting rates. What has happened to the 10-year yield since then? It's gone nowhere but up. So what we think we know, what we expect to happen, doesn't always happen, which is why we use technical analysis to keep us on the right side of trends. All right. All right, so what are our objectives as CMT charter holders, as technical analysts? We want to participate in trends. We don't want to predict them, anticipate. What happened last week and after the US election was a really remarkable market rally. And I'm guessing 4 years from now, in the weeks leading up to the next presidential election, somebody with some memory is going to say, right, everything's going to break to the upside because my candidate's going to win and I know what's going to happen next. Nobody knows what's going to happen next. And if you are watching some educators that tell you they can predict the future, please head the other direction. Responsible practitioners will talk about probabilistic outcomes, not deterministic outcomes. They're going to think about how to put probability on their side, take the best possible position within the available information, and that's the best that we can do. But reacting responsibly without emotion is critical. So let's move on to our second section. Let's talk a little bit about the tools that we can use as investors that come directly from the CMT, Chartered Market Technician Program. All right. Most importantly, risk management. So again, I'll just cover 3 because we don't need a laundry list of things. We'll talk a little bit about multiple time frame analysis, the perspective that a chart will give us on securities, particularly if we look at it across multiple time frames. We'll talk about the concept of relative strength or ratio charts, and those I hope you are using already. I hope you're using multiple time frames already, and if not, this is the exact right talk for you to be listening to. And then we'll talk a little bit about market breadth, because that has been at the top of so many analyst opinions all year long, particularly those who were fighting the trend. One of the clear points they made was that the market was being led by such narrow leadership. So we'll get to market breadth here in just a second. Multiple time frames. One of the beauties of technical analysis is that you might be an intraday scalper, and my clients might be long-only institutional portfolio managers. The concepts and tools, the indicators that we would both use to analyze markets are calculated in the same way. They give us the same information across all time frames. And that's really powerful. That's really something that we can use to our advantage. So to help us understand multiple time frame analysis, we got to go back to the godfather of Western technical analysis. All props to Monohisa Homa in Osaka, Japan, for inventing candlesticks. But Charles H. Dow, who was a journalist by trade and father of the Wall Street Journal, as well as the Dow Jones Indices and you name it, took a number of notes. He had a lot of opinion pieces that were being published that were later compiled into the Dow theory. One aspect of the Dow theory was that markets move in observable, multiple timeframes. Now, as a journalist by trade, he was also a very accomplished sailor, and he used nautical analogies to help explain what was going on in the markets. Keep in mind, Charles Dow didn't have Metastock. He didn't have powerful computing tools. He had ticker tape. So pretty impressive that he could step back and observe what was going on in markets without all of the technology that we have today. So backing up, the primary trend of the markets, which Charles Dow compared to the tides of the ocean, unflappable, unchanging based on the day-to-day mood of investors or information that comes out week by week. This is the long-term trend, and it's driven by expanding GDP, by the underlying fundamentals of the companies and industries that we're looking at. And this doesn't waffle in the wind, it's very, very steady. And you can look at very long-term charts to see the upward drift in the equities markets. And year by year, you might see bull markets and bear markets over multiple cycles, multiple decades. You'll see that the markets move through these cycles. That's the primary trend and the tides of the ocean. Now, Charles Dow also observed the secondary period, which he compared to the waves of the ocean. And he said that you'll see prices trend well above and well below that average of the primary trend, that move. If you think about a very long-term moving average, that's kind of defining your primary trend. The secondary trend might be a very short-term moving average. You might look at price action that moves above and below, sort of a longer period smoothed trend line. That secondary period is often where a lot of technical analysts and tactical money managers have made hay, because you can observe where markets become despondent and find points that it might mean revert back to the primary trend. You can also spot moments where the trend has accelerated beyond what was the primary position of that trend, and you can look for mean reversion to the downside. Finally, Charles Dow identified this minor period or the tertiary trend, and he talked about the ripples on the surface of the water. Those are the day-to-day fluctuations, the interpretation of investors to the news of the day. We hear about war breaking out. We hear about hurricanes coming our way. We hear about contentious presidential elections or presidential elections in foreign countries that might impact our commodities markets and the resources that we import, on and on and on. Whatever that news might be, it can shift price action. But the range of moves on intraday price action is relatively small, and we'll see that move above and below the secondary period, right? So it's fractal. The minor period is moving above and below the secondary period is moving above and below the primary period. What I'm arguing to you all is that in your practice, you should have multiple time periods that you are looking at for every chart that you're considering trading. There's a tremendous amount of information by overseeing, looking at a broad view of the primary direction of the markets. And if you're a mean reverting trader, if that is the style that works best for you, you want to pay attention to what the primary trend of the market is. And if the primary trend and the secondary trend are to the upside, then you're going to want really tight risk management on mean reversion moves to the downside. If you're short trading in a bull market, you better have your foot on hovering over the brakes. All right, so let's take a look at that in practice. Here's the S&P 500 on a weekly candlestick. We're in a bull market, friends. Happy to report on that. We've got the bear market of 2022. We saw price come down and test that 200 period weekly moving average, and price moved back above the shorter period, 50 period moving average, came back to retest, and has yet to come back to test even that shorter period moving average. So primary trend to the upside in US equities, at least for the S&P 500 index. But if we know that's the case, we're in a bull market in US equities on the longer time frame, let's drill into the daily time frame. And for most of you, you might be trading shorter periods, not just long-term investing. For you, these daily pullbacks that broke the 50-period moving average might have been opportunities for you to get out. That might have been against your risk parameters to stay in a trend that had pulled back below moving averages. You can also look at momentum. I've got an RSI on the bottom of this chart. These are instructive in seeing that the longer term trend is to the upside. Our daily period, what looked like very little pullbacks on a weekly chart, look a bit more destructive on a daily chart. And certainly if we went back in the historical view on this daily, looking at this bear market activity in 2022, we would have seen these relief rallies as major upside moves and things we probably would have participated in if we are shorter term traders. But if you're a long-term investor, you would not have gotten back in during that bear market activity. All right, so daily, and then we could drop down to maybe a 65-minute time frame, 6 equal bars per day. Intraday activity on the S&P 500 today has been sharply to the downside, and we gapped lower. We're coming to close the day in about an hour, probably near the lows. So not the most constructive, but again, if you're a longer term investor, this smaller move on the minor trend probably doesn't impact your investment decisions until it materializes on your weekly chart. Now, if you're a longer term investor and you're looking for an opportunity to participate in a trend that you're not already in, you might dive into these smaller time periods to get a better execution. Find that spot where the daily and the intraday chart start to align with your longer term view. All right. So let's move on. Let's talk about the second item, which is relative strength. And I've got some great illustrations for you. Martin Pring just talks about, comparing, dividing one chart by the other, one price action by the other. But I think it's best explained in a chart. So let's just compare growth versus value. And as a lot of portfolio managers, wealth advisors, they're going to look at style boxes for their clients. Do we want to own growth? Do we want to own value? Do we want to own large cap, mid cap, small cap? They're not necessarily doing individual stock picking as many of you might be. So if we wanted to just get an understanding of what style was working, we could use relative strength to our advantage. And to illustrate what it is, let's just say we took these two indices, the growth stocks and the value shares, and we just laid them out side by side, and we could eyeball that, this was the pandemic crash, and then they both recovered very well. Growth seemed to draw down a little further than value, but they were both headed lower, and then they both recovered again. Not a whole lot of information you can glean by eyeballing two charts side by side. So we use a relative strength line. We plot growth divided by value, and that gives us this line in the bottom. That's the relative strength chart. And when the line is moving up, we know that growth is outperforming value. When the line is moving down, value is outperforming growth. So a couple key points to think about when you're looking at ratio charts or looking at relative strength. They were both in absolute downtrends. Prices were falling throughout the COVID pandemic. These are weekly bars. This is a 5-year view, so it's very difficult to see the detail. But what's shocking is that the outperformance of growth versus value began before the pandemic collapse. Weeks, months before, we started to see growth outperforming, and it accelerated through the downtrend. So relative to value shares, growth stocks were going down less. And as a portfolio manager for clients, your relative performance is most important, right? If the market dropped 40% and your clients were only down 10 or 15, you're a hero. And that is very important to institutional managers. It should be very important to you as well. So the relative chart is not an absolute trend. But most importantly, we can look at the trend of that relative strength line to see where we should be positioning. It makes perfect sense in hindsight that the market knew what perhaps we didn't know or weren't willing to admit. When you think about growth equities, those tend to be characterized by things like technology, consumer discretionary, communications, all the internet stocks. Zoom, the stay-at-home trade, all those things that could continue to operate when the entire global economy shut down. Value shares, by definition, are oil exploration and drilling, manufacturing facilities, a lot of the things where people were sent home from their jobs because of the health crisis. So it makes sense that growth outperformed value. And isn't that amazing that the market sniffed that out before any of us even knew what a KN95 mask was? All right. So the trend of those relative strength lines matters greatly. I'm going to cruise through a couple of these in the interest of time. We've got about 10 minutes left. But if we're thinking about relative strength, we could take a list of all the industry groups of the market. We could rank them based on their trend and momentum, right? So we could give them a technical ranking. And then we could look at the quality of their growth story, the profits of those companies, and the valuation metrics. That's what's in this table. So a generalist portfolio manager is just going to rank them, right? If you're a trend follower, you want to own the things that are trending higher and at least underweight, if not short, the things that are underperforming. But if we compare, so sorry, I'll back up there real quick. At the top of this list, we've got semiconductor manufacturers, chips makers. And there's an observation to be made about the market environment right from this table. And that is what is trending right now have expensive valuations, right? They're poorly ranked by their valuation metrics. The things that are cheap for a reason. They're downtrending. So the market right now in this snapshot cares about companies with strong growth and profitability, but the market doesn't really care if they're overvalued. Hold that thought for a second, right? The environment can change over time. Sometimes valuation matters way more than the growth story, and that's what trends higher. By looking at what the market cares about, first and foremost, you can understand the environment in which you are investing in. All right, so chips manufacturers were at the top of that list. Let's take a look at some relative strength charts, right? This is the semiconductors ETF, so the industry group, relative to the S&P 500. Of course, this is the pandemic crash. Everything was moving lower on an absolute basis. But look at that relative strength line, holding with the broader market and accelerating higher. Okay, so now let's take a look at the constituents within the semiconductors, the chips manufacturers. 15 different companies, all of the names removed to protect the innocent, and because you should, in this kind of process, you are scanning and screening for the things that are working. So a generalist portfolio manager might say, yeah, I want to own semiconductors. And ETF vehicles make it very easy for a lot of investors to just own the whole industry group or the whole sector or even the whole index without worrying too much about what's inside. For research analysts on Wall Street that are helping their portfolio managers make sound decisions, they need to rank all of the semiconductors manufacturers from top to bottom, longs, shorts, or at least overweights and underweights. And they're doing that on the exact same relative strength basis. So I was showing you growth versus value. You could look at any company relative to its industry group, any industry group relative to its sector, any sector relative to the broader index, or you could just compare, do I want to own Apple or Microsoft? Well, let's take a look at the relative strength chart, and where they start to diverge, you know who your winning pony is that you want to be betting on. All right, so here we're taking chip manufacturer number 1, the top of that ranking, and number 15. Ooh, a little bit of a difference going on there. And that difference is probably all going to show up in the right side of our equation, right? The quality of the growth factors or the valuation, something's off with company number 15. Look at the relative strength lines. Blue is relative to the S&P 500. Red is relative to other semiconductors. Well, let's look at chip company number 15, right? Relative to the S&P 500, yeah, the blue line was falling. Now it's kind of flat. Relative to other semiconductors, it's negative. So it's underperforming its industry group. And as you are trying to narrow your field of investable opportunities, you can use relative strength to narrow in on those that are outperforming either their group, their sector, or the benchmark index. you want to beat the benchmark, you by definition need to own the things that are outperforming the benchmark. All right. That's relative strength 101. We can go through lots of other examples. Even in a bad industry group or sector, there are leaders and laggards, and they might be relative underperformers to the broad index, but outperformers to their industry group. That's a company that we might want to invest in based on its outperformance of its peers. Remember, I talked about ETF vehicles. A lot of investors simply own the whole basket. So if there is an individual company that's departing from, it's behaving differently, outperforming its peers, that's going to be the ones that we want to look for in the change of environment where their group starts working. All right, I know I'm moving fast, but we got to get you back to Jeff here pretty quick. Last concept, breadth. Now, I'm going to date myself here a little bit, but as a kid growing up, the greatest sports franchise in the world were the 1990s Chicago Bulls. I mean, oh my gosh, right? Sorry for all you Steph Curry fans, but Michael Jordan is forever the GOAT. Now, the Chicago Bulls had Jordan, incredible star player. I mean, will be in the history books forever. He has his own line of shoes and was the first to do so. But the championship winning team is built not just by having one star player. They had a very deep bench of excellent players who each had a job to do and did it exceptionally well. Best in the league, Scottie Pippen, Dennis Rodman, the list goes on and on and on. Market breadth is the idea of how deep your bench strength is. If your index is going to be winning championships, it's got to have a lot of participation. So we're looking at not just a stock market, we're looking at a market of stocks, and we care very much about what's happening under the hood of the broad indexes, particularly because they are cap weighted, meaning there's a much bigger influence of the largest companies on the index than there are from the smallest companies. So it gets hidden from view what those small companies are doing. So here's a quick illustration. Again, textbook example from the pandemic collapse. This is the Russell 2000. We're looking at weekly candles here. And just before we fell off the cliff, look what happened to the advanced decline line. Advanced decline line is one way to measure breadth. We'll talk about a few. We could look at new highs and lows, the advanced decline line, other ways to characterize breadth. Number of stocks making 50-day new highs, number of stocks above their moving average, you name it. What's shocking to me is that a lot of investors only care about the top level index. They only look at the S&P 500 and think that's the only way to look at how the market is doing. Or maybe they look at the NASDAQ and even NASDAQ 100, an even narrower sample and more heavily weighted to the largest capitalized firms in the industry. Russell 2000, pretty broad basket of firms, 2,000 of them. And so when the breadth measures tanked ahead of the collapse, multiple weeks ahead of the collapse, what it's telling us is that the average stock in the index began its bear market collapse before the index itself showed those signs. So we care about what's happening internally to the market. What's happening to the average company matters. Similarly, look at this rally in the Russell 2000 out of those pandemic lows. Pretty incredible, but this whole period, there was almost no expansion of breadth. So the large firms got a lot better quickly. And then here we saw the index just taper off. Market's going nowhere. It's stagnant. We're trading in a flat range. Nothing good is happening in the Russell. But look what was happening under the hood. Tremendous rotation of leadership, more and more stocks participating to new highs. And just because they're smaller by cap weighting, it doesn't show up at the index, right? And maybe what we're seeing right now in the S&P 500 might be an interesting observation for all of us. This is the S&P 500 on an equal weight basis. I'm using the ticker symbol RSP. You can find equal weight charts of absolutely every sector, industry group, every index that's out there. And it's helpful. And a lot of the Wall Street analysts that I know very well, my friends, use equal weight charts to remove the bias of cap weighting, right? If you look at it, the SPY, an ETF of the S&P 500, it's fully weighted to those Meg 7, those top weighted names in mega cap tech. What's happened to the average stock? And I'm going to zoom in here for you a little bit. I threw a very simple horizontal trend line, right? It was resistance, and we've basically been in a bear market for the average stock until 2024, right? We just had a breakout and a retest of this very important resistance area in 2024. So we were all celebrating the third year of the bull market. A different way to look at it is this bull market just started this year, and it's just accelerating in these last couple of months. So another way to think about breadth is to look at indices and sectors on an equal weighted basis to remove the bias of market cap weighted indices. All right. Last but not least, divergence analysis. I am sure I'm speaking to the choir, but you can use any number of technical indicators below your price panel to see if trends are sustainable. The whole concept here is as price is making higher and higher highs, we're looking at a momentum indicator or a breadth study or you name it, making lower and lower highs. So we have a bearish divergence, right? The move in price is less and less supported each time it strikes a new high. Difficulty with divergence analysis, you don't know if this is going to happen 3, 4, 10 times before you actually see a move in price. Contrarily to bearish divergences over here, we have bullish divergences where price makes a new low, but momentum, there's less and less enthusiasm as price is making new lows, and eventually it reverts to the upside. So that's a bullish divergence. The mother of all divergences that I've ever seen on any chart. This is, let's see, this is right about when Tyler was born. So I top ticked the bond market. This is the 10-year treasury yield in a 40-year well-defined downtrend. We moved basically to zero during the pandemic, and what a powerful divergence we had in the momentum. This is a MACD indicator in the bottom panel. It's the first divergence in 40 years, but what a powerful reversal signal that was in the 10-year yields. All right, I know it is now 3 o'clock. We didn't even really get to the final item here on the list, which was to talk about the CMT program. Hopefully what I've shared with you today is useful. You can put that to work in your own charting. And if you have more questions about the Charter Market Technician program, some of these core concepts are taught across the 3 levels, but we bring together risk management, quantitative systems design, all in a portfolio management context to help you make better informed investment decisions. We are coming up on the next testing dates are in December. We're already closed for registration, but if the CMT program and really taking your technical analysis study is of interest to you, there are no prerequisites. You don't have to be a professional money manager to start the CMT program. For a lot of our candidates, it's the first step of a career change. The Chartered Market Technician credential is for professionals in the industry, but I encourage all of you, if you want to take that leap and think about managing portfolios for a living or producing research or market commentary, that is absolutely an open door to you. The next exams will be in June. It's a 3-part exam, and you take them one at a time. I have survived the program, made it through myself, so that should be living proof that anybody can do this. And I'll answer the question that is usually the first one that I get from university students all over the world. Yeah, but what are my chances of passing? So 5-year trailing averages, level 1, about 60% of the candidates pass. We have very low standard deviation around these numbers from cycle to cycle. Level 2, that pass rate is right around 55%. And for level 3, it's over 70%. but there's a lot more information about that on our website, including more information, survey data from our recent charter holders about what career impact that has had on them. I'll just point out this dot right here on the infographic from our marketing team. Over 60% of charter holders within the first year of completing the program and earning their CMT designation reported having higher assets under management, greater responsibility from their firms and from their clients, because there is a trust in their approach to markets in a disciplined, rules-based system that will help manage risk and capture reward. So, Jeff, I really appreciate you having me here with you. Every time these conferences come about, it's a great joy of mine, and happy to take any questions. But for all of you who have been watching, you are welcome to contact me directly and shoot me an email, tyler@cmtassociation.org, or I'm on all the social media handles. T-Bone Pickens is my X handle, and you can find me on LinkedIn, Tyler Wood CMT.
I'm gonna just start introducing you as T-Bone from now on.
You know, I picked that handle at a time when oil was peaking. T-Boone Pickens is a very successful Texas oil man. I don't know if oil trading at around $60 a barrel is quite the boom town that it used to be, but that trend will change eventually.
Neil says, Tyler, great presentation.
Thank you very much. Yeah, appreciate it.
Cynthia says, I passed all my levels this past June. Congrats, yeah, Cynthia, that's great.
That's awesome. Well done.
And it has improved my investing many-fold. So there you go.
Wonderful.
Yeah. CJ, and I don't know if you're prepared to talk about this at all, but CJ just wanted to kind of get an idea of the fees involved.
Oh, yeah. So for the program, it's the same price point across all 3 levels. We have early, standard, and late registration pricing, and we will open the exams for registration in June. January 15th, we'll open registration for that June cycle. The thing I should mention to you, big change for 2025, instead of studying from a textbook that you buy from our publisher, the curriculum will be embedded right with your registration. So the new pricing will be on our site. That new curriculum is going to be awesome. It's in a digital learning management software, very interactive, lots of study tools built right into the system. So it's a great self-study tool, and that information will be all over the CMT website. We're actually hosting a virtual town hall meeting on November 25th. Encourage you all to head over to cmtassociation.org. You can sign up for that, and you'll hear from myself as well as my colleague Stanley Dash all about that new curriculum and the enrollment period for June of 2025.
All right, that's it, Tyler. Thanks a lot.
Thanks so much, Jeff.
Thank you
I'll see you real
for
soon.
Coming again. So,
happy to do so. Happy to be here. I'll talk to you soon, buddy. Take care.
Thank you. All right, you too. Go ahead and do this. Okay. And we will go ahead and move over here. Okay. All right. Okay, we're a little bit, okay, let me go back a little bit here. I want to say thank you to Trade Thirsty for sponsoring the event and CMT Association. I agree, Tyler did a great job there. Trade Thirsty, good partner, Metastock, been partners with us for since they started in 2013. If you want, you can get a special offer from them. www.tradethirsty.com/free is their income generator and top 10 ETF report. So there you go. Mr. Lewis.
Mr. Gibby, how can I help you?
I think it's time for prize of the day.
Oh, that's right. It is. Let's do this thing.
I think you remember what the prize of the day usually entails, right?
It usually entails the best, probably the best ever software that's ever been on the earth ever.
So yeah, we're gonna give away 3 months of Metastock. In case you haven't heard of Metastock, you're probably just tuning in for the first time right now. But it's been rated #1 in its price category 31 years in a row. We've talked about scanning a lot. I think it's one of the things that Metastock does really the best. But that's not all. You know, you can use it to test trading ideas. You can use it to learn about the markets. You can use it to get real-time alerts. It's got great commentary. We've kind of discussed all of this before, but it's also got hundreds of systems in it. We've been developing it since the 80s. It's a great little, it's a great software program. So we're going to give you 3 months of that. We're also going to give you 3 months of Metastock Zenith. Metastock Zenith is a program that they developed. It was developed initially by Thomson Reuters. It's now owned by London Stock Exchange Group, but they spent about $1 billion on it. It's got really tremendous market breadth. They cover a few hundred exchanges, 200 or 300. They have thousands of reporters, 2,000, and over 200 different global news bureaus. It's like getting Bloomberg, but you're not really paying that $1,800 a month that comes with Bloomberg. And we're also going to throw in a little bit of Learn Metastock. Greg, do you have any tools over there?
I beg your pardon?
Do you have any tools over there?
Tools?
You have like a toolbox, yeah.
You mean handy, like right now? Like
no, not yeah, could you go get an Allen wrench for me?
Garage. I don't know.
We consider Metastock a toolbox, and generally, if you know how to use your tools, it's going to work better for you.
And Kevin Nelson, our next speaker, is a tool master.
Yes.
See how I did that?
You know, every time we start an employee here, whether it's in sales or support, or in a different department, usually we sit them down and we have them go through Learn Metastock. And the reason we have them do that is because it really helps them get up to speed with using Metastock, which is important if you're helping sell it or support it. And so we use it, Learn Metastock, as almost an internal resource. We're going to give 3 months of that service away, which is a value of $99 per month. So it's a great one. Mr. Lewis.
Yes, sir.
It's number time.
Okay.
And then again, any number between one. Oh, actually, no, we don't do this one by numbers, do we?
Oh, you wanted to pull it from chat. You know, anything we can do to get into Kevin Nelson's time, I'm all for
it. Well, Kevin can take as long as he wants. He's all right. Okay, so I've got all the questions, like if the open here. And so if you've asked any questions today, you're going to be on this list. And the more you've asked, the more likely it is that you're going to be selected. And so what I'm going to do is I'll just start here at the very bottom, Greg. I'm going to start scrolling up. I'm scrolling right now. I'm going to let you tell me when to stop.
Stop.
Okay. Earlier today, Grace H said, I do options, but I don't buy stocks. Does it directly support that? That's the comment we stopped on. So let me go ahead and pull that down to the bottom here. And Grace, congratulations. Grace H, congratulations. Cool. Thank you very much for the assist, Greg. Appreciate you.
You're very welcome. I should mention, of course, we can chide Kevin in ways that we cannot with our other presenters because he is a good friend and former employer of both of us, or coworker anyway. So.
Cool. Thank you. I also want to mention, if you want to get an extended trial of Metastock or Learn Metastock or any of the products we talked about today, go to metastock.com/conf promo. Get in touch with our sales team at 800-882-3040 or chat online with them at metastock.com/sales chat. So without further ado, our last presenter is the only presenter out of all of them that's hired me for a job. When I started, Kevin is actually the sales manager here, and we worked together for a number of years. I can't remember exactly what number that is. Right now, he runs as you might have gathered from what we were talking about just a minute ago, a site called LearnMetastock.com, and it's a site where he puts together 3 webinars a week on Metastock. He has tons and tons of training videos on how to use Metastock. He offers, like, one of the things that he'll do is he'll take a trading methodology and break it down and kind of go through and kind of analyze it and talk about it, and then offer the Metastock code. Lots of cool stuff that he does. So without further ado, Kevin, let's go ahead and get you started.
All right. Hey, Greg, I was hoping to see what tools you had handy there. I'd love to see the Allen wrenches.
I was trying to play along, but I wasn't quite seeing. I didn't.
Yeah, I wasn't. I could have been clear. All right.
Oh, that's awesome. What about dad jokes? Did we any dad jokes today, or did I miss them
Oh,
all?
for sure. Yeah. I recently got a rental car, Kevin.
Did you?
And it was just a loaner. My car was in the shop. It was a Tesla. It was kind of a brand new Tesla. And I noticed that it didn't have a new car smell. I would describe it more as an Elon Musk.
Oh, Jeff. I'm sorry, I've missed all the other ones too.
Oh,
That's how
wait,
you.
I have to mention that when Jeff told the joke about the Star Wars joke
Yeah.
to I can't remember her name, Marina. She was
Marina.
utterly like, what are you talking about? She had no idea what he was doing.
Well,
All
I'm
right,
sure
so
a lot. I'm sure a lot of the jokes probably
break a
went
leg
that
there,
way.
Kevin.
I'm sure a lot of them went that way. Oh, that's too funny. All right, love to see you guys. Yeah, as Jeff said, I used to work at Metalstock there. I worked there for quite a while. In 2008, I left the company, and what we did is we started this training company called LearnMetalstock.com. And this is our website up there that you can go up there and take a look. And so what I'll do, so I'd like to go through the presentation first, but at the end of the presentation, then I'll give you an overview of just our website and the type of training that we offer and so forth. But if you have any questions during today's, webinar or whatever, make sure and let me know. Send a message over there in the chat screen, and I'd be more than happy to try to help you out here as we're going through it. And Jeff, feel free to interrupt if if we've got something that somebody's asking about right at that time that is relevant to what we're doing. Okay, so let me go ahead and jump over. So the presentation I'd like to give you today is about a trading system called the Turtle Trading System. Now, a lot of you, I'm sure, have heard of this before, and maybe quite a few people haven't heard of this before. It's a pretty interesting trading system there that was originally developed back in the early 80s. And the traders themselves actually got this nickname called the Turtles. And these traders called the Turtles, there was a group of them, there was 23 of them. And one of them, the original Turtles, his name is Curtis Faith. He wrote quite a bit about this actual system. And here's just a few different things that you can purchase. But if you want to go up to the internet and do a quick search on this system, there's also a free PDF that he wrote that you can access as well. That could give you a lot more information than what I'm going to give you. I'm going to give you, of course, an overview of it, and then, of course, how it works inside of Metastock. Now, the original Turtle trading system itself was originally created by two futures traders, Richard Dennis and Bill Eckhart. And back in the early 80s, they had this discussion, and what they were trying to figure out is they're trying to figure out really, are traders born, or can they be taught and or made? And to help answer that, what they decided to do is they decided to run a little experiment. This experiment entailed them actually putting an ad in the newspaper and asking for people who were interested in learning how to trade. They would provide all the capital, the trading ideas, and everything else. And out of this ad, they received over 1,000 applicants. And of those 1,000 applicants, they chose 23 people. And these 23 people, again, are what they nicknamed the Turtles. Now, this turtle trading system itself that they created here, they actually gave their students two different systems that they could possibly trade. But the most important rule that they had for them is that there was absolutely no second guessing to the system. So in other words, the turtles had to follow the rules exactly. And anybody who deviated from these plans at all were actually kicked out of the system. So not everybody made it through, but again, what they're really trying to figure out is if people could follow these rules specifically and be successful with it. Now, the system itself is actually a futures trading system, or it was originally developed to work on futures. And what the students were allowed to trade are different futures contracts on coffee, cocoa, gold, treasuries, silver, and they did have a choice of the different markets they could trade. And what they had to do is they had, of course, to fully understand exactly what the markets were doing and what the individual ones were that they were interested in trading at that time and how they were actually made up. Then what they were doing is they were given two different trading systems that they could trade, a 20 and a 55-day breakout. Now, I'll just explain this just real quick, but the 20-day breakout, for example, how this worked is, let's pretend that you're interested in going long. All they really did was take a look at the highs of the prices over the last 20 bars. And they said that if you're interested in going long, we're looking for the prices to trade above the highest that the prices have been over the last 20 bars. And that would be considered a 20-day breakout. And then, of course, they also had a 55-day breakout using the exact same concept, except, of course, using 55 days. Now, using these two different systems, how it worked, that actually became pretty interesting, and a really kind of an interesting twist on this is that the trades themselves were actually based off the previous trade. And the only way that they could actually take a trade is if the previous trade was unprofitable, which is, again, in my mind, I think that's pretty interesting take, because if you think about it, most people, they want to win every single time. Everybody's looking for that 90% winning system and so forth. So they want winners back to back to back, whereas this one, you couldn't take a trade unless the previous trade was unprofitable. So I thought that was really interesting. So one of the things that they did is, let's say, for example, that somebody was interested in trading a 20-day breakout, but the previous trade was profitable. What they were instructed to do at that point was wait and monitor the trade, and using a 55-day breakout, if the prices broke above the 55-day high, then they were allowed to go long at that time. So that's how they would use the two different systems. Now, in addition to that, they also changed, or basically they varied the size of the trades based on volatility. And how that worked is that if it was an extremely volatile market or volatile futures contract that they're trading at the time, they're instructed to go in with a lower position, versus if they had very low volatility in the market in that particular security, they're instructed to go in at a higher position. Now, in addition to that, they also adjusted the contract size as well based on how the trade was playing out. So they would literally add and or subtract from the positions depending on what was happening at that time. Now, to get out of the trades, they had a couple different ways that they could do it. Number one, they always had this fixed rule of 2%, meaning that if they lost more than 2% at any point, the trade was over, they're out, period. No questions asked. In addition to that, they also place stops based off of those highs and lows as well. And if the prices broke through those different highs or lows, going, of course, the opposite ways, they'd be kicked out there. And in addition to that, they also use another indicator, which I'm sure a lot of people are familiar with, called the ATR, which is the average true range. So what we're going to be doing here today, which is a little different than what I do a lot of times, is we're going to take this particular system, and I'd like to show you how you can use it inside of MetaStock, because everybody already has this system available. And then, of course, in addition to that, I'll show you the different things that I've created to also help the Learn MetaStock subscriber with the system as well. So let me go ahead and jump over here to the program. All right, so we're looking at a chart of the SPY here. And what we're going to do is up here at our indicator quick list, I'm just going to go ahead and type in turtle, for example. And this is how you can quickly find the different systems or indicators available. Now, the one that'll only pop up on your list is going to be called this one, called the Turtle Trader Bands by MetaStock. So what you want to do is you just want to drag this on top of any chart. And then what's going to happen, it's then going to ask you whether you want to go long or short, and you either place a 1 or a 2 in this first box. 1 for long, 2 for shorts. And then the look back period, you'll see has a default of 20. So we're going to go ahead and just keep that as a default. We'll click on OK. And then this is going to ask how you want to plot it. And now what's really important here is that you merge it with whatever scale that you have on your chart. So in this case, for example, you see I've got my prices over here on the right-hand side. So I definitely want to merge it with that scale. So I'll click on OK. and that'll plot our bands. And if you get that scaling wrong, I'd highly recommend just delete it and then try it again, because otherwise these bands just aren't going to make any sense. Now, the way that you interpret this, so let's kind of zoom in here a little bit, kind of go in here a little bit further, is that we're just looking to see what these prices are doing in relation to these bands. So this upper line here, this is representing, for example, the highest that the prices have been over the last 20 bars. So I can see very quickly here, like if I hover over that line, you'll see it has a value 1 and 2. Value 1 is your upper band, value 2 is your lower band. So the upper band, of course, is 565.16. And so if I go backward in time and look at this bar, for example, let's kind of hover over that if I can, and look at the high of that, you'll see it's 565.16. That's the high of that bar. So that means that this line right here is basically saying that's the highest that the price has been over this last 20 bar period. Now down here at the bottom, the way that the system is set up is that by default, if it's using a 20 bar high, it's going to use a 10 bar low for the exit. So this lower band down here at the bottom here, you'll see the value in value 2 is 510.27, which of course is then going to be the low of this bar here. You'll see that 510.27. So the way that you interpret this is that if you're bullish, for example, you're looking for the prices to break above this upper band, and then one place where you could possibly exit out of the trade is if the prices break down below the lower 10 period band. Now, to help you out there, if you click on the expert advisor up here at the very top and then just scroll down to the bottom of your list here, you'll find that Metastocks also has this system here available here for you. It's called the Turtle Trader Hybrid by Metastock. Now, very quickly, as why they have the name hybrid in there is basically how I was describing the system to you before about how they are adjusting the size of the trades and whether or not they would take a trade and so forth. There's a lot of little variables in this very simple system, but because of that, that just adds a lot of complexity to the trades. So the idea here, the reason why it's called hybrid is because we're just looking at the bands just by themselves, and we're not really adjusting the trade sizes or anything like that. Now, once you have that selected like that, over here on the right-hand side, if you click on this button right here, which is the edit button, this is going to take you out to the editor here. Now, what I want you to do is go to this tab right here, which is a symbols tab. And this is going to show you the different symbols that you can plot on your chart. So to get started, I'm going to unselect everything. And I just want to start by clicking on the buy and then the sell. All right. Click on those two, click on OK, and then click on attach, and then close this down. And then this is going to put a number of different symbols here on your chart. So you see we've got a number of different buy signals here. And then we have some signals here that have like a circle and they have a number 10 in it, if you can see that, okay? And the reason why you have this is that these buy signals or upward arrows, for example, are representing where you could possibly get long. And then the circle with the 10 is representing a possible exit because it's breaking down below that 10 period low. So for example, if we're looking at like this spot right here, you'll see that our high at this point was right there at what, 533.07, and then this bar traded above that, and because of that, we've got this upward pointing arrow. Now, one of the questions I get a lot of times is that when you're looking at these different signals here on this chart here, you'll see that you've got a lot of signals or a lot of buy signals in an upward trend like this. And the question is, why do you have so many buy signals? Well, the way that this system is written here is that if you get into a long position and then the prices trade down below that upper line there and then trade up through it again, this is going to basically plot another buy signal. So you could look at it a couple different ways. You could say, okay, well, this is the initial signal, and if you're following it and prices are moving this way, you could possibly look at this as confirmations in the upward trend or additional places where you could possibly get into that upper trend. And then vice versa, over here, you'll see on the right-hand side, we've got an exit because the price is traded down below that lower band. So really, I mean, that's kind of it. I mean, it's a pretty simple strategy right there, right? It's just looking at the prices in relation to those two different bands. Now, In addition to that, let's go back into our expert here and let me show you one other thing here. So I'll go ahead and scroll back down here to the bottom. I'll select it, click on the edit button, and then I'm going to add this button right here, which is the sell stop, and then click on OK. Click on close. And now you'll see that in this case, for example, kind of zoom in here, you'll see, let's zoom in here just a little bit if I can there. There we go. All right, so you see, for example, we've got another stop signal right here. Now it just says stop, and this one now also says stop instead of 10 there, by the way. But what this is doing, the reason why this is coming up as a stop is because this is now violating that ATR, or the average true range. So one thing that you can do, one thing I added that will help identify what the ATR is doing during these different moves is I did create a signal here for you that you can plot. So the way that you can pull up any of the formulas that you get from the Learn Metastock website is just start typing LMS, for example, and then that'll get you down to the group here. And so I'm going to scroll down here, and the one I want to grab right here is called the turtle sell stop. So I'm going to drag this directly on top of the price bars, and we'll just click on OK and click on merge. We want to make sure and merge it with a scale. But this is the average true range here for this chart here. And the idea is that this system will kick you out of a trade if the prices either violate the ATR, or the average true range, or the lower band. All right. So as you can see here on this bar right here, it didn't violate that lower band, but it did violate the ATR. And that's why I would recommend that you would get out at that point if you hadn't gotten out previously. All right. Now, so then the question that you might have is, well, how good, I mean, how did this thing really perform, or how has it performed on past data? Well, one of the really nice things is that inside your system tester, Metastock also includes a system test for it as well. So for example, let me go ahead and get rid of that. What you can do, if you open up your system tester and again scroll down to the very bottom of your list here, you'll find a system called the Turtle Trader Hybrid Method by Metastock. And so what I'll do is I want to go ahead and test this one on the SPY, for example. And I'll tell it to test going long only over the last 1,250 records, which on end of day data, of course, is about 5 years of historical data. We'll test it on daily data. And let me just show you how my trade setup is, or how my trades are set up for system testing. I'm going to go to my account here, and you'll see that I've got selected to run a points only test. So what a points only test is going to do, it's just going to return back a raw number of points that were gained or lost. It's not going to take into account any type of dollar figures or anything else. And just very quickly, I like using a points only test when I'm initially trying out an idea, because it's just going to tell me points that are gained or lost. You can always go back and add dollar figures to it, and there's a lot of different ways you can do this, but I just find this really easy to compare results of different systems against each other. So by using a points only test, when you go to the broker, that also takes out of the equation any type of interest rates or margin, which again simplifies things for you. And lastly, over here on the trade execution, you'll see I've got everything set to trade at the opening with a 1 period delay. So that means if I get a buy signal tonight, after the market closes, that this would quote unquote simulate that I'd get in at the opening on Monday. Okay, so we'll click on OK, and let's go ahead and run it here on the SPY, the chart that I have open. So I'll just put in my symbol and then click on our start system test. All right, now when you click on the view report, we can take a quick look, see how this thing did. And let's go through this. All right, now I know we've got a lot of people here in the room that have various, understandings of Metastock, maybe system testing and so forth. So I'm just going to talk about a few of the basic things here inside the system tester here that hopefully will help here a little bit. All right, so to get started here, you'll see that our profit here generated a little over 100 points. So then the question, is that good? Is that bad? Well, one thing you can look at is this buy and hold. The buy and hold says that if I would have bought this security on the first bar that I loaded in the system test and just held on to it, I'd be up 274 points, okay? So then you say, well, hold it, this thing didn't even do half of that. So gosh, why would I even want to do that? Well, there's a lot of things you want to take a look at when you run these different systems. So I'm just going to show you a handful here that I like to zero in on. All right, so first of all, we'll take a look at the number of trades. It traded 34 times. It had 16 winning trades and 18 losing trades, all right? And the average profit was 12.9 and the average loss was 5.9. Now, in this case, we actually had more losing trades than winning trades. But what I think is actually more important is the size of your average winning trade versus the size of your average losing trade. And what I think is really, really important for most people to look at, especially newer traders, is that when you're looking at developing trading ideas, you want to tend to go towards the systems where the average winner is substantially larger than your average loser. And if it is, then if you actually trade that and that becomes true while you're trading real money, you can be wrong a lot more often than you're right and still make really good money with that trading strategy. But if that average profit gets close to the average loss, about the same size or less, statistically, if you trade that long enough, it will wipe out your account. So you do have to be very careful there. And then down here at the bottom, this is another number that a lot of people tend to overlook. And this is how much you were actually in or out of the market. So this system here was out of the market 605 bars. So what does that mean? Well, if you look up here, excuse me, is that we tested 1,250 bars. So in other words, we were out of the market almost half the time. So that means it generated 100 points in about 2.5 years. But in order to generate 274 points, we had to be fully invested for 5 years. Okay, so that's another thing to take a look at when you're looking at the results of these different systems. But one of the most important things is down here at the bottom. If you click on this plot on chart down here, what this will do is this will give you the actual buy and sell signals of the system here, so you can verify, that this thing is buying and selling where you think it should be buying and selling. So we've got a lot of things going here on the chart, and one thing I'm going to do here is I'm going to clean it up here a little bit. I'm going to right click, I'm going to go into the expert advisor and choose detach. And now what I've got here is I've just got the buy and sell signals here from our system test. So let me kind of move over here for just a second. Let me just show you this little area right here. We'll kind of zoom in on this. All right, so right here, you'll see that this is a buy signal right here, and this occurred on August 21st. Well, if you look at the prices in this upper band, you'll see that the actual prices traded above that upper band on this bar right here. So the question is, well, hold it. We put in a delay of 1. How come it was delayed 2 bars? Why didn't we get in at least on this bar here? So that's one of the things that I came across in the system tester. So one way to possibly go about making that adjustment is that we could go back into our system tester, for example. We'll rerun the system test, but what we're going to do is we're going to go to the trade options here. I'm going to click on the trade execution, and I'm going to change the delay from a 1 to a 0, and then click on OK. All right, so now let's go ahead and rerun that scan, or that system test. I'll put in the same symbol of SPY. We'll click on our start system test, and then when it's finished, we'll click on our view report there. All right, hang on for just 1 sec. All right, so now you'll see by making that change here, okay, look at that. We increased a whopping 2 points there. But we'll click on this plot on chart here, because what I'm really after here is I want to see what kind of change that made to the signals. And here you can see that, oh, there it is. That's exactly what we're looking for here, is we're seeing that this price bar, for example, traded above that upper band, and we got into the trade on the next bar there. So that's exactly what we're looking for, right? Based off of the settings on that system test. And what you can also do too is that when you run these system tests, you'll see that underneath each one of these signals, there's going to be some yellow numbers there. 1 represents the number of shares or contracts or whatever you're trading at that point, how many were actually traded, and then 37 in this case in the parentheses represents the actual trade number, or trade number 37. So in other words, this trade number 37 traded 1 unit at, what's that price? $559.15. And if you hover over the price bar, then what you can do is then you can verify that the opening price, for example, is 559.15. See that? And so that's perfect. That's exactly what we need. So based off of this and just testing on the SPY using daily data, right, you can see that this is where it got in. And by the way, this, of course, is where it got out because the price is traded down below that lower band. Well, one of the first things I want to think or possibly try to experiment with this is like, well, hold it. If I know what the upper band is and I'm bullish on this security, then I know exactly what price I want to get in if the prices trade above that. So in theory, if I know this level, for example, is what, 564.20, I could theoretically place a buy stop with my broker and say, hey, if prices trade above that, just go ahead and play, get me into that trade or get me into that position. And so in other words, how would I modify the system to actually get in when the prices break above these levels, for example? So to do that, what I did is I actually created a number of different trading strategies here. And if you go up here in the system tester and in the search dialog, I'm going to go ahead and type in LMS for my Learn Metastock formulas here. And you'll see I've got 4 different trading strategies here or systems here that I created. So the first one, my turtle trader number 1, basically enters and exit based off of the bands. Now the way that this works, I'll go ahead and select it. I'm going to keep everything else the same. And again, I'll go ahead and put in my symbol of SPY in here. And again, start my system test. Now when it's finished, we'll click on our view report and we can see how this affected it. Okay, so by making that change, you'll see that this increase of profits to 168. See that? So kind of expand this here a little bit. And you'll see that in this case, for example, there are 33 total trades, 19 winning trades and 14 losing trades. So we got more winners than losers, which of course everyone likes to see that. And then the average profit was 12.6 and the average loss is a little over 5. So again, a better than a 2-to-1 ratio. And same thing, if we scroll down here to the bottom, you'll see that we're out of the market approximately about the same time. So we'll click on our plot on chart, close down this dialog. And then what we'd like to do here is just verify that this is buying and selling exactly where it should be. So for example, like right here, if I hover over there, you'll see it got in at 556.73. Right? And you'll see if you hover over that red line, you'll see that that's what the value of the red line is at that point, or the upper band. And then vice versa for sell signal, or exit, I should say, it got out at 553.86, which again is the value of this lower band. So by doing it this way, I know that this thing is now doing exactly what I want it to do. It's buying if the prices trade above that upper band, and it's selling or exiting out at the price of the lower band. So that's one thing you can do. So now, actually taking that just a little bit further, then I was like, well, hold it. What if we did it based off of the ATR? Because that was another type of exit that they recommended that you try. So I'll go ahead and put that in, and we'll put in the same symbol, SPY. We'll go ahead and just start our system test and click on our report. And you can see by basing it just off the SPY, now our profit went to 100 points. It dropped down quite a bit here. So kind of open this up. We'll take a quick look at this. Now we have 17 winners and 21 losers. So we have more losers than winners. The average profit to average loss is still good though. Our average profit is over 13 and the average loss is a little over 6. And again, down here at the bottom, we're out of the market about the same amount of time. So I'll go ahead and click on our plot on chart and we'll close these dialogues down. And here, by taking a look at this, if I kind of scroll back here a little bit, and we can take a look at some of these different signals here. Let me go back here just a little bit further. Okay, so here's one right there. There's a good example of one right here. This is a trade, of course, it didn't work out. The price traded above that upper band, and you can see it quickly got out right there. So let's go ahead and plot the ATR stop on there. Let me go ahead and grab that, and I'll drag that on there. And the reason why it got out at that point is because the price is traded below that ATR level. So that's another nice thing about, having a visual system like this. You know exactly where you're going to get in, where you're going to get out. And again, you can place it on whatever you like. So then the next question I had, well, hold it, instead of just doing the ATR, what if we did it on either the ATR or the lower band? Meaning, let's exit out based on if it hits the higher of those two different items. So let's go ahead and run that real quick. And as you can see, this is one of the real powers of Metastock, is that once you start to figure out how to use this kind of thing, this is an incredible tool where you can ask it about any type of question that you can imagine. And this thing will come back and tell you exactly what happened, going backwards like this. So again, I just can't say enough about it, to say the least. Anyway, so the profit in this case now jumped back up to 143. You'll see that we've got 20 winners, 19 losers. The average profit was 12 and the average loss is 5. And again, we're out of the market over 600 bars, or half the time. So this time, what this one did here is this is getting out based on what the prices are doing if they hit either the ATR or the lower band. So as you know here, as you can see here, I'm basing this, of course, just on the SPY, but as you might imagine, you can test this on anything that you can imagine, to say the least. And by the way, you can also do this on any time of time frame as well. So if you're a real-time trader and you want to use this on 5-10 minute charts, whatever the case is, again, the concept is exactly the same. If you're a momentum trader and want to trade in the direction of the overall trend, again, very, very simple, right? So let's do one more thing. And the last question that I had in trying to figure out how this thing could work, or maybe how to improve on it, is the default here is 20 periods for the upper band and 10 for the lower band. Well, maybe those aren't the best periods to use, or the best length bands to use. So to help answer that question, I created a fourth system here, which is optimization. So let me go ahead and select this one. It's called enter and exit based on the bands with OPT, or optimization. So let me go ahead and just start that one. We'll click on our start system test. And now this is going to take a bit, because this is going to go through 250 different combinations. Because what I did here is I said, for the length of the upper band, let's go ahead and check 2 to 50 periods, for example, and we'll do it every steps of 2. So we'll do a 2, 4, 6, all the way up to 50, and then vice versa. I did the same thing for the lower band and all the different combinations in between. And by doing that, again, as you can see, it goes through 250 different calculations or system tests. Then when it's finished, you click on View Report. When you run that, you're going to get a test like this, or a test result like this. And as you can see, it looks like everything is profitable. So this is where I need to stop for just a second and just explain one thing about what we're looking at. We just ran an optimization, meaning we told to go through the last 5 years of data and test all these different combinations of these bands here to see which one actually worked and which one didn't work. And according to this, it looks like everything was profitable. Well, one thing you have to keep in mind is that the most system tests that Metastock will keep track of is 100. So in this case, I ran 250. So what we're looking at is 100 of the most profitable system tests. So what I'm trying to say is that there's a very high likelihood that there were definitely some losing systems in here, but since we're only looking at the top 100, again, it looks like everything was a winner. So now, when you run a system like this, the other nice thing about this is that you can sort on any of these columns. So let's say, for example, you can sort on the net profit, for example. And here you can see that the one that generated the highest profit generated over 300 points. And to do that, you can see that it generated, or in order to do that, it had 81 trades, 40 winning trades, 41 losing trades. And then this 1.91 is the average size of your average profit to your average loss. So this is that number that I've been talking about before, or was talking about before, where I want my average profit to be substantially larger. So generally speaking, I like to see at least a 2, if not a 3 to 1 type of ratio, where again, my average profit is 2-3 times the size of my average loss. So this is just a little under, not bad though, but you can also look at your optimization variables over here on the right-hand side. And what these numbers represent are the actual length of those bands. So for example, the one that was most profitable, it had a length of the upper band of 2 and a length of the lower band at 6, which is a lot different than what we have by the default. Now, if I kind of go down this list here and look at something like this, for example, like here's one right here. This one generated what, 276 points. It had 22 trades. It had 15 winners and 7 losers. And the average profit, average loss was over or better than a 2-to-1 ratio. Now, the parameters that you use for that is 10 for the upper band and then 18 for the lower band. Okay, so if you want to take a closer look at that, then of course, then you can open it up by double clicking on it. And then of course, we can go down here and we can click on plot on chart and do the exact same thing. So we'll go ahead and scroll down and go back. So let's say, for example, that now what we've got here is we've got the metastock bands on here, but we want to see the bands at 10 and 18, like what came up in the system test. So to do that, if you double click directly on the metastock band, you'll notice that you can only change one of the look back periods. So for that reason, I created another indicator that you can plot on your band or plot on your chart called the Turtle Bands Adjustable. Let me get rid of this one first. Sorry about that. Let me get rid of that one. And then we'll go ahead and plot it. The Turtle Bands Adjustable, I'll drag it on our chart. And here you can set the upper and lower bands to any length you want. So we'll set the upper one at 10 and the lower band at 18. Click on OK. Definitely merge it with your scale. Click on OK. And then as you can see here, then as you can see here on our signals, that's how these signals will basically match up with the bands here. So for example, the reason why you got long at this point is because of course the price is traded above that upper band. And on the previous trade, this is where it got out because it traded below that lower band. So again, I'm testing it, of course, just on the SPY, but you can literally run it on anything you want. And in addition to that, you can also go up here to your expert advisor. And here I've also created something else that you can plot on your chart there as well. I'll go ahead and scroll down to the LMS formulas. There we go. And I'll select the turtle system. If you click on the edit, here you can go underneath the symbols here, and then you can choose, for example, like if I just want to see the long and the long signal and then the a long exit, I could select those two. And then you can also adjust them as well by double clicking on them. And here is where you can put in those parameters. So for example, if you want to put in an upper band of, again, in this case, like 10 and change the lower band to 18, you can make those modifications and plot that on there as well, okay? Then one last thing that I also created that possibly could help is an exploration. Whoops, do I want to say the changes? No. Is an exploration where you can go out and then search based off of these different length bands and so forth. So if you go up here to your Explorer and then do a search up here at the top again for LMS, this will bring us down to our formulas, and you'll see that this one right here, the Turtle Band Exploration, that this is going to identify the prices crossing above or below the lower bands. So for example, if you go to the upper band formula right here, you can change that upper band to any length that you want, and you can change the lower band to anything that you like as well, and then go ahead and run this scan. So for example, I'll select it. I'll go ahead and tell it that I want to run it on the NASDAQ 100 securities over the last 5 years using daily data, and we'll go ahead and start that exploration. We'll take a quick look to see what kind of hits we got here. I would imagine most of our securities today are going to be to the downside, but let's take a quick look and see what happens here. And up here at the top here, you can also kind of get a feel for how this is actually working too, to see if you're getting anything rejected out and so forth. Now, in this case, I didn't put any type of filter in here. And the reason why I did that is because this will show you all the securities that you scanned on, and then you can sort on the data here inside the Explorer. So for example, like you've got your securities listed here alphabetically, you've got the closing price, and then we have a column called upper, lower, volume, and then the volume percentage change. So for example, like if you click on any of the column headings, this is how you can sort on the data. And so there's only one security that was breaking to the upside today. This is Dexcom. But if you click on the lower, for example, I'm sure we'll get quite a few more. Yeah, we've got quite a few more here. that are all breaking to the downside here. And here you can kind of get an idea for the volume percent change. So for example, this looks like, what is this, Dr. Pepper at the very top? It looks like the volume percent change is 24% higher than yesterday. So let's go ahead and open that up. And before I do that, let me point out one other change that they made in version 19 of Metastack that I am absolutely a huge fan of, is that when you run these scans, you can sort your data on however you want. And then you just open up that particular security. So for example, like I'm going to open up Dr. Pepper, and then you'll see that the next one down is Airbnb, then Lamb Research, and so forth. But if you open up the first security, for example, by just double clicking on it, that'll open up the security. You can then either close or minimize this window. Then you can plot those bands on here. So let's go ahead and grab the turtle bands. We'll go ahead and place those on here. We'll make the top band 20, the bottom band 10, that's fine. And place it on here. And as you can see here, the reason why this security came up on that scan is because you can see it's breaking down below that lower band right now there. So that's for Dr. Pepper. If you click on the right pointing arrow, the nice thing is again, like in version 19, once you set up or basically sort your fields there inside the Explorer, open up that first security, you can then scroll through your securities in that list, and it opens them up one at a time in the order that you sorted it on. And that is, in my opinion, I love that feature, because otherwise what you have or can do is you can then save that list and then open up the securities this way. But if you just want to look at them quickly, sort inside the report, open up that first security, and then as you right click on this or click on this right pointing arrow down here at the bottom, you can very quickly just kind of cycle through all of those securities, giving you those buy or sell signals that you might be looking for. All right. All right, so I hope that that's helpful. I know it's a lot of information, but you know, at Learn Metastock, we can help you in a lot of different ways. And as you can see, I mean, Metastock's of course extremely powerful. I mean, you've heard a lot of people talking about it, and you can buy, for example, of course, if you're interested in just getting, you know, pre-built buy or sell signals or so forth, you know, using the different add-ons, of course, you've always got that opportunity. But Metastock by itself is extremely powerful. And here at Learn Metastock, this is what we do, is we can help you learn this program and hopefully get a whole heck of a lot more out of it than otherwise what you might get on your own. So if you go up to the Learn Metastock website, for example, the way that our site is set up is that if you click on, for example, we've got the section called live classes. And what we do in live classes is 3 days a week, we do classes on Tuesdays, Wednesdays, and Thursdays, where you can come in and you can ask whatever type of question that you have at that time. And then of course, our subjects rotate every week as well. So just go up here to the live classes, and that you'll see the different live classes for the week. But where most of our customers spend their time is underneath this section right here, which is called the video library. And inside our video library, we have well over 100 instructional videos in here that again, we can help you from A to Z. I mean, whether you're brand new to technical analysis to, you know, a seasoned Metastock user, and you just want to learn more about system testing or formula writing, I mean, we've got you covered. So for example, I mean, like right here, we're in this section here called Getting Started. And you can click on any of the videos, for example, and start them out. And then if you want to select that video or play it, you just click on the play button, of course. And then if we create anything to help you out with these videos as well, you'll find the downloads down here at the very bottom here. And one of the things that we do with a lot of the more basic videos is we also include quizzes. So if you want to reinforce the different things that the video was teaching you, you can click on the quiz, you can take a short quiz, it'll grade you, tell you how many you got right or wrong, and hopefully kind of help you with your learning curve that way as well. But as you can see over here on the left-hand side, we've got all different types of categories. So if you're interested in more like system testing, take a look at our system testing videos, and we can walk you through all the ins and outs, what to look for, what to, you know, how it works and so forth. I love the whole section on the Explorer. Explorer is my favorite tool inside the Metastock program, just because it is so incredibly versatile and what you can do with it. But if you want to learn more about formula writing, for example, you can go down here, you can go through our formula writing videos. But again, one of our most popular sections is this section here called the trading strategies. And this is what we did today, is we took this system here called the Turtle Trading System. And what we do is we'll take these ideas from books, magazines, internet, whatever the case is. We'll show you how to actually use a system. But in addition to that, once you actually want to learn how to use that inside of your own program, at the bottom of each one of those videos, if you go down here to the resources, you can click on here, and this will download the formulas that I was showing you today directly into your program. And you'll have everything exactly like what I was showing you here today. So, I mean, I've been doing this for a long time, and one thing I can tell you, I can't make a lot of promises, of course, but one thing I can definitely guarantee is that if you go through our training and consciously go through it and work at it, I can save you a massive amount of time, effort, to say the least, because I've already gone through this and I've got it all prepared for you. So again, we can help you in a lot of different ways, and hopefully that works for you. So anyway, so that's what I've got here for you today. Again, I hope it was helpful. So at this point, I'll go ahead and hand it back over to Jeff. And if anyone needs to get in touch with me, you can always just drop me an email there at admin@learnmetastock.com, and I'll be happy to help you there. So, all right.
Here, let me find my mute button. All right.
There
Here, I'm going to go ahead and make me the presenter real quick.
All right.
Thanks again, Kevin. I really appreciate your coming in and talking, sharing some ideas with us. And I'll take it from here.
Thanks again.
All right, cool. So, here, let me turn this on too. Yeah, again, just want to reiterate, every time we bring on a new support employee or a sales employee, the first thing I do is have them go through videos. We have them learn Metastock videos so that they can understand kind of the tools. And I think the lesson that Kevin just gave is a pretty good illustration of one of the things that I really like about it, the kind of the ability to go through, explain a system or a methodology and kind of how it works. But as part of learnmetastock.com, let me just move me off of the screen here. You're going to get 3 live classes a week, and you're going to get hundreds of videos. Videos on using Metastock Basic, the Expert Advisor, the System Tester, the Zenith program, videos on stops, just so many different videos, technical analysis theory, the risk of ruin, all kinds of stuff. So in addition to that, one of the things that is worth it just by itself is Kevin just talked about the turtle trading system, and he kind of talked about the indicators. He does that. He's done that for over 21 different systems. It includes 9 templates, 62 different indicators, expert advisors, system tests, things that you can completely download to use for the thing. So if you're looking at kind of a really effective way to kind of supercharge what you're doing with Metastock, and even your technical analysis by looking at some pretty good technical theory, Learn Metastock's a great option to help you do that. And normally it's a service that Kevin provides. It's $99. It's always a service that Kevin provides, but it's $99 per month. If you're a new customer of Learn Metastock and you subscribe, what we'll do is we'll do the same thing that we do with Metastock, and this would pair really well with your Metastock trial. So if you buy a month, we'll give you the second, we'll give you the third month for free. That means it's about $33 a month. If you add that to Metastock, you're paying basically like about, well, $57 per month to get Metastock and Learn Metastock. I'm just checking the math in my head. I think it checks out. You should do it. It's a good way to kind of help kind of get up to speed and get running with the program, learn more technical theory, all that kind of good stuff. So metastock.com/conf promo. You can call 800-882-3040. And you can also go to metastock.com/sales chat to do that. So big thanks to Kevin for helping me train my employees. But also, it's a great service. You should check it out. So also, all of the offers we've talked about all day are at metastock.com/conf promo and all week as well. as we kind of wrap up everything, I want to say thank you to everybody that's been here all day, and thank you for being here. All of our speakers, all of our presenters. This conference has gone really, really well, and I appreciate your being here. I hope you've learned some things. I want to say thank you, of course, to our sponsors, CMT Association, Trade Thirsty, AAII. I'm trying to remember. My slides are out of order a little bit here. If you haven't yet, go join the Traders Forum. You can find out about the Traders. You can just join. Go to www.thetradersforum.com. Now would be a great time to do it. Go ahead. There's live market chat with other traders. We talk about theory. We do interviews with other traders. It's a great place to learn about the markets. Thank you, Neil. Appreciate you being here. And of course, we talked about Metastock. I don't want you to forget. I know it's Friday. We have another day tomorrow that we're going to kind of come in here. And I've got the schedule. We have another great group of speakers coming in. We're going to start at 8 a.m. or 10 a.m. Eastern, 8 a.m. here. And we're just going to start with Adrian Mantz. We have Anwari Bain come in. She always does a really, really good job. They all do. Jacqueline Munro is going to come in, and she's going to talk at noon Eastern. Sunny Harris is going to kind of finish up after that. I'll be talking about some of Steve Bigelow's candlestick patterns, and then we'll finish out the day with Peter DeLaw. So we'll see you again tomorrow. Thanks for coming. As a last thing, we will also be giving away more prizes tomorrow. So if you haven't yet and you're watching us on YouTube, go ahead and like and subscribe to like. It helps a great deal. Subscribe to the channel if you haven't. But go to metastock.com/conference. Traders Conference, and Greg will put that in the chat, and register for the event so that you can kind of be eligible to win all those prizes. So big thank you, everybody. So far, so good. We'll see you again in the morning. Stay healthy, stay well, take care of yourself.